strikes against Iran. Now, and then in retaliation to that, Iran's foreign minister Araghchi said that U.S. had chosen to test our determination and that, they should leave our territory, leave our space. So all of this has happened. And that's the point I'm making, that, prices should have spiked. I mean, if this was so close to the ceasefire and there has been an actual military escalation, are markets buying into the fact that maybe, that signing on the dotted line with regards to some sort of an agreement is not going to take place? Well, the answer is no. Market's still very hopeful. Price is still at about 92, and I think that is the story. But, to be fair, oil markets have gotten it wrong in the past as well. So we just we don't know. But in terms of expectations of the conflict ending, I mean, you can always point to the next day or the day after and say, well, that's when it's going to happen, and prices need to go a lot lower. There is enough oil in the world. It's just not getting through, and that's the logic which markets are kind of working with right now. Now, U.S. markets have seen, so Friday was the big sell-off. Monday was a little bit of stabilization. Last night, tech stocks sold off again, and the Nasdaq ended about 0.9, almost about 1% or so. And the intraday range, the high-low of the Nasdaq, actually is very, very large. I mean, it was the fourth largest if you look back 3 years or so, right? I mean, that's a pretty large intraday range. And that also shows you, I mean, that intraday range of about 3.5% does show you the confusion, the debate which is going on in the U.S. with regards to equity supply, large tech IPOs, whether, that'll tip things over, whether the best is behind, or there is a lot more to go here. So all of that, of course, indecision, whatever you want to call it, but basically a very large day as far as the Nasdaq is concerned, at least high to low. AI, high beta, momentum trade let off steam once again, and that's the pack that we'll focus on more in a bit. And there was no other clear catalyst to this apart from what I've already mentioned. And of course, I mean, the geopolitical headlines which kept coming. The 10-year yield, by the end of it, I mean, actually, we did see briefly intraday a spike, but ended about 4 basis points lower. We're back at about 4.5% or so. Yesterday's session in India was interesting as well because, a day before yesterday, we had left off. We closed at 23,070, and that was an important support, as we mentioned yesterday as well. We've respected that. We've bounced from that, and we didn't break it. So that is the zone. Now, the next kind of level is 23,800, but before that, there is this congestion zone. If you can go back to the earlier graphic, 23,320 or so. Yeah, that's the one. That's the congestion zone, which, because, I mean, we've kind of chopped around these levels for so long now that 2370, I mean, if that breaks, then about 23,000. But on the upside, 23,320 as the congestion zone. And then, of course, there is 23,800, which hopefully we head to if you're able to clear this zone of congestion that the market has found it difficult to navigate through. GIFT Nifty will come up, give you a quick sense of how we're likely to start, and then we'll pick it up from there as we move forward. It's about, say 70-odd points lower. So it's a little down, but, markets are hopeful. Let me leave it at that. Nigel has walked across to the wall with a quick check on the F&O positioning and the stance. Nigel, take it away.
Well, the GIFT Nifty is suggesting a bit of a soft start, and I don't think it'll be such a bad thing. And the big question is, India has actually outperformed in June so far. We have outbeat, what the Kospi has done. We've fallen less, basically, in comparison to Kospi, Taiwan, Nasdaq. Remember, those are markets that rallied very, very hard. But at least for the month of June, well, we are relative outperformers. And the question is, can we relatively outperform from here on? Maybe there is a case that's building up out there because crude oil prices have pulled back. They've stopped reacting to headlines that much, not spiking above that $100 per barrel mark. The tech, the AI trade seems to be seeing some kind of unwinding. And the rupee as well has shown some signs of stability post the RBI measures, and that will kick in the next few months or so. So all those three, which were headwinds for the Indian markets, they seem to be subsiding. The problem is the FIs. They continue to sell. They sold close to 4,500 crores in yesterday's trading session. Net, though, institutions were buyers in trade. And the FI is selling, well, it's creating pressure on large caps. Some of them are not looking great with regard to a growth perspective, but I think a bottom-up approach is likely to continue. So the breadth of the market is going to be very, very important. And I expect stocks from the broader markets actually to continue to outperform from here on. Yesterday, it was evident that there was a bout of short covering that was taking place for the markets on the whole. The Nifty ended up, the open interest was down 1%, and the Nifty Bank, we had pointed this out yesterday, that could be a candidate for a bit of short covering. That's precisely what happened, because the Nifty Bank had a big blowout rally, and you had the open interest that was down by close to around 4%. So shots in the system on the whole, they did cover their positions. And if you look at the FI positioning, on index futures, what happened yesterday was, after a while, we saw the number of long positions added for more than the short positions that were added. That's the first time that that's happened in the June series so far, which is heartening to see, right? A market that's been seeing continuous shots getting built up from the FIs, some long addition. Hopefully, those shots as well do cover out. So as that previous play told you, the short positioning is holding at around 91% or thereabouts. There was clearly though short covering that was seen on stock futures because the shots covered out and there was some long addition as well. Getting straight to the options data then, the 24,000 call, well, some out there are hoping that things really, get up and going. Bit of a punt out there, going ahead, buying an out-of-the-money call option. All you lose is 15 bucks. If you get the direction right, then you make some money. So that's some out-of-the-money call buying. But the nearer-term levels are even more important. 23,300 call, good amount of open interest built up, and you had the premium there holding at around 200 rupees. On the downside as well, there appeared to be some writing at around this 23,200 put or thereabouts. So looking at these options data, looking at the recent technical levels, we'll bring up the Nifty levels that you need to track up for you on the screen. The 20 DMA, that's far away from here, but the initial resistance that you're looking at is at around this 23,350. If we conquer this first resistance mark, then all eyes are on the 20 DMA. And the bulls will feel they're in the game till the recent low, which is 23,070. 23,070 is protected. The Nifty Bank, last few trading sessions has been showing signs of outperformance. You want more of the same. And yesterday it left behind the 20 as well as the 50 DMA. So any kind of dip on that one, it appears, at least for now, these will be support zones now, which were earlier resistance, and you'll want it to continue to trade above those levels. As I said earlier, headline index could be in a bit of consolidation mode, but the breadth of the market and the broader markets could actually continue to outperform from here on.
Right, Nigel, thanks a lot for that. Broader markets, something that we will monitor as we go along in today's trading session. Over the last couple of days, there have been more advances than the number of decliners on all the broader indices. Good time to get in our guests then. We do have Rahul Chadha, founder and CIO at Shikhara Investment, and along with that, we have Prashant Paroda, who's a portfolio manager, emerging markets at Allspring Global Investments as well. Prashant, let's start with you. The month of June so far, the Indian markets have fallen a lot less than some of the other peers. And even though the other peers have seen bigger gains, do you think the time for India now has come by? Are we at around an inflection zone, or maybe the AI trade continues, notwithstanding the recent confusion?
I think the AI trade, especially when these IPOs are being digested by at least the US market, it's pretty clear that a lot of these companies will be able to raise. Now, what's clear is how things will react in the aftermarket. So if there is some kind of wobbly effect in the aftermarket, then people will question kind of the capex numbers going into next year. So I think the AI trade is very dependent on how these IPOs trade over the next month or so in the US market.
Got that. Morning, gentlemen, Prashant and Rahul. Rahul, good morning. So this FII sell-off continues, right? I think this month so far, if you total the number, it's about 40,000 crores already out net. There was this piece which Akash from Mansa wrote yesterday, was doing the rounds. I mean, not very much new, but it's a pretty somber read. What's your read through? And that is one part of the equation. But the non-FII part of the market continues to power higher, and that is a smaller cap, that is the large parts of mid-cap, and those are doing just fine. Your thoughts, Rahul?
Yeah, no, absolutely. So if you see over last 2 years, first we had the overhang of the US tariffs, which unlike most participants' expectations, initially started at almost 50%. And then we had the Middle East conflict. And obviously, last 6 months have been all about the AI trade, where markets like Korea, Taiwan, and parts of China have benefited at the expense of India. What we're seeing now is some bit of a rolling over of the AI trade. Look, these markets have done exceptionally well, Korea, Taiwan. and obviously portfolios are skewed towards tech, etc. So ahead of these IPOs and the fundraising by Max 7, I think there is some bit of an sitting back and evaluating that, look, when do we get the ROI on these almost near $1 trillion of AI investments in the coming year? So those questions market is kind of asking here. And as the AI trade takes a breather, I think India becomes a natural beneficiary. And that's where you're seeing some bit of a strength in the market. Oil, despite the ongoing Middle East conflict, is sub 95. So that's positive. What RBI has done on the rupee front in terms of accretion of reserves is positive. So that's positive. I think longer term, those issues remain basically, which is the competitiveness of the economy because AI is for real. The job creation. We used to, FI used to come to India because of demographic dividend. But in absence of job creation, does that dividend become a liability? So I think those are questions which are being asked.
Okay.
Sorry. So are you saying, two parts. Are you saying, well, this is the entire AI frenzy is going to take a bit of a stop here, Rahul? Because, I mean, the consensus here is that that is what is required for people to look at other parts, which other markets like India, etc. Is that what you're saying? That we're at that point?
I think again with the strong rally which we had in the AI trade over the last 6 months, it's highly likely that takes a breather. And even in markets like China, also if you see some of the leading Chinese internet names, some of the leading ASEAN consumer internet names are down 30-40% YTD. So the AI trades has sucked oxygen out of other sectors in markets like China and ASEAN also. So I think as these AI enablers kind of take a breather, the other parts of the market get alive. And again, India is going to benefit from that. The longer term structural questions, which I talked about before, I think they remain. So they are yet to be answered. Yeah.
So, Rahul, you think India can outperform from here on? The rupee is showing signs of stability, that AI trade seems to be unwinding and crude oil prices are well behaved. Would that be fair to conclude too?
I think next couple of months definitely from
Okay.
an index level also outperformance. But look, as kind of you also mentioned before, what
Yeah.
we're seeing is a lot of action happen beneath the index in the small mid caps. Like in our portfolios, we own a lot of mid cap manufacturing names out of India. We own a lot of hospitals or healthcare names. So those are spaces which are doing well. So the way we look at this decade is it's going to be pretty much similar like 90s.
Yeah.
You have conglomerates which gave way to the private banks and the IT services companies. You'll have new businesses which will emerge, and the index will change in the coming decade, basically.
Okay. All right. Got that. You want to name a few stocks, Rahul, for us? What do you have in your portfolio? Do you disclosures?
Yeah, no, I think some of these names which are there in our fact sheets are names like Sanjera Engineering, it's an auto
Answer.
ancillary company. Hospital name like Narayan Haridwale. We've been anchor investors since my very days in 2015 in that name.
Okay.
By the
Got
way,
it.
there is Nigel, there is a flash at the bottom of the screen. And this is, that AI trade that we're talking about, right? I mean, in India, one of the ways, there's not very much in the listed universe, but there are, as Rahul put it, enablers. Meta is just put out an announcement that they're tying up. They've entered into an agreement with Reliance to lease their AI-enabled data centers in India. And there are, by the way, a couple of other companies which have been mentioned, including CleanMax, which is, of course, which is a CNI company, which is, much of this, of course, is hopefully going to be powered by renewable power. And that's why there are these kind of companies which come in. Just a quick word, Rahul, on this in India. So while we talk about India will do well when this frenzy cools off, but it's a real thing. The build out is a real thing, right? We've got about 1.5 gigawatts of data center capacity in India. Most of it is non-AI. And some 8-9 gigawatts is already funded, which will come up over the next many years. Any opportunities there?
Yeah. No, I think there are capital plays which are supplying to the data centers, which are part of the data center ecosystem chain, and those names would benefit basically. So, yeah.
Okay. All right. Prashant, coming back to you then, what do you make of all this volatility we have seen, on a day-to-day basis? All asset classes selling off, whether it's gold, Bitcoin, US equity markets, we all fall down together. What is it? Is it that people are raising money for, the SpaceX IPO, or what was it? What would you attribute it to? Routine profit taking,
Yeah,
or do you think it's more of making space for a large issue?
I think at least for the large allocators, they have to make space for the large issues. But yes, there has been, uh, AI has been sucking oxygen out of the markets, and everybody is kind of preparing for these IPOs and kind of selling down the existing positions to make room for that. Once this capex and fundraise phase is over, I think the light has to shine on all these AI companies. So uh, they will have to go to their investors and to the sell side and promise a certain top line and certain incremental margins, and they will have to deliver to sustain these valuations. So I think the picture till now was that all these companies were private and the light was only on the public companies. Now these companies come into limelight, and I think this will have opportunities both in the non-AI side of the market. India will definitely benefit from that. If you think what's happened over the last 2 to 3 years, we had companies in Taiwan that were only growing at 10% top line, started doing like 50, 60% top line growth. And that was all AI driven. While India, companies are still doing high teens growth, but there was no AI kicker. But if people start questioning the sustainability of AI growth going forward, I think people will return to the Indian market, at least for the high teen growers segment.
Were they to return to the Indian markets, and were the AI trade to, come undone at some point in time, do you think they will return to the traditional IT players, or will there be newer players? Because you've been underweight IT for a while.
Yeah. So, I mean, we've been underweight IT because we think AI is real. And even though companies like Infosys, can at least grow the AI part of the book, we have concerns on the legacy part of the business. And I think if someone like Infosys can show better top line growth, yes, those stocks will rebound as well. But I think the next 12 to 18 months, we'll get the picture clear in terms of whether these Indian IT services companies can become a part of the AI story and show better top line growth.
Sure about the...
Rahul, just one quick point, and I just go back to, markets will go up and down a little bit and there'll be movement of capital here and there. But generally, Rahul, there has been, and I go back to some of the points which Akash made yesterday. Much of it, of course, is not new, but he kind of said, his feedback is lots of investors, when he goes to market, say, well, why does India get such a big premium compared to EMs, et cetera, et cetera. So more kind of fundamental, basic kind of questions. Is that something that comes up as well in your conversations, Rahul, at all? I mean, beyond the here and now, what happens to AI, not AI, but I mean, just generally, fundamentally.
No, absolutely. So this is coming back to the point which I said. See, demographics or good, favorable demographics were a dividend. But if you're not able to kind of generate employment for them, if you're not able to recruit new consumers, then again, the key question is why should India trade at a premium to rest of the region where growth rates are improving from what you saw the decade before? And I think the other question which is going to be asked is, again, when you look at the global competitiveness of the companies, compare them to the Chinese companies. Those companies have achieved scale. They are globally competitive on the technology front, and then they are trading at a fraction of a valuation, and there the ROEs are reflecting and improving. So I think those questions are being asked. So I think which is where I think leave aside the temporary bounce from an index perspective, some of these structural issues need to be addressed for a sustained rally to happen.
Absolutely, and I think those are questions which we must not forget and keep discussing even as things start to improve at the margin here. Because those are longer term, more structural underpinnings which have supported market performance here for a long time. Thanks very much, Rahul, for joining us. Thank you, Prashant, for being here. Good conversation with both of you today. We'll take a quick commercial break here. Let me just quickly run you through the interactions which you will see coming up over the course of the next 2.5 hours. So NRB Bearings will be with us on their F527 outlook in the road ahead. So that's coming up shortly. 9 o'clock, we have Sovilo Investment Managers' Sandeep Agarwal to put the spotlight in the IT services space. What's happening, because a lot is 9:20. Shreyas Devalkar of Axis Mutual Fund talks markets with us. 9:30, we have the Indian Hotels Management talking to us on their F527 outlook and more. We have a discussion, by the way, on from the management of Apar Industries. That's a management you rarely see up on television. 9:50, we bring you a discussion around the aviation space, and that's an interesting one. So you've got a large global plane manufacturer and, of course, a regional airline operator in India. And towards the end of the show, Lata speaks with Santanu Sengupta, Chief Economist at Goldman Sachs, on RBI's new schemes to ensure dollar inflows.
Break. We've got a lot of stock-specific action track for you. We get to that in just a bit in our special top 10 segment. For the time being, I'll run you through the list. Afcons, Quality Power, Dixon, Ajanta, Emcure, Reliance Industries and CleanMax. All of them will be reacting to positive news flow, while you have Interglobe Aviation and Bluestone Jewelry that will be reacting to negative news flow. And we expect a mixed reaction coming in on crude sensitives. Stay with us.
एक सेकंड, हीरा खरीदते वक्त जब आप सर्टिफिकेशन मांगते हैं,
क्या ये डायमंड सर्टिफाइड है?
तो जवाब मिलता है
ऑफ कोर्स मैम, सालों पुरानी कंपनी है हमारी, हम सेल्फ सर्टिफाई करते हैं।
मतलब प्लेयर भी यही और अंपायर भी यही।
ये IGI सर्टिफाइड नहीं है।
नो मैम।
तो बोलो
नो थैंक्स, ये नहीं चाहिए।
जब डायमंड खरीदे पूछो IGI सर्टिफाइड है क्या? IGI डायमंड सर्टिफिकेट,
हीरे की असली पहचान।
Time, even as it seems to pause, it slips, it passes. Some ideas, however, are ahead of time. So we built a world where everything arrives as foreseen, as if an invisible intelligence is at play, ahead of what's ahead. Newgen, orchestrating intelligent enterprises.
Look, this famous guy is giving me investment tips.
Sure, it's only for you.
Oh. Pay attention.
Welcome back. You're watching us here on Bazaar Morning Call. The Gift Nifty is still indicating a softish start, but could things change? And a large part of that depends on the stocks that we are going to discuss right now. One of them, obviously, is Reliance. So our team is here with the CNBC TV 18 top stocks of the day. And let's go across to Sudarshan. Sudarshan, do we now finally have an AI play in India? And if that's Reliance, with the sheer weight that it has on the index, could that move things around?
So you're right. Just a few minutes ago, there's an announcement from Meta that it has signed or it has entered into an agreement with Reliance Industries and also two other clean energy providers. So what does Meta say? It says that it has entered an agreement with Reliance for data center, and as part of the agreement, will lease its first AI-enabled data center in India. And apart from Reliance Industries, it has separately partnering with two clean energy providers, and those are CleanMax and Fourth Partner Energy. So talk about the agreement in details. First, Reliance will build a data center, and and that capacity would be 168 megawatt. And also there will be an option to scale, and Meta will lease that capacity. With CleanMax, Meta is partnered for 837 megawatt of solar and wind projects in Rajasthan and Karnataka. So we have to keep an eye on both Reliance Industry as well as CleanMax. So what does Mark Zuckerberg say? He says that Jamnagar facility will help the company scale its AI infrastructure globally. Even Mukesh Ambani has commented and saying that partnership with Meta marks a transformative moment for India's digital infrastructure. And at Reliance, companies committed to building world-class digital infrastructure. And it's not just for India, but for the world. So I'm going with green for both Reliance and CleanMax.
Okay, all right, Sudarshan, thanks a lot for that. I think that's the much-needed boost that the bulls will require, because in the last 1 month, Reliance Industries is down 7 to around 8%. That big boy gets its act together. That gives the much-needed boost. And CleanMax, remember, the day it listed, the stock, in fact, was down more than 10% because that was at the start of the US-Iran war as well. From there, I think the stock is close to have doubled. It went down to around 700 rupees, and from there, it's pulled back up. So interesting times out there. Talking about CleanMax, that's the other one. Well, let's go across to Vinny. She's here to tell us some more stocks that are in the news. Vinny?
Hi, first up, we'll talk about Interglobe Aviation. Now, the ETF prices for domestic airlines have risen by around 10%. But do not forget, last week we had OMCs that had rolled out that price stabilization scheme that will allow carriers to lock in fuel rates for up to 3 years. Now, obviously, airlines who are opting for the scheme would have to pay a fixed ATF price of 115 rupees per litre. So we maybe could see some bit of a red and then a recovery in Indigo, given that crude prices today have come off significantly from the highs that we've seen in the recent times. So that maybe could, lift the stock as well. Apart from that, we'll keep an eye on Quality Power. They are to acquire 100% in Win-Win Specialty Insulators, which is for a price of around 315 crore rupees. This acquisition is mainly for high-voltage ceramic insulators, which they're manufacturing of up to around 1200 kilowatts. So that is a high voltage side as well. And plus the brand of the company for Win-Win Insulators also comes into now Quality Power. So green expected here. And lastly, Dixon Technology, they've signed a JV. They've entered into a JV with Gemtech Technology. This JV, 60% is Dixon, 40% is Gemtech. They'll be looking to manufacture some optical transceivers as well as telecom products. And mainly this is to focus on AI, cloud, hyperscale, data center, all of these. And that is why Dixon could see some bit of a green here.
All right, Vinny, thanks very much for that. So a bunch of names to keep on the radar. Afcons is the next one that we want to highlight. Vivek is here with details. Vivek, take it away.
Well, Afcons Infra, after a while, has got a very large order win. Now, this particular order is at the Wadwan port, and the company has won an order to go ahead and construct 10.14 kilometer long breakwater project, and this is the Wadwan port, like I mentioned. The total size of this particular project, or the total order size, is over 5,300 crore. Now, remember, this is significant given the fact that at the end of FY26, the company's order book stood at around 32,496 crore. So, a large order win. Expect some green on Afcons Infra today.
All right. Thanks a lot for that, Vivek. Hormaz, you have a bunch of other stocks as well. Block deal details coming in from Ajanta Pharma, Emcure Pharma, even Bluestone.
Plenty of block deals took place in yesterday's trading session, and Ajanta Pharma started off that spree with the promoter entity was one of the sellers in that transaction, and it was lapped up by entities like Kotak Mahindra Mutual Fund and Nippon as well. Kotak Mahindra Mutual Fund was both of them previously owned stake in the company as well, so they have increased their stake through this block deal. So expect some green here on Ajanta Pharma. Now for Emcure Pharma, BC Investments was the seller here. 36 lakh shares were sold, and that entire stake was purchased by Kotak Mahindra Mutual Fund. They do not have any prior stake in Emcure Pharma, so there's a fresh investment here that they have made. So as per the shareholding pattern at least, so you are expecting some green here as well. But for Bluestone Jewelry, there were multiple entities that were sellers in the transaction. SL was one of the sellers as well, and IV was also one of the sellers in that transaction that took place yesterday. But in comparison to the number of shares that were sold, Nippon India Mutual Fund was the only buyer in that transaction, and it has only purchased a fraction of the number of shares that were sold. So the supply was not fully absorbed, and as a result of which the stock was lower, expecting a downtick here in today's session. So going with red for Bluestone, but for green for the other two names.
All right, thanks very much, Hormuz, for that. Well, that is stocks, right? Let's talk about crude sensitives, which should be in focus. And Manisha joins in for that. Manisha, take it away.
Well, thank you so much for that. Well, overnight it was a 5% of a decline that we saw in case of the crude oil prices, moving far away from that $100 a barrel mark. But in the Asian markets right now, we did see some support come in. $92 is back. Overnight, we did slip below $90 a barrel as well at one point in time. With Iran downing an American helicopter and U.S. launching new defensive strikes against Iran, seems to be adding premium to prices. But the statement coming in that that U.S. is done with that defensive strike, markets do believe that we perhaps are yet again headed towards some conversation between Israel, Iran, and U.S. therein. That is what the street will watch out for. In the meanwhile, you also have the U.S. crude inventories, which have declined by 9 million barrels to a 4-month lows right now. The only reason that the crude prices hang in a bit of a balance and we haven't seen prices surges because the Chinese demand for the month of April and May has seen a decline. For the month of April, we actually have seen the Chinese imports decline to an 8-year low, is what really seems to be keeping the crude oil prices in check at this point in time.
All right, Manisha, thanks a lot for that. So those are a bunch of stocks and crude-related plays that we will be tracking in today's trading session. In case you missed all the stocks that our team is tracking for you, let's get you a quick recap. Stocks with positive news flow. We have Afcons Infra, Quality Power, Dixon Tech, Ajanta Pharma, Emcure Pharma, Reliance Industries and CleanMax. While stocks with negative news flow, we have Interglobe Aviation and Bluestone Jewelry. A mixed view on crude sensitives. Take a short break. On the other side, we have the management of NRB Bearings joining us to discuss their FY27 outlook and the road ahead.
Welcome back. As promised, let's get chatting with the management of NRB Bearing. Remember, the stock has been buzzing off late. Just sort of detail what's going on in the company, what's the way ahead, and what's the longer-term aspiration. We're joined by Ms. Zaveri, the VC and MD at NRB Bearings, who joins us on the show. Well, Ms. Zaveri, thanks a lot for joining in. I believe you're in Europe, so thanks a lot for staying up for us here on CNBC TV 18. Well, just to run our viewers through the 3 broad points we're going to be talking about, there was some promoter stake sale. The next part is they have an ambitious 2031 outlook. And are there any supply chain disruptions? Well, Ms. Zaveri, let's start off with point number 1. There's a promoter entity, Tirokchan Singh Saine Trust, which had around 7% stake. Now, part of that stake was sold to a foreign investor. Just wanted clarity on this. Out of that 7%, all of it is lapped up? Or is there some pending with regard to this promoter that sold, I think, 4.5% stake?
So I think there's a little bit of misunderstanding on that part. You're talking about our trust, which is one of the promoters.
Yes.
The entire promoter stake, even what I personally own, is over 40%. And along with the other close associates and close family members, it's 3-4% higher than that.
Okay, right. But this particular entity has been categorized, madam, as as a promoter. So we just wanted to know, whether or not this particular entity, this trust, is the selling is done, or is there more in store? We note the point that the foreign investor has come in there, they have lapped up shares, the street seems to be excited. But is there anything more out of the 7% that has to be sold?
So what happened is a very high caliber foreign fund reached out to us in FII. And this is exactly the kind of funds that have been interested in NRB and mid holding for 10 years and 15 years and even longer in some cases. So we felt that this would be a great win-win. As you know, I had a borrowing that I wanted to retire, and we're done with the loan. Of course, small stake sales of very nominal amount happen on and off just because a particular FII or a mutual fund wants to come in specifically along with the promoter. But yes, we are done, and we have a very comfortable situation on this.
Got it. Ms. Zaveri, let's talk about business then. What is the revenue growth aspiration you have for FY27? Last few years have been, the industry itself has been into a bit of a flux. But you are guiding for better times ahead. So I think exports as a percentage of your mix is around 30%. What kind of growth you're expecting on exports? What kind of growth you're expecting on domestic numbers? And for the company on the whole, what's the growth number?
So I would like to take you to a slightly longer term outlook. Of course, NRB has been outperforming the market in terms of its profitability and its growth as well, because fundamentally some of our competitors, you need to look a little more carefully, are not necessarily bearing companies. They're actually automotive aggregate suppliers. Some of them are bearing companies. And you've seen that not only our growth, but even the growth of our EBITDA margin has been significantly steadier and higher than the rest. This is because of our long-term strategy. And our strategy is, first of all, to focus on NRB's key differentiators. We're the only Indian-owned company that has R&D capabilities. We launch new global platforms, whether they're ICE, whether they are hybrid, and whether they are pure EV. The second pillar on which our strategy lies is to focus on EV agnostic business. That means we supply tier ones globally and also in India. And these tier ones are coming up with a chassis or a steering column or a transmission that will not change.
We get that point. We get that point, and which is why you've given us an ambitious target as well. From close to 1350 crores in FY26, you are targeting about 2500 crores in revenue by FY31, which implies doubling of your current business. Could you give us, a sense of what the revenue mix of the company would look like in FY31? How much of that would come from exports? How much of that would come from domestic? How much of that would come from EVs? How much of that would come from agnostic businesses?
Sure. So our 5-year plan is to double our sales. That is order book in hand. So 2,600 crores is our order book in hand for 2031. It looks like we will cross that comfortably because we are looking at even more joint ventures and even more industrial applications. As you know, we're getting into aerospace. We've already started getting into industrial gearboxes and into the farm equipment industry in a major way, and construction as well. This is along with very strong automotive growth, which is both export-led and India-driven.
Ms. Zaveri, hi, good morning. Just a quick word, Prashant here. What percentage of the products that you supply are you the sole supplier for? I'm just trying to understand what is the stickiness across the product range and competitive intensity, etc. I mean, can you put a number to it?
For
the product category that you, I mean this by product category. I mean, I believe there are lots of products where you are kind of the only supplier for those specific product categories. Is that high? Is competitive intensity rising? Because that used to be a big, used to get talked about as a big moat for a company like you. Is that
correct? So industrial is right now about 11 to 12% of our sales, and it's going to cross 20%. by the end of that period and possibly even 25%.
Okay.
Does that give you an idea?
Fair enough. And maybe we can...
Now, just one more point. Apart from this, the way we penetrate even the auto component and the friction solution space is we don't only make bearings, we make a lot of other components that go along. Secondly, we create new technologies. There's a product called the one-way clutch. There are wheel bearings that we're getting into. Wheel bearings, for example, is a $13 billion market. So even if you skim the surface and focus on the customers that really want more of what you make, you can see what the opportunities are. Similarly, construction equipment, that's another $15 billion. So likewise, we're focusing on similar products, starting from what we make today, but adding a whole range of newer products as well. And as I said, that's what we do best. The second thing is the customers that we serve are very sticky. The testing costs are extremely high. They can't replace you easily. And that is one of the things that drive the margin, the technology behind what we do.
Yeah, no, absolutely. And I think, niche industrial manufacturing is getting all the interest in India as well. We have lots of recent examples, and you're in that space. Two questions. One, I think there was some talk of you starting to supply to defense as well with HAL. Is that an area which will continue? Do you see a large TAM there? And number two is the other emerging big growth area where there is tens of billions of dollars being committed for investment is data centers. Lots of stuff go into data centers. I mean, is there something you're looking at as well?
So it's interesting you mentioned data centers. That is exactly the strategy we worked on last week. Yes, we're definitely going to enter that space.
Okay. In what way, Ms. Zaveri? And you said
just
last
a moment,
week.
You asked me an earlier question. Can you repeat the first question? Because data centers was the second one.
I will. Can I just finish the data center loop and then I'll come back to my first point? You said you decided to enter data center as a segment last week. This is new strategy.
No, I said we created the coherent strategy for it last week. We have, of course, been looking at this in our entire space. We are already in companies that are hugely expanding into data centers, and we supply them other kinds of parts because those are large groups as well.
Yeah.
And this is one of the discussions going on. And for sure, this is a product group that will increasingly become important to us as time goes on. But, I would like to highlight 2 points. No one customer, NRB, is more than 10% of our sales. And no one segment contributes more than 30%.
Yeah.
So we are a very wide range company. Sorry
to interrupt, ma'am. Just a quick thing. What is the strategy? Could you just lay it out for us? Because you're already supplying. And in which product segment are you looking at too? Because there's lots of stuff. Data center as a entity is like the finish line, right? But there is so much which goes into it. So which product category is NRB going to focus on? What's the strategy here?
So there are bearings there.
I see. So straight up.
What
but those are
applications.
Yeah.
So it would be our core business. It's not diversification. It's just diversification of segment and a huge opportunity.
Right. What we're trying to understand is the total addressable market here. What proportion of the data center value chain is bearings?
So as I said, we'd like to unveil this across in a very well-structured manner. But your question was, are we looking at this? Are we going to enter this segment? Yes, we are.
Okay, very quickly, aerospace and defense, you're saying is a big focus area, right? Industrials, you've already told us from 11-12%, it close to doubles. Aerospace and defense as a percentage of that ambitious target of 2,600 crores will be how much? Roughly how much?
So again, it's hard for me to put a percentage on it for the simple reason that if something else does better, right, then the percentage in the pie gets impacted. And that's why I was explaining to you how diversified our strategy is. But we did a recent acquisition, as you know, for the defense and aerospace business. When we got into that acquisition, they had an order book of 25 crores. It's not very long back. And our order book is already crossing 70 crores just in this very short period of time. So the pace of incremental growth is large. Even if we're talking about 300 crores within the next 4 or 5 years, look at the margins. In our case, the margins are significantly higher because we enter bearings where there are very, very few players. And these are very critical applications as well.
Got it, Ms.
Zaveri, we'll leave it there. Thank you very much for joining us. It's glad you could join. And next time, we'll do a longer one because there is so much that you're doing. Stocks at an all-time high. Interest, of course, in the company. And as I said, niche manufacturing doing very well. Thank you for staying up. Thank you for actually waking up earlier. I guess it's early morning, where you are. Thank you for being here. Appreciate it. We'll take a quick commercial break here. We come back. Devin Choksi of DR Choksi FinServ with us on the other side.
Welcome back. You're watching us here on Bazaar Morning Call. A bunch of stocks that were moving around in yesterday's trading session. Let's go across to Hormaz, who joins in as always with stocks which had a lot of volume and delivery-backed data.
Morning, Manglam, and of course the big sectoral performance yesterday came from the PSU banks. Every single PSU bank did very well in yesterday's trading session. You look at Bank of Baroda, Bank of Maharashtra, Bank of India, all of them saw healthy gains. Look at the volumes as well. For Bank of Baroda, well, we've had volumes that have been around about 2.5 crore, biggest single day gain in over 2 months for Bank of Baroda, over 3 crore shares that were traded. The volumes as well for delivery were well above its 20-day average as well. Although the stock is still below its 52-week high, but there was still some delivery buying that was seen in Bank of Baroda. Stock that did well in yesterday's trading session, apart from what other stocks that were outperforming, was Ola Electric, and out of the last 15 odd trading sessions, the stock has gained in 10 of them. And even in yesterday's trading session, the volumes were the highest in the last 2 months. Was a significant amount of volumes that were seen, and the volumes yesterday were well above its 20-day average as well. So close to 50 crore shares were traded. The 20-day average was around 15 crore shares, and even for delivery, 7 crore shares were there. The 20-day average here is only 3 crore shares. So 2x, it's 2.5x its 20-day average as well. And from its 52-week low, or its all-time low, which is around 22 rupees, the stock has more than doubled in value, has Ola Electric. Some of the other movers that did very well in yesterday's trading session, of course, the advanced decline was mostly skewed towards the gainers. Panacea Biotech was one such name. The 6th straight day of gains for the stock. The volumes yesterday were the highest since December of 2025. And even if you take a look at the volumes in yesterday's trading session, more than 7 crore shares were traded on Panacea Biotech, significantly above its 20, as all 1.7 crore shares, I beg your pardon. Where, the volumes on the 20-day side is only 8.5 lakh shares, and 8 lakh shares were marked for deliveries, and the 20-day average here is only 1.7 lakh shares. In fact, at the day's high yesterday, Panacea Biotech was up over 60% in this 6-day winning streak, but still the stock is well over about 50% during the 6-day period.
Got it. Okay, all right. Thanks a lot, Harmas, for joining in and giving us all of those details. Well, let's welcome Devin Choksi, MD, DR Choksi Finserv, who joins us on the show. Hi, Devin. Good morning. Good to see you. Well, the big news coming in is with regard to Reliance and looking at the data center opportunity, and CleanMax as well has been roped in to do part of the work. What do you make of Reliance Industries at around this 1,280 rupee odd mark? And CleanMax as well, that stock is up, I think, close to 80-90% from the post-listing lows. That was in March itself. Your view on both these names?
Yes, Nigel, good morning. Well, I think sometimes you have fantastically good businesses available at a throwaway price in the market, and that's the case with Reliance today. The way in which I think this company is building one after another values in form of different verticals, I believe that I think this is an opportunity for those investors, I think, who want to patiently accumulate the stock for long-term investment. Data center definitely is a part of the entire game plan that this company is executing in the area of Reliance Intelligence, wherein probably, I think, not only the data center alone, but the entire AI ecosystem and the framework pertaining to that, including, I think, the areas related to the ancillary businesses, I think all are being taken care of by the company. So in my viewpoint, I think they are end-to-end value creators as far as I think the business is concerned, and data center is going to be part of that. Definitely like to see this kind of businesses added into the portfolio, particularly when, because of the other reasons in the marketplace, the stock price is available at an attractive valuation. So it becomes attractive opportunity in my viewpoint.
All right, an attractive opportunity. What about CleanMax? Do you have a view on that one, Devin?
Not really, Mangalam. I haven't looked at it, so would stay away from it for at least time being.
All right, just a question on all the PSU banks. You know, all and sundry are fairly positive on the financial space. Now with the RBI's moves coming in and, you know, they're reducing the cost of overseas borrowing, do you think PSU banks stand to benefit from that? If yes, yesterday we saw a big move. Are there any particular ones that you like?
So both State Bank of India, Bank of Baroda, kind of large franchises, they definitely remain favorably placed as far as I think the large size PSU banks are concerned. State Bank is around close to 40 lakh crore loan book size, and Bank of Baroda could be somewhere around 11 to 12 lakh crore worth of loan book size. I think they are some of the large franchises, and they are fortunately available at a valuation which is far more attractive. In fact, I think on a core business valuation, both these banks are available at less than 1 time price to book value. State Bank of India, of course, when you add some of the part values of the different businesses, including the life and now the AMC business, which is going for the IPO, I believe that the stocks available at a valuation which is far more attractive, and whatever the interest rate related negative news, I think, which were there, have been fully discounted in the price. So in my viewpoint, again, it's a buy opportunity for a good quality stock.
Okay, a buy opportunity coming through, according to Devin there. Devin, the other part which has done phenomenally well, and I think, you know, with this Meta deal, as you were discussing, the comment on Reliance, it's going to sort of, you know, again, focus the market's attention on anything to do with this data center build out in India. We were talking about this earlier. Anything else you like in that space? There's this Power which has done very well. And there are a bunch of names there, both on the transformer side. There's renewable power. There's just basic IPPs, etc. And of course, there are companies like Anantraj and a few others, right, which have done well. There's this Black Box, but Black Box I think is largely focused in the US, building out data centers in the US. But that's again done very, very well. Any other names, specific single stocks on your list there?
So I think overall, we are very comfortable with the entire value chain that we are talking about. On one side, the renewable power segment, which is the main important factor behind the success of the data center, and the pricing, I think, coming out from the data center itself. So that is one area where we like the renewable power segment, and along with that, the energy storage facilities that some of the companies are coming up with. That remains formidable. Then ancillary businesses within the power sector, some of the equipment manufacturers, likes of Siemens Energy, likes of Hitachi Energy, I think those kind of companies, they remain absolutely very clear with the kind of the size, order book size that they are having for execution, along with, I think, the growth that they are projecting. We also find value proposition in the power finance companies where probably the stocks are available at practically one-time price to book with a large amount of growth execution available into them. So they are also equally interestingly positioned. The transmission and distribution segment, couple of companies, of course, they are slightly expensive as far as Adani Energy Solution is concerned. But the power grid remains, I think, relatively more comfortable also at this point of time. So yes, I think there are a host of stocks within the power and power ancillary sector, which ultimately gives, I think, the backend support to the data center. We like it. Even the cable companies, which are typically looking into the data centers, even the companies which are providing the cooling solutions into the data centers, they are all among those. Yes, I think selectively those companies are there in the list as far as I think our portfolios are concerned.
Okay, Devin, we'll take a quick commercial break here. We're going to come back in just a bit, and the pre-open will be with you. We'll also have Sandeep Agarwal of Sovilo Investment Managers with us to put the spotlight on the IT services space. Stay tuned.
Welcome back. Well, we are almost getting to market opening, so a good time then to invite our technical experts. We have Mitesh Thakkar, who joins us, as well as Sudarshan Sukhani. Good morning, gentlemen. We had a fairly interesting trading session yesterday, and the bulls would take heart from that. Sudarshan, you go first. What's the trade today? The GIFT 50 suggesting we pull back 70, 80 points.
Yeah, good morning. See, the pullback is a buying opportunity. Now, Nigel, you also understand the markets well. It doesn't mean I guarantee that the markets will go up. It just means that at current levels, with a strong support going in, and with all the, all the world news is adverse and the world markets not reacting as such. So this is a good time to buy. If it doesn't work out, it doesn't work out. The stop loss is by using call options. You have limited risk on the downside, and a decent upside if something goes right.
All right, decent upside if something goes right, and the call option is the price of the option is your stop loss, as you had pointed out earlier as well. Mitesh, what do you make of yesterday's move, and how does that culminate into the very near future for the Nifty?
Good morning, Mangalam. I think I partly agree with Sudarshan that the pullback will be buying opportunity, but for me, I think the buying will be selective, and the area which I would look to buy into would be Bank Nifty, financial, and the banking names. I think very clearly the Bank Nifty is outperforming, as well as given the fact that the decline which happened a few days back, the Nifty did test and break the 23,150 support, while the Bank Nifty's corresponding level was 52,900, 53,000, which was never tested. Therefore, very clearly that is the index to focus on. So buying, yes, but on the banking and financial names, the rest of the market I'll take with more of a stock specific bias.
And let's talk about stocks then, Mitesh. What's on the list?
Good morning, Prashant. So I have two banking names. Bank of Baroda is a buy with the stop at 268 for targets of 285. Canara Bank is a buy. Keep a stop below 134.5. Look for targets of 144. A sell on Indus Tower with a stop at 426 for targets of 405. And also a sell on NTPC. Keep a stop about 361. Look for a target close to 343.
Okay, all right. So PSU Bank's looking strong, and so some trades coming through there. Sudarshan, what about you? What are your picks?
Yes, well, I'm also in banks, although it's ICICI Bank. So ICICI Bank is a buy with a stop under 1250. Indian Hotels is a buy. It's also a positional buy with a stop under 650 and a disclosure that I own derivatives in it. Supreme Industries is a sell with a stop above 3560, and Infi is a sell with a stop above 1205. It's a mixed market, but for the Nifty, my view, as I told you, was that we should be long.
All right. Thanks very much, Sudarshan and Mitesh, for that. Well, we'll sort of come back with more rates, more trades. The rupee is, by the way, open 95.54 compared to 95.35. So it's about a 20 paisa weaker currency this morning, as opposed to where we left off yesterday. Let's turn our attention to IT services for a bit. So yesterday, TCS's 31st annual general meeting took place, and the chairman, N. Chandrasekaran, laid out the company's trajectory on what they're doing with AI development. AI agents was a big focus area. So just want to play out some sound bites before we get into a discussion.
Managing and overseeing AI within organizations. AI agents don't stay where they are. They learn, act, drift of course, and can even deteriorate. Getting them set up within an enterprise, training them on specific context, monitoring performance, governance compliance, and managing cost at scale will be a big challenge and a big opportunity for established companies like TCS to work with their clients. In fact, I would like to say that if maintaining the applications, what is called as the ADM, was the defining annuity of the last era, governing intelligence will be the defining annuity of the next decade. TCS is investing, building, and maturing the solution framework. It is showing in the pipeline. If you look at the TCS's AI revenues, it has been growing consistently over the last 4 quarters. The last quarter, the AI revenues on an annualized basis was close to $2.5 billion. The day is not very far when TCS will have equal number of AI agents or AI workers as they are physical workers.
Okay, well, that is N. Chandra talking at the TCS's AGM. Sandeep Agarwal, fund manager at Sovelo Investment Managers, is with us. Sandeep, what stood out to you as an investor that coming from from TCS? What's your sense? One, of course, I thought, well, here's Chandra himself, in a way, talking. But he's the chairman and he does this, but there's more attention now because of the situation that Indian IT services finds itself in with the face of all this AI onslaught. But what did you make of it, Sandeep?
Yeah, hi, good morning, Prashant. Thanks for having me in the show. So, I 100% believe what Chandra has said, and not because, he's the chairman and I have to go by what he's saying. As a past analyst and now fund manager, I may have different view, but still I say I will say that I 100% agree with what he's saying. See, this value chain is very simple that, it starts with hardware where you have hockey stick growth, which you saw in NVIDIA and AMD and similar others, and then followed by, the providers of providers of those technology like the Microsoft and the Grok and all of them, and they will grow for longer at a better growth rate, and then will come the service provider, which we are there, and that will start now in 1 or 2 quarter time. So I believe that 2-3 years the 0% growth broadly for the large cap which was there, that will change to 6-7% growth, and with that some rupee benefit. So I have done some maths on Excel, and if you see that maths, from here, if the currency doesn't fall below 92.93, it remains above 92.93, then the EPS growth for most of the companies will be between 35-40% to 70% over next 3 years. So even if you keep the multiple same, I think that is the upside which you will get in this stock. They are slightly better than utility stock, and this is an industry which will be lower growth for longer. But that doesn't mean it is a zero growth and completely written off. Remember the efficiency which AI brings. Because of that, the growth has been lowered by 30%. So a 10% growth industry has become 6-7% growth. But 6-7% growth, I don't have doubts, will continue.
All right. What about pockets which may grow faster and which are the direct beneficiaries of the AI trade in India, if at all?
So, Mangalam, it's a very good question. So there are two kinds of beneficiary. One are the direct, IT players. So what has happened because of AI and the urgency of it to be deployed? So whoever has the manpower and resources, they will be first one to, get the business. So because of that, there is a massive democratization between the players. So we saw first leg of democratization due to digital, and now second leg of democratization due to AI is happening. So the small and mid-cap player within the IT services segment will do better. We are still very cautious and are not looking at opportunity in the ER&D space, because I think there is a lot of disruption there to happen, and the stocks have not corrected meaningfully the way services stock have corrected. So that is the first layer of impact. Second, I think all these data center, quasi data center players, the hardware distributors, the line providers, the pipe providers, and also the coolant pipe providers, I would say. So stainless steel companies which makes pipes which can provide pass through the coolants and all, those will be the second type of beneficiary. So I believe there is a lot of benefit which will happen to Indian IT companies, but don't compare our benefits to the likes of the Mag 7 or even the the hardware providers. I believe hardware providers in the last leg, maybe 12, 16, 18 months more, there will be good growth. But then you will see 15, 20 years of lull again there. The way we saw after 2002, it has taken 22 years for another hardware cycle to come. So I am not positive on the hardware players. I am positive on the providers like the Mag 7, and then followed by Indian IT services and ancillary.
All right. You mentioned briefly about stainless steel, the pipe makers, right? If I heard that correct. Which
yeah.
one?
So because
the one that y'all have been investing in for a while, Venus.
We have not invested in our PMS in that.
I think you personally maybe had some investment.
Personally, but I would not recommend only one name or anything. I will say any stainless steel provider, pipe provider will benefit, because there will be a lot of demand. There is a 2 to 3% requirement of the total capex in data center of stainless steel pipe. So any pipe provider will also do well in the long term, because you have to finally keep this GPUs cool and the centers cool. So you will need the coolants to pass through.
Okay, got it. So that could be another ancillary play, that discussion for another time. But this ER&D, that theme was very hot. I recall, 5-6 years ago when we chatted as well, that was very hot. Now, those stocks, some of them are less than half of what they were at the peak. But you're still not interested over there? Valuations are still too expensive and growth not going to keep pace?
So growth will keep pace, Nigel. So the thesis that, they will grow at the double the pace of IT services remains true, but they were at 5 times the multiple also. So multiples, even after correcting 50%, are still away from comfort level. I believe, ER&D companies will still correct 20-30% at least from here before they become a buy case. But IT services, I believe, barring 1 or 2, are all ripe for, giving good return. As I gave you the example, EPS growth of 45 to 70% in next 3 years minimum you will get in this companies. Now, based on that, even if multiples remain same, you will make that kind of return. That is what my thesis is.
So maybe
and we are heavily invested in IT services right now.
40 to 50% returns could be probable in IT services names in the next 3 years. Would that be your call?
Yes, minimum that much I'm expecting.
And what would you go for, the traditional big names, the Nifty IT stocks? Or would you go for the Persistence, Coforge, those stocks which are actually growing at a faster pace between the two?
No, we will have a mix of portfolio. We will have some of the large caps because we like 6-7% growth, and as I said, EPS growth still will be 40%. So I will go for them also, and I will mix them with the smaller IT services company which are trading at 8, 9, 10 times with 30-40% cash balance. I don't see any risk in them. Return may come after 6 months, but that is where we have to take the risk and we have to have patience to make return. So we will stay with that.
All right, I wonder whether you have a view on Reliance or not, but before that, we'll go across to our colleague Rachna, and then we'll ask you about your view as well. Reliance Industries and Meta Platforms have announced a significant expansion of their strategic partnership with an agreement for an AI-enabled data center in India. Rachna, take it away.
Well, Meta and Reliance Industries have announced an agreement to build an AI-enabled data center in Jamnagar, Gujarat. Now, the facility will have a capacity of 168 megawatts in its first phase with options to scale. Reliance will construct it, Meta leases it, runs entirely on renewable energy and will cool these data centers using desalinated water. Now, any conversation around data center has been about the water it utilizes as well. So, an important one to note that it would be desalinated water, and Meta will cover the full cost of energy and water supporting. Now, the facility in Jamnagar, where Reliance is already developing one of the largest data center campuses in the world, paired with Meta's project Waterworth, the longest subsea cable system ever laid, this puts significant compute capacity on Indian soil, connected directly to the global internet backbone, potentially for now. For Meta's India users, and there are over 1 billion of them or us across WhatsApp, Instagram and Facebook, this could mean AI being served from local infrastructure. So lower latency, faster performance. For Reliance, though, it is the next step in a partnership that has moved through each layer of the digital stack. It's the third time around they're partnering. The first was the $5.7 investment in Jio in 2020, then the Llama AI joint venture, and now it's physical infrastructure. On clean energy, Meta has contracted nearly 1 gigawatt of new solar and wind capacity across 5 states, 837 megawatts with CleanMax and 88 with Fourth Partner Energy. All in all, this partnership could indicate that India is moving from spectator to stakeholder in this global AI race.
All right, thanks very much, Rachna, for that. By the way, CleanMax is up 10% as we speak. Reliance, of course, is opening up higher as well, 9%, 10%. Yeah, there you go. 1350 dropped off a little bit from the highs, and Reliance, of course, is up about 0.5% as well. Sandeep, any thoughts on this, the development?
No, so it is a must needed, as we know that land and water and coolant, these 3 things will be required for the data centers. We would have been more happy, if Reliance and Bharti, who control the customers, they could have run some AI deal which would have have higher proportion for India. But unfortunately, because of the hurry to have some AI ahead of others, we have to go with it. But broadly, these are the ancillary benefit and not the main benefit which should have happened.
All right. Thank you very much, Sandeep, for that. There's 4 minutes to go for market open, and we will sort of come back with more stocks in a bit. But the 9-10 call, Sudarshan and Mitesh are with us. Sudarshan, what do you have?
It's ICICI Bank, buy with a stop under 1250.
Okay, and Mitesh, what about you?
I'll go with the banking name as well. Bank of Baroda is a buy for targets of around 285.
Okay, just a quick recap of everything we put out since the morning in terms of individual names. Afcons, Quality Power, Dixon, there's Ajanta Pharma, Emcure, Reliance Industries and CleanMax, Interglobe Aviation, Bluestone Jewelry, and of course, we've got some crude sensitives out there as well. So that's the overall picture, overall pack that we have on your screens right now. I think there is 3 minutes to go as far as market open is concerned. And let's just look at Asia for a quick bit before we move any further. 8-point change, so it's not a, I mean, it's neither here nor there. And we are just, we'll pick up on that in a bit. Hang Seng is down 0.6 and Taiwan is down about 1.25% or so. As well, I think Kospi was down 2, but I think it remains a little lower. This entire high momentum AI bunch is lower, as we saw with Nasdaq as well. But brokerage calls of the day with Sudarshan. Sudarshan, take it away.
So HSBC has initiated coverage on Max Finance after the life insurance data for the month of May has come out, and it has initiated coverage with a buy call target here is 2,120 rupees per share. It says sustained operating performance and progress on potential merger for the company will be key catalyst, and also sector valuations have de-rated over the years due to regulatory headwinds amongst all the names in life insurance. It's positive on Max Finance. Next one, Morgan Stanley has it on energy. It maintains overweight call on ONGC and target price here is 345 rupees per share. It says over last 2 decades, company has paid $33 billion dividends, roughly equal to its current market cap. And over next 20 years, expects dividend to be 2 times of historical rate and sees 3% production CAGR and 14% earnings CAGR over FY26 to 29. On Oil India, it has downgraded the stock to underweight from overweight and target price is cut to 404 from 566 rupees per share. It sees 6 to 7% downside risk to street estimates as oil prices normalize after West Asia war. Last one is Jefferies has initiated coverage on Meesho with a buy call and target price is 225 rupees per share. It says company is building a scale-led value commerce platform and forecast 25% NMV CAGR and 3% adjusted EBITDA margin by FY30.
Okay, so those are individual names. Thanks very much, Sud, for that. We've got market open coming up in just a bit, and we will pick it up from there. So the first rates should be on your screens anytime now. So it's a flattish start. The indicative open is, of course, flat. But it's, of course, all been about broader markets, and I guess today will be no different. 0.15 lower. Okay, it's now not even that. Nothing on the Nifty. 23,228, so unchanged. The Nifty Bank is also unchanged. Let's see if they pick a direction. Midcap index is up 0.1, and I think the small cap index is also going to come up with some green. Yeah, some green. 1/3%, 55 points higher to begin the session on the small cap index. But that's the market for you. Already in the green, moving up a little bit, 0.15, 23,270 now as far as the Nifty goes, and about a quarter on the Nifty Bank, 55, 320, 330. Nifty heat map, how are the 50 stocks opening? Right at the word go, and then we will pick it up on individual names. So Reliance is in the green, and that can have a big influence if it starts to move. It's underperformed for a long time. Bajaj Auto, Trent are some of the other winners. On the downside, there's Hindalco, Infosys, Bajaj Finserv, SBI Life, and a few more. But it's more down than up with 55-point up move on the Nifty. Mangalam.
Well, if you look at a couple of these stocks which are doing well with the broader markets, you do have obviously Afcons, which is higher on account of the order win that the company has gotten. But more importantly, the biggest mover today has to be CleanMax. The Meta partnership with CleanMax has the stock fairly excited, up in near double digits for that counter. Then we have some others which are extending their gains from yesterday. Case in point, something like Studs, which was up 20% in yesterday's trading session. Fair amount of volumes backing that counter. That stock opens with a gain of 5%. And Wakefit Innovations is the other one, which is higher and sits with a gain of almost 6%. Importantly, Panacea Bio, which was among the bigger gainers in yesterday's trading session, starts off with some profit booking. So that stock is down about 4%. And we're also seeing some muted moves in a lot of these metal names. So Hinzinc is down about 2.5%. We're seeing some traction on the downside on names like Vedanta, Hindustan Copper, Nalco, etc. So metal stocks not doing particularly well after the big run that we've had over the last few trading sessions. They've come in for some bit of profit taking. But as we speak, Reliance continues to extend its gains, and that's immediately visible on the Nifty, which has actually extended its gain to about 94 points now, closing in on a century on the Nifty, 23,350 thereabouts. And a large part of that, the contribution chart would tell you, is courtesy Reliance, because the Nifty Bank is holding on to gains, but about 0.25%, so not as much as the frontline index. And at an index level, even the mid-cap index actually is flattened out, and that's largely because of the weakness that we're seeing in a couple of these metal names. Nigel.
Well, a few stocks, Mangalam, that deserve special attention. You already pointed out Afcons because of that large trade out there. So that stock, is moving with very, very good volumes. CleanMax has come off a little bit from the top, though the news flow is positive for them. It's still up close to around 6%. I'm keeping an eye on Meesho, because that lock-in period, that actually has opened up. And there are some very, very large trades that have actually taken place on the counter just in the first minute itself. So keep an eye out on that one. Yesterday, in fact, we had a note that came in from Jefferies. They have initiated coverage on Meesho with a target price of 225. But today, the stock is in focus after opening up. We did see large trades, change hands out there. So we'll keep an eye out. If I'm looking at that number correct, it's 8-9 crore shares that have actually changed hands. So Meesho is the stock that's on the radar. Physics Wala as well. I think there's a domestic brokerage house that's come out with coverage on the stock. It's up 2%. Volume's very, very large. Dam Capital, they've come out with a note on Physics Wala, so that stock is holding in the green. IDBI Bank, that stock is moving with high volumes. It's up only 1%. But sources, I think, government sources are telling CNBC TV, and I can see it on our, digital piece, that IDBI Bank sale is back on track. So we'll have to keep an eye out on developments on that front. But that's one of the top buzzers in the initial trade itself. Hindustan Zinc is down. Silver ETFs are down because silver prices have come down drastically. Last check, sub $70 per ounce mark. So Hindustan Zinc was getting bulk of their value from there. That's why, in fact, and there is that fear that the government of India could come in there and possibly take some money off the table. So explains why that one's down 3%, and all the silver ETFs as well down 3 to 4.5%.
All right. Those are individual movers as they come up right now. The Nifty is up 0.4. So this is a good outcome after, all the sideways kind of indicative open that we had before 9 and, of course, in the pre-open session as well. So that's what's coming up. Shreyas Devalkar is with us, Head of Equity at Axis Mutual Fund. Shreyas, good morning. Good to have you with us here. Are you guys also... By the way, it's no investment strategy, but just with the benefit of hindsight, what's worked and what's working is stocks with no FII holding. Not no FI holding, but low FI holding. Let me put it that way. Is that a filter at all? I started with the disclaimer there is no investment strategy, but that's what's working because there's relentless selling. 40,000 crores this month so far from foreigners.
Yes, thank you very much for inviting me on your show. Actually, when it comes to these FII flows, and you're right, partially this observation is right, especially when it comes to the large cap, larger names, where the ownership has been very high. So especially if you take banking, private sector banking, IT sector, and some of those sectors where the ownership has been some of few stocks which are having very high weight in the indices, there the FII ownership has been high and it has impacted. But normally in my observation, it's not the only reason. If you see on a relative basis, the stock performances are always driven by the fundamental merit of that individual stock versus other. But on an absolute basis, you are right that yes, it has impacted the performances of the stock. And that's where one of the reasons why most of this pack is reasonably valued when it comes to its valuation compared to its pre-COVID valuation and now.
Right. One would have thought that, Reliance will be among the top of the pops when it comes to gainers. Turns out that it is actually HUL. And this morning there was a note that came in from JP Morgan. They have an overweight rating, a target price of 25.50. They met the management and there has been some positive commentary coming in from the management. So HUL, while on the contribution list, is about 13 points because of its weight. But if you look at the stock, up around 2.5%, has been a bit of an underperformer. Shreyas, one school of thought also says that the next leg of gains in the consumption space will come from staples and not necessarily discretionary, because one of the underperformance of staples, and secondly, inflation has saturated the discretionary demand, and these large players are likely to do better. Would you concur with that?
Definitely. So it's across. So you brought in multiple angles. One is the underperformance, the low base effect, and third is the inflation. So if we just try to bifurcate into this, and to start with the inflation part of it, I think inflation is going to help multiple companies, not only FMCG. And normally, in case of FMCG, wherever there is an inflation, obviously the discretionary part being less, you can, on a fair assumption basis, that yes, the volume growth may not get hurt more. So in that context, even some building material, even in case of FMCG, where inflation component is going to help the top line growth. But having said that, one need to keep in mind that it is also going to hurt your margins. So there are FMCG or even some other segments where there is a packaging cost, there is raw material price increase, raw material linked to the to commodity prices, including the crude oil prices. So one need to be cognizant of those facts as well. When it comes to the inflation and its beneficiary, so it's not only about actually FMCG, it is also about, if you take the credit growth. So credit growth is also going to get helped by the inflation. Only thing, obviously, as always in the banking sector, one need to watch out for is its adverse impact on the asset quality and also the NIMs. But broadly, inflation is going to help multiple segments. Even if you look at India's nominal GDP growth, where it will have an impact on that. When it comes to the other aspects which you talked about, which is the base effect and overall growth coming back into that sector, I think that at least the slowdown in the growth has bottomed out in multiple categories, especially in the FMCG. The food category has been doing well, and that is accelerating. So we are also very selective in that pack.
All right. Hi, Shreyas. Good morning. Good to see you. And Shreyas, if I remember correctly, ahead of time, you turned cautious on tech. You could correct me on that fact, but I think more than 2 years ago when we had chatted, you said that tech is something I want to stay cautious on. What's your stance right now? Stocks have seen a big correction. Valuation's a little bit more attractive. However, growth could possibly still be missing. Your view on the stocks at current reckoning post the recent underperformance, given the kind of rupee depreciation that we've seen, that could give some kind of cushion in the time to come as well. Interested or remain cautious?
Sure. So, in a hindsight, that call of slowdown in the IT sector. So obviously, no one predicted at that time the AI would have some impact in the valuation, especially. But it was more to do with the absolute growth, even at that time. The absolute growth, and especially in the large cap space. Because if you see, mid-cap IT has been doing well. Some of them actually grew right from 12-13% to even up to 20% as well. But when it comes to large cap, the growth slowed down. And I actually, if you recollect, we talked about the change in the growth pattern of IT sector. First decade of this century, second decade of this century, and now third decade of this century, where it has gradually come down by almost 5% every decade. And in that context, we are very cautious on the sector that 5% growth means actually dollar term growth is 3-4%. Like everywhere, the rupee depreciation will help when it comes to rupee term growth. But 3 to 4 to 5% growth in dollar term is not a point to start discussion with. But having said that, you rightly highlighted that there is a deflation in terms of valuation, and that deflation is more to do with the AI rather than the slower growth. So despite slower growth, the market was giving them reasonably good multiple, but with AI actually the multiple got derated for the sector. So from here on, in my opinion, overall, this AI and its impact broadly looks like in price. One need to look at impact of the improving trajectory of the growth. So if we see there is an improving trajectory on the growth, then definitely the valuations are reasonable. But that we are not at, as of now, there are no indications of that.
No indication of that. By the way, Shreyas, lots of conferences last few days, last 2 weeks actually, right? And I'm sure you and your team would have been at a few. Anything stood out to you as an insight, as an idea, as a theme?
Sure. So even apart from conferences, what actually is coming out recently, there are multiple trends which you are observing. One, if you see that in case of auto, now just start sector by sector. In auto, you are noticing that, especially in the two-wheeler, the EV trend has picked up very well. So earlier, the two-wheeler EV used to be around 6 to 8% of the sale, while now it has gone up to 10%. In case of scooter, it is as high as 20%. So that trend is observed. That is not observed as much in the four-wheeler for obvious reason. So all of us understand the reasons for that as well. But that is one particular trend which was observed in two-wheeler. And why it is important to note is that if you take TCO, or total cost of ownership, actually with whatever price increase in the fuel is there, it's not changed dramatically. But it is the anxiousness that whether it is available or there are certain troubles which customers might have faced. So that part of a change which is observed. We need to obviously look into it in detail as to how much at a country level the import of fuel versus import of the battery and because in two-wheeler or in EV now generally the imports are more compared to ICE engine where almost entirely it is manufactured in India. So that part of trend and its repercussion on entire value chain, including the finances of the country or BOP, one need to look into. That is one aspect which is being observed. Second aspect is currency depreciation and versus China, versus Europe, versus US. Now this part, if you look, just go back and probably last decade also, we have gone through this situation where there has been rupee depreciation and there used to be natural winners during the rupee depreciation kind of case. Today, because of AI, the natural winner, so already there used to be natural winners like pharmaceutical exports, natural winners like IT, and because they are short cycle, there used to be a benefit in that. Currently also IT definitely, as I highlighted on the top line front, they will benefit, but the benefit at the core of the rupee depreciation, it is not only about margin, it is about whether you are going to get more and more business out in the country. And that aspect is now we are also evaluating and checking with the companies, especially now in the manufacturing sector as well. Today, everyone understands that the sector, it's not going to be overnight journey that yes, just because rupee depreciation is there and versus 20% versus China and 10 to 15% versus other emerged economies, there is a problem of logistics today. So whether my goods are going to reach or not. So there are problems of logistics. There are problems whether this differential is going to stay at this level or not. So assuming this remains 1 year down the line, definitely you will see some positive talks around it. Today, as we speak, I don't think people are actually talking about it because there are many other constraints which.
What is the Shreyas? So what is the investment implication? The first one is clear, electric as a theme, right? Out of this logistics, what is what's the idea in that sense?
So idea is to look at the beneficiary. My point is that the beneficiary in exports. So that's why I was highlighting that erstwhile you used to find out beneficiary only in the IT and pharmaceutical sector.
Oh, so you're saying manufacturing exports.
Across the board where it can be a beneficiary.
Manufacturing exports. That's what you're kind of... no, absolutely, and I think this is a discussion worth having. Glad you highlighted it. Thank you very much for joining us, and I really appreciate your time here on CNBC TV 18. We're on the clock. There's management's waiting. 100 points, by the way, on the Nifty, 23,340. Mangalam, Indian Hotels with us.
Indian Hotels with us, indeed. The next management on the show, the company, obviously, a lot of the hotel stocks were buzzing in yesterday's trading session. The stock too doing well right now as we speak. They informed the exchanges that they will conduct a full-day roadshow with analysts on June 11th, that's tomorrow. And to discuss this and more, including the opening of an unpronounceable name, Taj Hessischerhof in Frankfurt, we do have with us Puneet Chhatwal, who's the MD and CEO at the company, who joins in. Thanks a lot, Puneet, for joining in. Always a pleasure. Let's get two things out of the way. One, how is the first quarter shaped so far? Because when we spoke to you post your fourth quarter earnings, you did say that there would be strong domestic demand coming in for summer vacations. There are wedding dates. A lot of the events that were earlier slated to take place outside of the country have now moved back into the country. So how have all those things panned out, including the performance of some of your international hotels? And the second point, you're going to meet analysts tomorrow. What is it that you're going to tell them?
Thank you. Good morning to all of you. The first quarter is shaping quite well. Obviously, there are challenges with the West Asia crisis, but having said that, resilience in the sector, resilience in the demand, resilience in the consumption, definitely of rooms and food and beverage, is been like the way we have seen in the preceding year, which also had a lot of unfortunate events. So I think the guidance we gave post our call of 12 to 14%, we can only maintain it, maybe even slightly increase. I had said in the in the analyst call that should the West Asia crisis subside by end of May, we could even go higher than 15%. But despite the crisis not having subsided, we remain fairly confident of delivering a top-line growth of at least 13 to 14%.
All right, 13 to 14% top-line growth is what you are confident of maintaining. Puneet, I just wanted to understand one thing. When we started speaking, when you had just joined, there was obviously the Taj brand. There were, some of the other brands, the likes of Vivanta, etc. There was Ginger at the phrase. Then you had a slew of newer brands that started. And now as I look at your portfolio, there is Ama Stays, there is, Claridge's, you have Bridge, you have, Vatmantan and all of that and stuff. At what point does this bouquet become too diversified? At what point do too many brands start to hurt the overall, positioning of the company, so to say?
See, the results have shown otherwise, Mangalam. It's all very positive. I think there was a lot of brand confusion. There was a lot of brand overlap. And when, things are not going right, you tend to use your backbone, which is the Taj for us, and add a bit of Taj to every brand. And all brands in this sector have done that in the past. To get more and more penetration, to get larger market share. It's another way of saying it. And I think the time had come to give clarity to the brands, to give them, the chance to stand on their own feet instead of having the crutches. That's something which has played very well for us. As you know, Ginger in the mid-market is on its way to becoming the market leader in India with almost 250 hotels expected in the next 12 to 15 months. So all in all, each brand on its own, each brand will be firing in all fronts. Every year, you will see the emergence of one of those players becoming a market leader in their relative segments.
Puneet, hi, good morning. On a lighter note, I thought Mangalam started by saying that I'm going to ask you two questions. I thought one is going to be, how do you pronounce that? Because you started by saying that.
Before him pronouncing that, he had promised both Nigel and me, I remember, that the next conversation that we have will be in Frankfurt and will be at the Unpronounceable Hotel.
I'll tell you, of course, as we all know, Germany is close to Puneet's heart. But go on, Puneet, you want to take that?
Give it a shot. The word Hessische comes from the word Hessen. Hessen is a name of a state in Germany, which has a commercial capital called Frankfurt and a state capital called Wiesbaden. And the Hessische Hof means the house of Hessen, and actually traditionally it was the home of the prince of the state of Hesse.
Now the Prince of Frankfurt is Puneet Chhatwal, actually.
Lovely. Lovely. I think you've broken it up nicely and very neatly. Thank you for that. Puneet, just so from Germany back to India for a quick bit. I think you've added Goa is back as a kind of a sort of, this. You're going out to the market with that. Is it back? And just tell us, it's an important market for you. Lots of marquee properties there. What's happening in that space? In that market, micro market?
Goa had driven the charge during and post-COVID in terms of attracting people because of the nature of the properties you have there. They're not really vertical. So, for example, Holiday Village or part of Fort Aguada or Exotica is a lot of spread out kind of architecture. So Goa was leading charge during and post-COVID. The demand was strong, so the rates went up, the occupancy went up. Then it saw a little bit flattening in the last few years. For many other brands, maybe not as strong as Taj. There was maybe a weakening in the RevPAR. But for us, year to date, we can say a top line growth in Goa north of 20% is what we have witnessed in the first 70 days of this financial.
So you're saying it's coming back strongly? 20% plus out of Goa on the top line so far this year.
Absolutely. And we also had the benefit. We had 40 rooms last year in Fort Aguada under renovation. They were out of order. So a part of that is also being driven by Fort Aguada, but Taj Exotica remains very strong. The Vivantas, the Gingers, they're all doing very well. Our Ama portfolio is very strong. Actually, we have a total portfolio of 50 amongst various brands in Goa. So for us, it's a very important market.
You know, I was in New York last week, was tempted to go into the pier and ask them what the plan of the management is. But I thought I'll ask you itself once again. And you said that you aren't putting that lease up for sale anytime soon. And at nearly 100 to the dollar, I didn't intend to go there as a customer either, Puneet. But just a final question before we let you go. We know your numbers. We know all those data points that you have. I think you're making a point. Sorry, go ahead.
No, I was just saying it's not nice on the national television. You're saying dollar is expensive. Don't go to the pier. Go to the pier, experience the pier, save a lot so that you can enjoy the pier.
All right, we do that. We will continue to save a lot and we'll enjoy the pier. But just a final question from my end. You know, we know the company's numbers. We know how the sector is poised for growth. We know the demand and the supply concerns and all of that. You know, doing well for the hospitality sector at large. Just an industry trend question. What after luxury? You know, because luxury, everyone knows, is seeing a fair amount of growth. There is some saturation out there as well to some extent. But people are seeking newer niches beyond luxury. And what is your group doing to get to that? Because now there are very specific resorts and destinations around the world. Some are sports related, some are wellness related, some are, you know, health related, some are functional related. So what are you doing there, and what are some of these emerging trends that maybe the customer's not seeing right now, but you from your vantage point are seeing?
See, there is a strong demand for spiritual tourism. I've never seen this kind of demand ever before, as we are witnessed in the last 3 to 4 years. We doubled the size of our hotel in Banaras and it's still full, the Taj Ganges. We added 2 more on the Ghats, the bridge and the Avantika very recently, plus Tree of Life. They are all, doing extremely well. But that is the story, whether we are in Rishikesh or at the Taj in Rishikesh or at Anand Kashi or, going down to the holy city of Banaras. We just, as we speak today, we are opening our hotel in Ayodhya called the Ayodhyam. You should read that very soon in the press release. So the spiritual demand remains very resilient. Then also because of very expensive air tickets, very expensive foreign currencies, a lot of demand has shifted back into the domestic markets. So I think the domestic leisure, especially with school holidays, despite the heat, is doing well for the sector. Third, what we have done, I feel very good. You answered that question yourself, actually, initially. We have diversified our portfolio by brand, by geography, and by contract type. So by brands, I mean, we're not only in luxury experience travel, we are also in semi-luxury with Bridge. We are with mid-scale experiential with Tree of Life. Right. We are in the mid-market in leadership with Ginger. So with all this diversification, with the support coming also from the Vivanta, Gateway, Homestay, etc., right. I think the resilience that we have built ourselves and the resilience that we are getting from the domestic demand is really helping us to keep driving both top line and bottom line growth.
All right. Puneet, a great start to FY27. Good start to FY27, and some of the markets are firing for you. We wish you all the best of luck and hope, the situation on the international front with all this geopolitical upheaval also settles down, which obviously is going to be a tailwind when that happens. Thank you very much for coming on, as always.
Thank you for having me.
All right, we'll take a quick commercial break here. We're going to come back and get a discussion going with Apar Industries management on their growth outlook and much more in just a bit.
Welcome back. Well, on the sidelines of the ICICI Securities Conference, I spoke to Mr. Kushal Desai, the Chairman and Managing Director of Power Industries, and started off by asking him about the growth outlook as well as the margin profile of their largest revenue contributor, which is the conductors business. Let's listen in to what he had to say.
We'll have a base profitability in that 36,000 per metric ton range. And then, based on tailwinds, which are all the special projects that we do, the HTLS, the high temperature, low sag, then there are twisted pair, for difficult wind conditions, so all these type of special projects, they add to the bottom line. So we are hoping that we'll still be in the 40s as we complete the year. We've been guiding a 10% growth, and we are looking at more business coming from the US market now that the tariffs seem to have got a little bit more stabilized, especially under the Section 232, which is what covers bare metals.
Okay.
It's also put a level playing field across the globe. So irrespective of where the product is produced, the tariff remains the same under that section.
Okay, since you're talking about tariffs, what about, in terms of global trade? I remember there was this big China plus one opportunity that was presented to various companies, and you were one of the beneficiaries as well. How much of that is played out and how much is still in the offing?
The US market is an outstanding example of that, where access that Indian companies have to the market today is better than what the Chinese companies have, especially with respect to the transmission distribution side. And also I would imagine in terms of components and cables that go into the data center and some of these more sensitive applications.
Okay, all right. So India is better placed today, and we've come a long way in comparison to what China was doing, because earlier they were dominating that market, the US market. Since you spoke about cables as well as data center, a quick question. In terms of the products or what you produce, if someone is putting up a data center and they're setting up a capex, what percentage of their capex are you entitled to? Say between cables, conductors, the other wires that you put on. If you could just give us a brief idea.
So in the data center complex, there are no conductors used, it's basically cables.
Right.
So the cabling would be between 2 and 2.5%, maybe slightly higher than that if the specifications of the products are at a high standard like fire survival, etc., etc. There is also a huge play for us of bringing power and data into the data center.
Okay.
Because we are one of the larger producers of OPGW wire. OPGW carries a fiber optic core and is the galvanized steel wire, that's for the earthing of a conductor. So there the play is to actually increase the fiber count to bring in much more data in and out of the center in the network that's servicing the center.
Right.
Also, if you're putting up a large data center, it may almost invariably need an upgrade in the transmission distribution setup.
And that's where?
And so that's where, our conductor play comes into effect, especially our HTLS, the high temperature, low sag, because you can bring in a significantly large amount of data. I'll give you a simple example, Nigel. If you look at the project that we did for MSC TCL, one of the largest lines bringing power into MMR is from Padga to Kalyan. So that was bringing in 2,000 megawatts. That's 2 gigawatts of power before we did the reconductoring. And after the reconductoring, it's already bringing in 4.2 gigawatts of power. And that is what has enabled Navi Mumbai to actually set up these data centers. So that's the impact that can have, and that's the scope that is available. It's difficult to quantify exactly in terms of data center, but the access to the data center will play a big role.
But what we can quantify is the cables opportunity, which could be around 2.5 to 3%, very, very roughly as a percentage of the total data center capex.
Absolutely.
The conductors, that is variable depending on the type, the quality, etc. Got that out of the way. Now, in terms of cables, you have been growing that business very, very well. What kind of growth are you looking at on the cables business, and in terms of profitability as well? What are we looking at out there? And since we spoke about the US markets, how much comes in from the US market as a percentage of your revenue, and where do you see that number headed?
So we are looking at in the cable business, and we've publicly stated that about 25% year-on-year growth for the next 5 years. That's what we are targeting. There's a significant amount of capex that APAR has planned. 50% plus of that capex is going into the cable side to create this capacity. So we are quite bullish on that cable side and its growth. Specifically with the US market, last year we did approximately 1,600 crores of revenue in the US in spite of all the tariff related issues.
Turmoil, yeah.
This year we are looking at beating that number. But I can tell you that FY28 is where we will be really well set up, because the key in a market like the US is to make sure that you have enough access. You have approvals at the different stages so that the RFQs come to you.
You're right.
As I said, for APAR, we have 3 C's that we focus on. The first is capacity, which is the capex that you put in, is the easiest to do. Then you need to improve your company's capability of being able to produce the right products to meet requirements of customers, etc. And the third and most important is to improve credibility of the company.
Correct.
So to do very well in a market like the US, you have to really focus on the last C, which is to build credibility, because the jobs are getting larger and larger in size. The implications are getting more and more critical.
So, putting in all these 3 C's into perspective, we have to put a number to it. You've done around 1,600 crores. In the next 3 years, you think it should be $500 million of revenues from the United States?
That's what our target is.
All right. And you're putting around 1,500 crores of capex. This helps you in terms of growth for how long, if you could help us out with that, and what could be the rough asset turn?
So we've already invested 700 crores in the last year.
Yeah.
And then over the next 18 months or so, we will invest this 1,500. So it's really like about 2,200 crores in total. And that should get us to, we want to add about 4,000 to 5,000 crores every year. And this gets us to about 15,000 crores worth of top line.
All right. Interesting. You have various parts of the business, the T-oils, cables, conductors. You want to keep them together, or cables at some kind of revenue potential or some kind of target? Will you look to demerge the entity and get a better valuation there?
Well, at the moment, we have no such plans.
But maybe
I
at
think
some
there is
scale?
a lot of synergy, because cables begin where conductors end. And just to give you an example on the data center side, a big data center is coming up. You've got both conductors coming in to bring in power and data into that location.
Yeah.
Then you have cables that are running within the data center.
Yeah.
We are looking at increasing our presence in there, because see, APAR's business is to carry electricity.
Correct.
And we are agnostic to where it's generated from and want to take it to a consumption source. So there are more opportunities within a data center. Like, for example, you have bus bars and bus ducts and, other things where, scope is there for us to look at. So rather than looking right now at demerging, our whole focus is on growing the combined business.
But at some scale, would you think about demerging the cables business?
I think it's something that we'll leave the problem for the future. Right now, we want to improve revenue and profitability, increase return on capital employed.
So in terms of the company on the whole, what kind of revenue growth are you projecting over the next few years on a steady state basis?
So we've been looking at 15% plus.
Revenue
so
growth.
we closed at 23,000 crores last year. So 4,000 crores a year, getting up to 5,000 in a year. That's what the target is.
So 3,000 to 5,000 crores addition of revenues on a per annum basis, and margin should be in the vicinity of blended.
So it should hopefully be higher than what it is today, because you will have again economies of scale coming in.
Yeah.
And as the markets are getting more sophisticated, especially in India, there is a greater chance for us to deploy some of our premium solutions. See, today in our conductor business, our premium products are 45%.
Right.
I'd love it to be at 60%. What's holding it up is just access to projects where you can quote for those type of solutions.
Brilliant. Final question before I let you go. The last 10 years, Mr. Desai, I've been tracking the company very closely. You used to do 100 crores of net profit. That number has gone closer to around 1,000 crores. All of this in a matter of 10 years. If for the next 10 years, what should the profit number look like? Will it be 5 times what it is right now? Would that be the aspiration?
Well, it's, as I said, 15% year on year is, what is the sort of base number that we are targeting.
Am I being conservative?
No, not conservative, but I think, if everything goes well, then we should be seeing, at least we should double our profits in the next 4 to 5 years.
Okay, well, that is the management of APAR Industries. You don't see them on the air very often. Markets, by the way, have moved on. We're up about 130 odd points as we speak, 23,375. Not looking bad. Just look at the dollar rupee as well. I think we opened about 20 paisa weaker, and maybe just a quick look in before we move on. 95.41. So we have recovered. We've come up. The low on the rupee this morning closed at about 55 or so. So there's been a bit of a pullback which has come through. Well, let's just talk about an industry where there is, of course, which has been doing very well, just in terms of the overall growth and new customers in that sense, if you can put it, flyers in this case, but which perhaps has been hit by high oil prices. I'm talking about aviation. And within aviation, let's pick the regional aviation piece, because, it's still a nascent industry, nascent part of that big aviation segment. Will high oil prices, sustained high oil prices, be an impediment? So where does that story fit in? So we have two gentlemen with me here in our studios. Manoj Chaku is MD and CEO at Fly91, and Alexei Vidal is Chief Commercial Officer at ATR. Gentlemen, great to have both of you here. Thank you very much for joining us.
Thank you.
We planned this discussion before the 10% price hike came through, and I was thinking, well, that gives us a nice way to start this, Manoj. So just your thoughts, top of mind, how the ADF stabilization fund, how does it all help, and where are we at? And this is not a Fly91 question, but for the aviation industry, how's it looking?
Yeah, so I think, Prashant, first of all, thank you for having us here. In terms of the aviation stabilization fund, yes, the West Asia crisis has been having its impact on aviation in general. But I must say that the government of India has really stepped in extremely well. First they stepped in by kind of putting a cap, a 25% cap on the aviation, rise in aviation turbine fuel. So that was like an extremely good step. And the second one is the stabilization fund that they have put together actually helps us to have the government also as a partner in this process to make sure that you don't take the shocks as a company directly. Okay, so I think it's a very, very positive move by the government of India to make sure this industry is kind of, I won't say protected, but have people participate into this entire thing. Of course, different airlines have got different levels of impact today. People with the jet engine aircrafts have a much higher impact on their, fuel cost to revenue ratio, whereas, regional airlines like us have a much significantly lower impact. But I would say that it's an extremely welcome move.
Welcome move. And of course, at the end of the day, all this will depend on the underlying, which is the price of oil moves, right? Some of this could be unwound, this is subject to change.
That is correct. There will be some subject to change, but I think there's a very good mechanism that the government has created, the ministry has created, which actually helps us in a positive fashion, So you're not kind of left guessing, needing to know what to do and things like that. So I would say very welcome. And hopefully we're all waiting for the crisis to get over, and for oil prices to stabilize. But I think in the short run or the medium run, I think extremely positive moves.
I'll get into the cost dynamics, etc., for aviation in just a bit, and I'll get you in, Alexei, on it as well. But Manoj, you've been an airline veteran. Is this some of the toughest periods that the industry has gone through with very high oil prices?
I think the industry has been through this before. This is a cyclical phenomenon. Way back in the 2007, 2008, we've been through a similar kind of a situation at that point of time. So yes, fluctuations in aviation fuel pricing has been a cyclical thing, but I think the industry has also had the resilience to, handle it well. But yes, currently there are situations which are unprecedented. But yeah, I think the industry has faced worse shocks in the past.
Okay. Alexei, jump in there. So talk to us a little bit about ATR. So we've got an airline operator and we've got an airplane manufacturer.
Sure, we are the world leader in manufacturing regional aircraft. And talking about price volatility of the fuel, this is where it commands airline to utilize the most fuel-efficient asset. So to give you a very simple picture, an ATR is a turboprop aircraft, meaning it has two engines, moving, rotating propellers that pull the aircraft forward. That alone burns up to half less fuel than an equivalent size jet aircraft. So when you have price volatility as we see today, or even tension on fuel supply, you want to be using the most fuel efficient aircraft. And that can help airlines fly profitably and also develop new routes, new markets in a very interesting market. India is the most exciting market for aviation nowadays.
So 30 to 40% lesser fuel consumption.
Yes.
Through these are smaller aircraft, right?
These are smaller, like up to 78-seater aircraft, which are great for opening new routes, new destinations, or new airports.
So, and this fits in with what's happening with India. Lots of new airports, connectivity going up. And so I'm assuming Manoj is a customer, Fly91 is a customer, but so are others as well in India?
Oh, we have different customers. We have been in India for over 25 years as ATR. Today we have about 70 ATR aircraft flying day in, day out with different airlines. I think we are 100% aligned with Manoj and Fly91 about the desire to develop regional air mobility in India.
Where do you make these? Where does manufacturing happen?
So we have a global supply chain in the world, but we are assembling ATRs in France, in Toulouse, which is one of the home of aviation in the world, and we are very proud of that. But we are serving about 100 countries in the world today.
And how many of these do you sell every year?
So we sell about 50 to 60 aircraft per year. We manufacture today about 40, so we are having a strong demand for our aircraft, and we have plans to grow our selling and production more globally.
And how many of these, I mean, you'll go up to 60, and how many will be how many of those planes will be coming to India, to Indian customers?
Well, you know, India today is a phenomenally growing country for regional aviation. We have 70 aircraft. We forecast a demand for more than 200 aircraft more. So we want to direct, aircraft production and delivery to India, and we are glad to be a strong partner for accompanying Fly91 in its growth in India.
Manoj, so, as Alexei said, right, fuel consumption is a lot lower.
Sure.
So just talk to us a little bit about that. So can I make that jump and conclusion by saying that, well, you operate, all of your aircrafts are ATRs, right?
That's correct, standard fleet.
So has cost as a percentage of, has operating costs gone up significantly for you, lesser than perhaps, the regular large plane operators? I mean, just give us that comparison in a sense.
Sure. So Prashant, I'll give you a kind of comparison. So for us, our cost of fuel to revenue ratio is about 22%. So out of my total revenue, I make about 22-23% is cost of fuel. A comparable airline in India, I mean, say from a cost perspective, is anywhere between 32 to 40%. So an airline that has got a large population of turboprop aircrafts tend to have it more towards the 32%, whereas the standalone jet aircrafts are in the 38 to 40%. Now, with the fuel prices going up, I mean, so while the government put a 25% fare cap, the impact of the 25% increase in fuel, our cost to revenue ratio went up to about 28 to 30%. Whereas for the people who are already sitting at the 38-40%, it's actually gone up closer to 50%. So the advantage for us has been, we have been far more resilient in terms of being able to take the cost shock, as compared to the people who operate jet aircrafts. Of course, part of it we've been able to pass on to the consumers in the form of fuel surcharges and stuff like that. But yes, I think being a pure turboprop operator, it has kind of been to our, I won't say advantage is the wrong word to use, but I think the structural advantage is something that is actually playing out in our favor, in situations like these. And obviously from a long-term perspective as well, our operating costs are very, very strongly in control.
Manoj, but it's not as if some of the larger, sorry, the mic just fell. We'll just, it's not that larger airlines like, for example, Indigo, etc., can use more ATRs replaced, because these are shorter haul flights in that sense, Manoj, right? So the cost advantage is there, but it's only going to be there for regional airlines. Would you agree?
So yes and no, Prashant. End of the day, it depends on what is the voyage you want to do, what's the kind of distance you want to cover. And typically, if you take India as a country, more than 50% of trips that Indians undertake are in the typical 8-hour to 12-hour by road distance. And that is typically what falls in the actual wheelhouse of ATR aircraft, correct? And today, if you look at the amount of under-penetration that exists in India, out of 163 airports that are functional in India, Indian aviation is largely concentrated around 70 cities, 70 to 80 cities. So there is a massive headspace available out there. And if you go back and look at, airlines that have operated in the past, city pairs that have operated in the past, there's a lot of opportunity there. So I think that opportunity exists for anybody that wants to connect two city pairs. But again, the Indian dynamics, out of 1,200 sectors in India, almost 781 are monopolies, and about 260 duopolies, clearly reflecting the demand that exists. And that is where, regional aviation actually will step in.
Come in and
Yes.
step in a big way.
You know what we do in ATR? We don't just build great airplanes. We also analyze the mobility patterns. And we found out in a study where we bought like tens of millions of data set that about 4 billion of intercity trips within India are conducted every year. But only 3% of them are conducted by air travel versus 97% on ground transportation. That means we have a possibility to double or treble that. If you look at more mature aviation economies, which is more like 8-9% of air travel share. So we have a phenomenal opportunity together with the airlines like Fly 91 to continue to develop that ecosystem with the right products.
Manoj, and just round this off with your own ambitions. I mean, where are you now, and how many planes are coming on?
So we are currently 6 aircrafts, and we connect 12 cities with 280 weekly flights. Of course, our ambition is to cross the 60 aircraft mark in the next 6 years. And obviously, we want to grow. You know, we've grown very slow but steady for the first couple of years. We wanted to kind of make sure our base is set right. But the aim is over the next 5 to 6 years, we want to cover about 50 cities. And with a fleet of anywhere between 50 to 60 ATRs, literally doing all the small regional connectivity. You know, we are not in this game to connect the Bombay Delhis and the Bombay Bangalores. We are here to go to the Jalgaons and the Sholapurs and the Sindhudurgs and the Agatis and the Kulus and all these kind of places. So that's really the space that we are operating. And we are here to kind of coexist with everybody because we are the only pure play regional airline. You know, so we're not part of a larger airline. So we stand by ourselves. We work with everybody. And yeah, that's the ambition we have.
Well, you got your hands full, the order book full with 60 aircraft. I think all of them ATRs. Thank you very much, both of you, for dropping by. Manoj, all the best to you. And Alexei, great speaking with you. And drop in next time you're here.
Thank you very much.
Thanks very much.
Thank you
for joining
us.
Thank you. Well, I think, you know, that's the aviation story and regional aviation in that sense. Well, 100 points, 23, 340, 350 on the index, so looking up. We're not flying away. As aviation is we just discussed. Nagaraj Sethi is with us with some, thoughts on what to do now. Nagaraj, what would you tell viewers to do, just in terms of indices, trades, your thoughts?
Hi, good morning, Nifty. Good morning, Prashant. Nifty has been showing some consistent rise from the lower levels to sustain the gains. I think 23,100 has been a strong support for the market, which is a opening upside gap of 8th April. I think this has to form some base around 23,100 levels and could eventually Nifty move towards the next overhead resistance of around 23,500 odd levels in the very short term. Overall chart pattern is looking positive, and the other components of the market, especially banking, PSU banking, mid-cap, small-cap, and micro-cap, are outperforming the benchmark Nifty. And I have Bank Nifty, PSU banking stocks and PSU banking sectors are looking very well ahead of the Nifty and likely to show some good gains in the near future.
Stocks, Nagaraj, what's on your radar?
I have two stocks from the long side. First one is from PSU banking stocks, Bank of India. Chartically, Bank of India was in a consolidation phase over the last couple of months and recently witnessed upside breakout of the important resistance somewhere around 145, 146 levels, currently trading at the higher levels. Overall chart pattern is looking positive. RSI and rising volume during breakout indicates more upside in the near term. Currently trading around 140, 148 levels. One can look to buy at current market. Immediate target would be around 156. One can place a stop loss at 143. Second one is Elecon Engineering. The stock has been in a constant rise over the last couple of months, recently shifted into a triangle pattern and moved above the triangle somewhere around 525, 530 levels. Currently trading around 535. One can look to buy at this point of time. The immediate target would be around 565. One can place a stop loss at 520.
Thanks very much for that, Nagaraj. Appreciate it very much. Let's get some trading data, some F&O data on the BSE, what's happening, Sensex derivatives. Mangalam has gone across to the F&O desk. Mangalam, take it away.
Well, yesterday we had the Nifty weekly options expiry. Now tomorrow we have the Sensex weekly options expiry as well. And as we look at it, there are a lot of interesting moves that are taking place in the frontline index. The Sensex currently, as we speak, closer to that 74,320 odd mark. But importantly, We have the 20-day moving average, which is around 74,934, and we have the 50-day moving average, which is closer to 76,000. So those are important levels to look at as we move along from here on itself. If you look at some of the options, the up move today has actually led a lot of people to go ahead and write puts. So the 74,000 put, which expires tomorrow, has a lot of open interest on it. We also have the 74,200 put, which has a serious amount of open interest added to that, close to around 268 rupees, telling you 74,000 is an important support. And 74,300 put as well, which is currently trading with a premium of 300 rupees, ties in with that 74,000 as an important support mark as well. Eventually, the 75,000 call, however, is fairly active, which tells you that at high levels, closer to the 20-day moving average, we will see some supply coming in for the Sensex, which is not very different from what we are seeing on the other frontline indices as well. The 20 and the 50-day moving average remain elusive on the frontline indices.
Well, thanks very much for that. Well, we'll take a break. We're back. Manish on the other side. Commodities in focus. Welcome back. I just want to make a very quick mention of the mutual fund flows. If you can have the net equity flow number come up on the screen, it's a dip. It's a meaningful dip. I'm not sure what has happened. Maybe was there a large NFO last month which took in a lot of money, and this month that has been absent? I'm not sure. But yeah, that's the number. Net equity inflow is about just under 23,000 crores, and that number was about 38,000 crores or so just the last month. This is, of course, for the month of May. May over April. The equity number, please. And 23,000 compared to almost 39,000 actually. So it's a very large dip that we are talking about. Okay, all right. Commodities in focus. Manisha is here with oil in focus. Manisha, take it away.
Thanks for that, Prashant. Well, it has been a very volatile. It continues to be very volatile in sense of crude oil prices every 24 hours. When you look at the prices yesterday, we saw 5% of a decline. And at one point in time, we saw prices going below $90 a barrel as well for the Brent prices there. But in the Asian markets there, you have it above 92 right now. This is after what has conspired overnight. We did see US launching newer strikes against Iran, saying that they have done it in sense of defensive. There also were reports on how Iran has downed an American helicopter leading US to react like that. But from what we understand is that these hostilities right now have been put to rest, and is the reason you're looking at markets easing, but also a strain coming back in Asia. And that is on the back of US crude inventories declining quite sharply for a 7th straight week, and this time around by 9 million barrels. And with that, it's a 4-month lows in sense of US crude inventories. Also, when you look at the Middle East production, well, that has continued to decline as well. At the latest count for the month of May, we are looking at nearly 11 million barrels per day of a loss continuing from Middle East as well. Take a look at some of these numbers then, and these come in from the US EIA report that came in yesterday, which says that the global petroleum output and demand seems like a big factor right now. So for 2025, those were record numbers, by the way, when output for global markets was 106 million barrels per day and demand was a record 104 million barrels per day. Cut down to 2026 in sense of average, the output seems to have a very sharp decline therein, and the same goes for in sense of consumption numbers as well, which have declined to nearly 102 million barrels per day therein. This is the inventory drawdown that the street is working with, and that number also seems to have continued to see a decline. Second quarter saw an average of a 6.3 million barrels per day of a decline, and third quarter is estimated at 7.6, so much higher in that sense as well. This is about the global inventory drawdown, and that has also been declining. March was 129 million barrels down, and in April, in addition to that 129, you saw another 117 million barrels of a decline coming in. So global inventories, output, consumption, all the numbers as compared to 2025, 26 seems to be looking at a weaker sense there. So when you look at the OECD oil stockpiles therein, they stand at 2003 lows right now. This is a statement coming in from OECD as well. So inventories have continued to decline, and 2.3 billion barrels is what is estimated by December 2026. This is much lower than the 5-year average of 2.8 billion barrels. So we're looking at lower numbers across board, and that clearly is a worrying factor. But the reason you haven't seen the crude oil prices trade above $100 a barrel, that is because when you look at the Chinese May imports in sense of crude, that declined by 29% on a month-on-month basis, and the lowest in 8 years as well. So China is the largest buyer really, and with the kind of numbers that we've seen declining in April and May, and anticipation that June could go same way is what is keeping the markets in balance there. And then there are various reports suggesting that a lot of ships are bypassing the blockades, switching off their AIS transponders. And when you look at the overall numbers in sense of Strait of Hormuz transit as well, from negligible and 0 to 2 to 3, the understanding is that 10 to 12 ships per day are now passing Strait of Hormuz, much lower than 125 to 130 that we've seen pre-war. But some traffic seems to be coming back. That also is what's weighing onto the markets.
All right, thanks very much for that, Manisha. So that is the picture as far as commodities and oil is concerned. You know, I just want to make a mention. The SIP flows are steady, rock steady, 31,000 crores approximately compared to 31 plus last month. The NFO point that I was making, well, it's come off, but that doesn't explain the large drop on an overall net number. So it's, you know, the new scheme inflow was 800 something. It is now just under 500 crores this month. But the overall dip is 22 versus 38. So looks like actually there is actually outflow, and that is the overall outflow has led to the net number being much lower in the month of May. And it's got to be that. It's not the new, that there were no large fund launches, because that doesn't explain the difference. It's a very small number in that sense. That's a trend that we're looking at. So reached 40,500 crores in March, 38.5 in April, and now 23,000 crores in May. So those are numbers. We'll get you some reactions coming up as well. Well, we'll take a break. Lata speaks with Santanu Sengupta, Chief Economist at Goldman Sachs, and RBI's new measures to ensure dollar inflows, coming up in just a bit.
Welcome to It's the Economy. Foreign funds, banks, currency markets are all still digesting the new schemes announced by the Reserve Bank to attract capital flows via FCNR deposits and dollar borrowings by PSUs and banks. The rupee has hardly gained. It's gained about 0.25% since the rules were announced on Monday night. So is the best yet to come, or are the markets still skeptical? Joining me to discuss, of course, the RBI schemes and more broadly the trajectory of growth, inflation and interest rates is Shantanu Sengupta, Chief India Economist at Goldman Sachs. Shantanu, good morning. Always a pleasure having you with us. Thank you for your time. Well, can I start with an offbeat question? We just saw the mutual fund inflows for May coming in, and after a very long time, I'm beginning to see a dip in net equity inflows. It's fallen by about 40%. That is May compared to April. Would you say that this is a good thing, that equity valuations are finally beginning to, will finally begin to reflect earnings?
Well, thanks, Lata. So it's just a month's inflow number. So I think we'll wait for more evidence to see if this is a change in the way equity investors are looking at committing money to markets. So it's just 1 month's number. Overall, I would say that the level of financialization of savings in India has progressed manifold in the last few years, right? And overall, money more towards financial markets, whether it is insurance, pension, and capital markets, is what we would expect going forward.
Yes, of course. But it's just that, both policy, that is taxation, as well as the way the Reserve Bank keeps the yield curve under control, debt seems to be getting a stepchild treatment compared to equities, which is more hands-off. But that discussion later. Let me come to, what is the talking point in the currency and among the foreign funds fraternity, the RBI schemes. What is the, after 48 hours, you'll have a good understanding of the FCNRB schemes. Will they fetch enough mana?
So this is very positive from both the government of India and the RBI. And I say government of India and the RBI because this kind of policy usually needs coordination, especially if you're changing around taxes. So we think that carry flows are not just driven by rate differentials, and policy or market-related factors also play a part. I mean, you can think back at FCNRB in India earlier. You can think about the ECB relaxation guidelines earlier in the last decade, which ended up fetching, what we call as carry flows, which is both FPI debt inflow, FCNRB kind of deposits, as well as ECB. So from that standpoint, we think it is quite positive, especially given the fact that the RBI is bearing the full hedge cost for the FCNRB and about 1.5% for the ECBs for the public sector entities or the SOEs. So overall, from a flow perspective, over the next 4 months or so, it is going to look fairly positive. Of course, all of this has a forward short leg, but for the time being, we will be, in our view, pretty much taken care of the flow requirement or the flow gap.
Okay, since you're repeatedly referring to the government also chipping in, let me first discuss the FDI in debt, the FPI flows in debt, and then come to the other things announced by the Reserve Bank. Do you think that is good enough for India to get into the Bloomberg index or any of the important global bond indexes and attract sizable amounts of money? The fact that people don't have to pay capital gains as well as withholding tax?
There's 2 parts to this. Before I get to the index, the fact that you are tweaking around taxation just gives you a better yield, or a coupon on investing in government bonds. The second part is the parts which have been included in the FARs now. While FAR was not really the stumbling block in terms of investing in India, that just opens up a bit more for foreigners to easily come in and go out. 3, you have a fairly steep yield curve in India, especially at the very long end. And, we've had this conversation multiple times earlier, that we think there is domestic demand, which is quite structural in our view, which anchors that part of the curve. 2, foreigners may find that part of the curve also attractive beyond 7.5% yield in the 15-year plus kind of segment, right, with the tax tweak. So overall, we think that there'll be demand coming into that segment over time. Although right now you've seen most of the demand being in the short end of the rates curve. On the inclusion, look, I mean, on the Bloomberg Global Ag inclusion, they will review the matter in mid-2026 is our understanding. Approvals, if any, will be coming in by end 26 for inclusion only in 27. So flows, if any, is more like 6 months to 3 quarters out. But is there the fact that you're already in the GBIM index, JP Morgan GBIM index, just open the doors also for Bloomberg. The taxation change will just act as a possibly as a catalyst.
Okay, so you're not expecting FPI debt flows of a seminal nature this year?
We think this becomes quite attractive, and we think that if FPI debt will come into the long end of the curve. That has less to do with Bloomberg inclusion, is what I'm trying to say. The Bloomberg inclusion is more of a next year story than a immediate next 3 month kind of a story.
Got it. So not index related, but in any case, even outside the index, people could be attracted. Yeah, we have still not exhausted even what has been made available by way of FAR limits, right?
Yeah, and especially because you've had the tax tweak now, so it just gives you a better yield.
Fair enough.
And once the market comes around to the fact that what we think is that we think that you have a ceiling on this runaway depreciation in the INR with the flows. Hopefully, that will be coming in with all these measures.
Okay.
And once the market gets around to the fact that there is stability in the INR in the short term, that is when you can get some capital commitment coming in.
Yeah, both even in equities. Actually, since let's get this money and amount of flows and rupee out of the way before I come to growth. Do you all have a ballpark of how much flows? Is it 50 billion, 70 billion? What is the range you're expecting? And therefore, what is the rupee range for the year?
Yeah, so the flows first and then the rupee. Look, we think the FCNR itself last time round was about $25 billion. If you just did the same share of NDTL, it would be a much larger amount. We don't think it goes, almost double that amount, but at least somewhere in the region of $25 to $40 billion is what we would think is possible from FCNR. The ECBs are also quite attractive with 1.5% discount. So that could be anywhere in the range of, $10 billion or so. So, you could think of a range between like $30 billion to $50 billion that comes in, along with, some top up, which you can have through GSEC inflows from the FPI, the discussion that we had earlier. Now, if you look at the BOP numbers, which I think has taken at least us by surprise for the previous quarter, the current account actually was in surplus. BOP is in surplus in that quarter. If you put that together with the kind of BOP hole that we were thinking about, so the current account we were estimated at around 2% of GDP, we think there's a likelihood that comes in smaller. So it's a narrower current account deficit than what we were estimating earlier. We think that India's oil intensity is just generally lower. It's lowered over time. The economy can switch quickly to alternate sources of energy. And therefore, the oil import bill may not be as large as we were thinking, 3 months back. Hence, with a slightly smaller current account deficit and the BOP hole now, in our view, more or less being plugged through these flows, we think over the next quarter or so, there's pretty much a ceiling on the depreciation pressure on the currency. Of course, we'll have to observe the conflict, where it goes, where oil prices settle, etc. by the end of the year. But for the time being, we think that that was my starting point. That the RBI, along with the government, has come out with measures which sort of puts the ceiling on the rupee.
Okay, just a word on the growth, because I'm being warned about the time limit. The flows that come in, FCNR flows and ECB flows, also mean liquidity for banks. Banks' CD rates were the one that best reflected the RBI schemes. They fell by, in certain levels, they fell by about half a percentage point, 40 basis points. Clearly, 25 basis points across the curve, you're seeing CD rates fall. So if bank financing becomes a little easier, are you getting any more positive on India growth What's your number, and is there an upward bias?
Yeah, sure. I mean, India has been more resilient into the shock than what we thought 3 months back. I mean, clearly, right? I mean, I think previous quarter's number beat all our expectations. We were at 7.2. And absolutely, CD rates were elevated, which is why an FCNR or an ECB completely made sense. That's what we sort of also wrote before the policy meeting. And now that you have this fully hedged, the RBI covering the full hedge cost, we think this will, have this, sort of dual impact, A, from the BOP perspective, which we discussed, and B, absolutely clearly on the liquidity front as well. So this will make overall funding conditions easier. And therefore, I would say that, the growth, unless the war goes to a point where oil prices are significantly higher, I would say that slightly higher bias towards growth. We are still in the low 6 handle on growth, with the RBI at mid 6 handle for F27.
Okay, and so there is an upward bias. Unfortunately, out of time, Shantanu, I'll take a rain check from you for another discussion on another day, but at least it's positive that there is a cap for the rupee in terms of its depreciation and possibly an upward bias to growth as well. Thank you very much for joining us. We wrap up on Bazaar on the note that markets still in the green. Let's celebrate that, and perhaps Chartbusters will see more green after the break.
Reliance Industries ties up with Facebook parent Meta to set up the very first AI-enabled data center in India. The 168 megawatt data center will be built in Jamnagar, Meta, to release the same with optionality to scale up.
CleanMax and Favour and Meta Platforms Inc., a 900 megawatt renewable energy partnership, CleanMax, to develop and operate 837 megawatt of the new capacities across Rajasthan and Karnataka. Meta, meanwhile, will purchase 100% of environmental attributes of the said project to align with its aim of 100% clean energy usage. Shares of CleanMax upbeat in early trade.
Afcons Infra bags a 5,300 crore project from the Vadhavan port to construct a 10-kilometer long breakwater. Upon completion, the said structure will become the second longest breakwater in the world, says the company. The stock up 5% in early trade.
Elevated bond yields coupled with firm dollar drag precious metals down. Gold corrects significantly from its January peak of $5,600 an ounce. Prices drop below the 100 DMA. Gold finances Muthoot and Manappuram under pressure. Hindustan Zinc too sees some selling pressure.
A bullish JP Morgan note sends shares of HUL higher by 2.5%. They set an overweight stance with a target price of 25.50 on the stock, whereas Morgan Stanley downgrades Oil India to underweight from overweight, cutting the target to 404 rupees, citing a 6 to 7% downside on account of crude price volatility. That stock down about 3%.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, Mangalam, still in the green for the Nifty. Intraday volatility is there, but Nifty still holding up, and the Nifty Bank as well is playing its part with a gain, I think, of around 150 points.
The Nifty doing well, the Nifty Bank doing well. We have Reliance as well playing its part. The only one which is not doing well is the IT pack. And alongside that, we have the Midcap index as well. Though, you know, the Midcap index, even at an index level, while it is an underperformer, we have a little more in terms of the number of stocks which are advancing than the number of stocks which are declining. But that is a metric that we will be tracking all through the course of today's trading session, as those lines have come fairly closer. The important part, however, is that the mutual fund data for the month of May has been released. While on an optical basis, there has been a sharp dip in equity inflows, there is a lot more that meets the eye. And for that, we have Vinny, who joins in with all the details. Vinny.
Hi, good morning. So firstly, obviously, we've seen that equity inflows have come down. Month-on-month basis, we are seeing a decline. It's the lowest in terms for the level of flows that we've seen coming in almost a year. Now, this does indicate some bit of a cautious approach that has come in from investors as well. Mid-cap also, we're seeing a decline in terms of flows coming in. Large cap flows also have seen a decline. It's the lowest since December 2025. But the SIP contribution, if you look at that, yes, month on month, you're seeing some bit of a decline, but still steady above that 30,000 crore mark. So yes, you're seeing that steady performance continue for that 30,000 level in terms of SIP contribution. Apart from that, NFOs, those were much lower this time. So you're not seeing much of a traction coming in on the NFO front as well. Gold ETFs continues to see some bit of a profit booking over the last few months. Also, we're seeing monthly a bit of a decline, some booking on that front. Plus, do not forget that, there are a lot of AMCs which had stopped taking subscription for gold ETFs during this month as well. So that also does come into a factor and does come into play as well. Now, AMFI on their call also highlighted that there's a cautious approach among investors, this global uncertainty that is there. So there is some cautious approach. But long-term, investors continue to hold on given the steady SIP contribution that one has seen. And as well as in terms for gold ETF also, they did highlight that maybe this is something that could continue for some time. But as of now, that concern comes in because AMCs have also stopped taking subscription. Mid and small cap also have seen a decline on a month-on-month basis. And over the last few months, they've seen very strong traction. Right now, in the month of May, we're seeing a reduction there. So seems like clearly in terms of the data, we're seeing a bit of a cautious approach that's coming from investors this time. At least that's the indication.
Right, we take that point. Thanks a lot for that. SIP number at 31,000 crore is steady. Suranjana Borthakur, who's joining in from Mirae Asset Mutual Fund. And alongside that, we also have Santosh Joseph of Germinate Investor Services. Both of them join in to, decode these numbers. Suranjana, coming to you first, what do you make of the sharp dip month on month? Is it largely because there was no major NFO? How do you read these numbers so far? And what does this tell you of the trend?
Yeah, hi. So I think while, as has been mentioned, that at a broad level, there has been a 40% dip that we see in equity inflows from a 38,000 to about 22,900. The last we saw this number was somewhere, lower than this number was around May 25. But what I see is the biggest impact has been in the thematic and value contrast segment. I think thematic to a large extent has cooled off in the last few months. There was a frenzy, you remember, last year as well as last year. So I think that continues to become a little more tepid. The flexi cap is halved to 5,000 crores compared to 10,000 crores in the last few months. That is a inflow pattern which has changed dramatically. I would think multi-cap is again a segment where there's been a 40% drop that we have seen. Mid and small, incidentally, continue to remain relatively better. I think it looks like, conviction in the alpha which can be generated in the broader market remains a positive view continuing from here as well. I think it's also to do with the SIP momentum continuing, whereas this lump sum flows probably moderating to a certain extent. NFO, as mentioned, yes, the flows have become fairly tepid. I would think it's to do with, the sustained market uncertainty. Obviously also there was some sort of domestic profit booking also, which happened after the April month's recovery that we saw. But in May, obviously, the Sensex also was down about 2.5-3%. Nifty was down about 2.5%. So I think May we kept seeing the escalating geopolitical tension, the surging crude prices, as well as very massive, FI outflows that continued. I think BAF is the other segment in hybrid, which lost, almost the flows were 90% down from last month, which is something which stood out within the hybrid basket. Aggressive hybrid and arbitrage also saw an inflow which was less than 50% of last month. Multi-asset continues to be a category which, even though there was a slippage, but I think that is a category month on month we've been seeing very healthy inflows and has become a go-to category for many clients. Gold, as was mentioned, I think is, the negative 725 crores vis-a-vis the 3,000 crores last month and the very high inflows in the last few months. This is a category where we've suddenly seen a drop, obviously to do with probably the profit booking after a very sustained rally which has happened in gold. I would think the AUM still of the total industry remains very steady, but SIP flows holding above 30,000, to my mind, it indicates that, the structural story probably remains unbroken.
Got it. All right, so Ranjana, thanks for that. Request you to stay with us. We have Santosh Joseph as well, who joins us on the show. Hi, Mr. Santosh. Thanks a lot for joining in. Well, to give you the big headline numbers, the net equity inflow has come in at around 23,000 crores, 22,897 crores. That compares with ballpark around 38,000 crores. The large cap, well, the fund inflow out there is around 1,600 crores, which compares with close to around 2,500 crores. Small cap, 4,946 crores. That compares with around 6,900 crores. And the SIP number is holding rock solid at 30,954 crores odd, giving you a sense that the Indian investor actually is maturing and hopefully they can hold their ground. Santosh, what do you make of it?
So you said it right. The Indian investor is coming of age. He's maturing. He's sticking to the discipline of investing consistently. What you see in the larger headline number is that they're also maturing in terms of being mindful of the valuation at the entry point. Back when there was a small dip of 1% or 2% that would get easily bought into. Right now, you're seeing that getting a pause, which is they're waiting to see an actual bottom or maybe even more meaningful dip for them to buy. If you notice in the previous, maybe 6 months ago, a 2% dip in a month would easily see a huge inflows into equity because people say they were buying the dip. I think both in terms of repeatedly buying consistently through SIP or jumping in to buy the dip, you're seeing maturity on the end of the investors.
Right. What does this dip from April to May tell you about one-offs, and where do you think this number settles as we go along from here on? Because Santosh, intuitively one says that, the markets follow flows, but turns out it's actually the other way around.
Actually, it's right. In this kind of thing, what you said, that the flows are actually following the markets. Usually in a very buoyant market, the equity flows are very, very robust. And in this market, I think what we should highlight is we've been having very volatile months. You had a great April. Before that, you had a really difficult month of March. And then you had a flattish to negative May, which means it's also testing the nerves of the investors. Now, that's why I said the investors are matured, because they're stuck to their SIP ground. But when it comes to markets not giving them the breakout that they chose, they're not very comfortable in coming all out and putting all their money. Again, if, for example, in another 1 or 2 months, we see very, very good markets, you will see that equity numbers will again bounce back in a big way, because we saw that in the past also, that whenever people feel that the markets are rebounding, they will buy into it heavily.
Okay, all right. Appreciate you joining in, Suranjana, as well as Santosh, and giving us your quick take. We'll have a longer discussion during the course of the day, but thanks a lot for joining in. Well, time to slip into a quick break. You come back, we'll continue to focus on markets. We'll also get you some trading ideas with Reliance Broking's Ajit Mishra. Stay tuned.
Welcome back. 100 points higher for the Nifty. Still not doing particularly bad. In fact, Trent has now moved to the high point of trade. Some of the banking names have now come to the fore. Case in point, ICICI Bank, that's moved higher. And L&T too has picked pace, currently at the high point for that stock as well. Good time then, as any, to bring in Ajit Mishra for a quick technical check on the market. Ajit, the last couple of trading sessions, the bulls have attempted to make a bit of a comeback. Do you think this sustains? If yes, then what are the levels that we're seeking?
Yeah, good morning, Mangalam. So, Mangalam, yes, we are seeing that bulls are trying to defend the 23,000 mark, which coincides with the lower band of this declining channel that currently we are trading in. The banking is basically the major savior that we are currently seeing strong momentum. In fact, the private banking majors, which were sitting on the sidelines, are also witnessing traction, especially ICICI Axis. They are holding well. So basis that possibility of further rebound is there, but still we are not out of woods when it comes to the Nifty index because we are still below the 20 EMA mark, which is close to around 23,500, 550 area. Let's say once we surpass that, then probably we may see this recovery further extend towards 23,800 mark. So selective buying opportunity, especially in the pharma, healthcare, and banking is something that one should be focusing on until we see a decisive sign of reversal in the index.
Got it. Okay. All right. Ajit, what about individual stocks? What are you looking at?
So Nigel, pharma, healthcare, banking is something that you should be focusing on considering their relative strength. And yesterday we were seeing that the PSU banking counters were buzzing in the trade, and we expect this momentum to further carry after this recent consolidation phase. So Bank of India is something that we like even at current levels after this sharp rebound in yesterday's trade. With stop at 142, one can look to go long with immediate target of 157. And then we have Oro Pharma from the pharma basket, which has formed a fresh buying pivot. The risk reward is favorable. We are eyeing 1530 area as an immediate target with stop at 1430.
All right, take that point. As we speak, there is the Tata Consumer Annual General Meeting, which is currently underway. Yesterday, we got comments from N. Chandra on TCS, and now as we speak, he's speaking at the Tata Consumer AGM, saying that they're well placed for growth, broad-based constant currency revenue growth of 12% and PAT growth of 20%, which was there in FY26, continues to do well for them. They have successfully transformed a tea and coffee company into salt and multi-category along with other consumer products. So we'll monitor any lines, important lines that come along from there, given the sort of outperformance that we're seeing in FMCG staples in today's trading session as well. But let's get you some ideas for profit now. Colleagues at Money Control Pro joining in. Bharat Jinani has a stock that he's been tracking. Bharat.
Today's ideas will be PN Country Jewellers Limited. Despite the custom duty increase on the gold, the jewelry demand is buoyant. Jewelry retailers are increasing the share of old gold exchange in their overall sales. That would reduce the dependence on imported gold. PN Country Jewellers is trying to increase the share of old gold exchange in its sales from 40% to 50%. Additionally, the company is focused on introducing lightweight as well as low carat jewelry. Moreover, with the gold price correcting by about 5 to 6% in the past 2 weeks, the customer footfalls are expected to improve. The company is targeting revenue growth of 25% in the current fiscal. The company would continue healthy network expansion and aims to open 25 new stores in the current fiscal. The company would also enhance its market presence and aims to enter 3 new states of Gujarat, Haryana, and Gurgaon. The company has maintained net profit margin guidance of 4% in the current fiscal. Increased marketing and advertising expenses will be offset by a better product mix and operating leverage owing to higher sales. At the current market price, the stock is trading at a PE of 13 times FY28 projected earnings, which is attractive. Hence, we recommend investors to add this.
Thanks a lot for that, Bharat. Well, time to slip into a short break. Come back. We'll continue to focus on markets and stocks that are moving around. Stay tuned. Welcome back. You're tuned in to Chartbusters. You're on CNBC TV 18. Well, let's turn our attention to the oil and gas space. That's back in the spotlight after a Morgan Stanley note came out earlier today. Sonal joins us to cover a couple of those companies, ONGC and Oil India, on her radar. Sonal?
Well, you know, Morgan Stanley is quite upbeat on the upstream sector of the country, specifically ONGC. Higher crude prices, that is something which will aid revenues and realizations for them. They say it is seeing an investment boost of $10 billion a year. There have been a couple of things that have happened, new discoveries of natural gas and reduction in royalties. These two are the key catalysts for both these stocks. There is no windfall tax. That was surprising because the expectation was that in a situation like this, there could be windfall tax on crude oil production and realization as well. So that has come in as a positive. For ONGC, Morgan Stanley is overweight on that stock with a target price of 345 rupees a share. Couple of things which are working for ONGC. The first thing, it has paid $33 billion in dividends, roughly equal to its current market cap. Of course, these dividends have been paid over the last 2 decades. They expect dividends to be 2 times the historical rate that they've seen in the next 20 years. So the dividends will continue to increase, which will be positive for the investors. They are seeing a production CAGR of 3% and earnings CAGR of 14% for the next 3 fiscals. For ONGC, the growth will be driven by gas production domestically, turnaround in profitability in international operations. So ONGC Videsh and the other fields that they have abroad, that is something that they are very positive on. But for Oil India, they have downgraded the stock to an underweight. The target price has been cut sharply to 404 versus 566. They are seeing 6 to 7% downside risk to street estimates as oil prices they're expecting to normalize. That would work for ONGC as well, right? But for Oil India, the additional tailwind is the Numaligarh refinery. They had acquired it for BPCL 4-5 years back. So they say there could be potential discounts in diesel sales which will hit margins for Numaligarh refinery in consolidated figures. Delayed natural gas selling price. They will see lower refinery margin because of that. Slower increase in domestic production, and hence the reason why we are seeing the decline and a downgrade that has come by on Oil India.
All right, Sonal, thanks a lot for that. So that's about Oil India. Meanwhile, as we speak, we have the market which is gaining and, adding to its gains right now. The Nifty Bank, when we started the show, was up around 0.2%. Right now, as we speak, up nearly 1/3%, 200 points on the Nifty Bank. With that, we're out of time on this edition of Chartbusters, but you don't go anywhere. The team of Trading Hour takes all the market action forward. From Nigel Me, thank you for watching.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me, as always, is Ritu Singh. Ritu, good morning. And the markets have had a good start today, despite the sell-off that you're seeing in the big tech across the globe, across the US, even in South Korea, in Taiwan. The Indian equities have done fairly well for themselves, back at the highest point of the day as of now. So 23,370 is where the index stands, 130-point gain for the index, and this is despite the lack of contribution from the Nifty Bank. The Nifty Bank was the star performer in yesterday's trading session, but today it's had a quiet start to trade, and and that too has over the last few minutes now moved to the highs of the day. So good start for the index, for the Nifty Bank as well, continuing to build on to yesterday's gains. Ritu, good morning.
Good morning, Hormaz. The Nifty Bank, yes, continuing to build onto the gains. You also have the IT Bank that is at least in the green today. What's not doing so well is the broader markets. That's in the red. The mid-cap index is down about 93 points as we speak, whereas the small-cap index is also seeing cuts of 0.3%. So that's a bit of a weak spot in the markets today. But the advanced decline ratio tells you it's pretty much even, Steven, at the moment. If you look at the index, India VIX as well, it's down about 0.3%. So, looking decent here at the first few hours of the trading session. On the macro front as well, if you look at the oil prices below $92 a barrel, 91.6 is where the Brent is at. So that is some good news. Whereas the rupee has also seen a bit of a appreciation today, 95.22. That's where we're at the dollar. In terms of sectorally, what is doing well and what is not, it is FMCG, pharma, Bank Nifty, of course, a bit of IT that is seeing some buying. The weakness is present in the metals, the media pack, the auto pack, and the real estate index, also on the downside. But as always, let's put the spotlight on individual movers and shakers in the market today. And Hormaz has walked over to the ball to give us that list. Hormaz.
It's a good start, and the Nifty would be hoping that it finally manages to break out of that range that it has found itself in. For now, it is at the higher end of that range. With 23, it crossed yesterday's highs, and now we go into the 23,500 zone yet again, which has become a congestion point. Last week's high, of course, around about 23,516. That is the level now that the bulls will be eyeing, considering the fact that the dip that we saw intraday has now been bought into. And the Nifty Bank continues to push the index higher, and yesterday the index was up around 1100 points. Today it has added another 250, 300 points to that as well. A very sharp surge over the last 30 minutes for the Nifty Bank. It had a subdued start, and now it is heading towards that 55,500 mark, and analysts believe that if we cross 55,500, head towards 55,700, 800, and then if we break out of that level, the next target on the upside for the Nifty Bank comes up to around 56,200. So there is still analysts projecting more upsides for the Nifty Bank if it manages to cross certain resistance levels. The FMCG stocks are the ones that were leading the outperformance right from the start before the Nifty Bank stepped up in the last 30 minutes. Colgate and HUL receiving some positive brokerage recommendations earlier in the day. Nestle and Dabur also doing fairly okay for themselves in today's session, gains of 1.5 to 2.5% as well. Reliance Industries dominated news headlines this morning. The stock is off the highs of the day, but still a significant contributor to the Nifty upside. Yesterday too ended around 0.7% higher, has added another percent to it, was up around 2.5% initially. CleanMax, of course, the same Meta partnership, 10.5% higher on this one, was up around 15% earlier in the day. Afcons with the big 5,000 crore order win that it reported last evening is up around 6%. And Oil India with that big downgrade coming in from Morgan Stanley earlier in the day, 3% lower on that stock, not to add to the fact that the oil prices too continue to fall. Metals as an index continues to underperform. It is the 5th straight day of losses for the Nifty Metal Index. Hindalco, Nalco, Vedanta, Jindal Steel, all of them are trading with losses. Vedanta is seeing some buying coming in at lower levels, but Hindalco continues to underperform, 3% lower, as does Nalco, another 2% down in today's trade as well. The precious metal prices have seen a very sharp fall in the the global markets overnight, and that has had an impact on all of these gold financing companies. Manappuram and Muthoot both down 3.5%, and of course the only listed silver play in the country, Hindustan Zinc, that too is trading with losses of around 3%. And lastly, stocks that are at 52-week highs in today's session, even though the broader markets are a bit sluggish this morning. The CCL Products is continuing to move higher, 6% again on today's trade. Kaplan Point 5% higher in today's session, and Himadri Specialty Chemicals is seeing some very high trading activity over the last 5 to 7 trading sessions. Another 3% added in today's trade, and another 52-week high for the stock, Ritu.
Well, thanks very much, Hormas, for running us through that list. A lot of stocks will be in focus today, and we'll be speaking about them in just a bit. But remember, Hormas, yesterday we discussed the whole data center opportunity in India, that boom, which is playing out. And today we have this news come in. Reliance Industries and Meta Platforms, they've come together to announce a significant expansion of their partnership with an agreement for an AI-enabled data center, which will be set up in Jamnagar. Rachna Dhanrajani is tracking that story for us and joins in with what exactly this partnership entails. Rachna.
Well, Meta and Reliance Industries have announced an agreement to build an AI-enabled data center in Jamnagar, Gujarat, and the facility will have a capacity of 168 megawatts in its first phase, with options to scale further. Now, Reliance will construct it, Meta leases it, runs entirely on renewable energy, and will cool these data centers using desalinated seawater. Meta will also cover the full cost of energy and water supporting the facility. Now, Jamnagar is where Reliance is already developing one of the largest data center campuses in the world. Now, pair that with Meta's Project Waterworth, which is the longest subsea cable system ever laid. This will put significant compute capacity on Indian soil, connected directly to the global internet backbone. For Meta India users, and there are over 1 billion of us across WhatsApp, Instagram and Facebook, this could mean AI being served from local infrastructure. So lower latency, faster performance, and maybe things that are made just specially for Indian users rather than being adapted from the West. For Reliance, it is the next step in a partnership that has moved through each layer of the digital stack. It all started with the $5.7 billion investment in Jio in 2020, then the Llama AI joint venture to bring Meta to Indian enterprises, and now it's physical infrastructure. This is pretty much the stack that underpins everyone above it. On clean energy, Meta has contracted nearly 1 gigawatt of new solar and wind capacity across 5 states, 837 megawatts with CleanMax, and 88 megawatts with Fourth Partner Energy. All in all, the partnership could indicate that India is moving from spectator to stakeholder in the global AI race, so we'll have to watch out for that one.
We'll keep an eye out on that. Rachna, thank you for that update there. Almost 1% higher on Reliance Industries, but CleanMax is the stock that has zoomed ahead 10% higher on that stock. Has been one of the few successful IPOs of the year as well. Shifting focus to some of the other names, we spoke of CleanMax, so you get more details on that. And of course, Afcons Infra, which is also, as we mentioned, surging on the back of an order win. Vivek is here with more details on both of them. Vivek.
Well, thank you so much for that. So first up, let's start with Afcons Infra. We've actually heard a spate of cancellations, especially from Europe as far as Afcons Infra is concerned. But yesterday, a positive surprise being delivered by the company. The company has gone ahead and won and has emerged as the lowest bidder for a 10.14 kilometer long breakwater project, and this is going to be at the upcoming Wadhwan port. The total value of this particular project is in excess of 5,300 crores, and this, when you're comparing it to the company's order book at close to 32,496 crores, is a significant accretion as far as the order book is concerned. So Afcons Infra clearly one of the top movers in the session today on the back of this very large order win. And like you mentioned, CleanMax, the company continues to go ahead and strengthen its partnership with a whole host of MNC players. Remember, they already have tie-ups with names like Apple. Today, they've gone ahead and partnered with Meta. This is to set up a renewable energy platform where the company will go ahead and add renewable energy capacity. 837 megawatts of solar as well as wind projects will be added by CleanMax in Rajasthan as well as Karnataka, and Meta will be the off-taker for all of these particular projects. Remember, CleanMax again has been a recent IPO that had corrected on day one, but has since doubled and has been one of the top gainers in the session today as well.
All right, CleanMax and Afcons Infra gainers in trade today on the back of those order wins. Vivek, thank you very much for bringing us that update. And we'll now shift focus to consumption stocks. Now, JP Morgan has come out with a view on both Hindustan Unilever and Colgate. Mangalam joins us now to take us through their stance and the rationale behind it. Mangalam, overweight on HUL, neutral on Colgate.
That's correct. So the FMCG staples are likely to do better from here on, and there are a bunch of reasons for that. The biggest one, of course, is the fact that they've underperformed and now going into a zone where the base for them is favorable. But alongside that, they've taken mid-single-digit price hikes as well, and as a result of which, revenue growth for this year would look a lot stronger for all of these companies which were struggling for top-line growth. And in light of that, JP Morgan met the management of HUL. They have an overweight rating and a target price of 2550 on the stock. They say that the management did reiterate a stable demand outlook supported by calibrated pricing actions and resilient urban as well as rural franchise premiumization coming in from the urban standpoint as well. Segment-wise, liquids within home care and personal care, premium beauty, well-being, and scaling their foods business are important optionalities. So they're positive, and they are also confident of absorbing the 10% input cost inflation while maintaining their margins between 22.5% to 23.5%. On the other hand, while they're neutral on Colgate, they do believe that the CFO signaled a positive outlook for FY27 towards both volume and price has to be balanced. Premiumization would lead to revenue growth. They too have taken about mid-single digits in terms of price hikes, and oral care category will remain relatively resilient amidst inflation. At the same time, they've said that, urban, the sentiment is improving even as rural remains stable, but still slightly more exposed to inflation risk. On the profitability front, they believe gross margins will remain stable, but here's the most important point. EBITDA will be influenced by stepped-up brand investments, and this is something that the street will not mind. Colgate choosing brand investments over a few basis points in EBITDA, and as a result of which leading to higher growth, is something that the street has been wanting for a very long time, and that, if the CFO has promised, should be positive news.
Positive news indeed. Mangalam, thank you for summarizing that for us. Both the HUL and Colgate doing fairly well for themselves in today's trading session. The one stock that is continuing to move higher is Aster DM. Another 3.5% today, has been up all through the week, has been the stock. So another 3%, so 820 now on Aster DM. On the flip side, though, there are certain names that are not doing well. HFCL, another lower circuit for the stock today, continues to see profit booking after the stock had crossed 200 rupees at one point of time. So in a lower circuit is HFCL. Karur Vysya Bank has moved to the lows of the day as well, 3% lower on that stock, and some profit booking also setting in on NetWeb Technologies is also trading lower by around 3%. Take a short break, focus on the bond markets with Manisha Gupta on the other side. Welcome back. Shifting focus now to the bond markets as promised. Manisha Gupta is here with the latest. Manisha.
Well, thank you for that. I'm also looking at the AMFI ETF numbers really because that shows you on how the total AUM has seen a decline. We have seen an inflow decline on a month-on-month basis, not just for the equity markets, but also in sense of the credit risk. Fund inflow has seen quite a sharp decline on a month-on-month basis. Hybrid fund inflows also have inflows have actually just about halved when you look at on a month-on-month basis. And then, of course, you have outflows not just for gold and silver ETFs, but also the SIP inflows have seen a very sharp decline. The corporate bond fund inflows should come in on your screen. And it's not actually an inflow, it's an outflow, and a strong one at that. Last month was an inflow of 6,000 crores. We're looking at a 7,000 crores of an outflow coming in for the corporate bond market therein. Well, let me remind you that when you look at the overall India's corporate bond market, that stands at 53.6 lakh crores, which is, by the way, $645 billion therein. And when you look at the overall number, it has jumped up quite strongly in the last decade or so. We have seen a CAGR of around 12 to 15% onto this one. It is now nearly 15% of India's GDP as well. So because of the kind of measures that we saw from RBI in the previous week as well, did not touch tax easing when it comes to corporate bond, is something that the street has been looking at with a sense of displeasure therein. Also, there is a statement from AMFI suggesting that, one, there is profit-taking, of course, but the other thing is that the RBI and government measures to attract flows into GSECs is something that the street is also looking at. There is a bit of outflow that the markets have seen. As I said, no tax easing on corporate bonds is something that has led some displeasure into the space therein. But there are private issuances that have just about continued quite strongly. We've seen Tata group of companies come into the markets as well. NABARD says that they are also looking to raise nearly 70 billion through the reissuance of 3-year, 1-month bonds maturing in 2029. So more and more companies coming in there with bigger numbers this time around. HDB Financial Services also is looking to raise 17 billion via 3 bonds, 2 reissuances here as well. Aadhaar Shila Infrastructure should also come in on your screen. They are also looking to raise nearly 3 billion with issuances of bonds which are maturing in 2031. And then you have Axis Finance as well, planning to raise nearly 8 billion. They are doing it via issuing bonds which are maturing in Jan 2029. So corporate bond, private issuance is just about continuing to the market, but AMFI data a bit of a dampener when it comes to corporate bonds.
All right, Manisha, thank you very much for getting us that comprehensive wrap of all things on the bond market. Let's slip into a break, but when we return, we will discuss market technicals with Rohit Srivastava of IndiaCharts.com and Stripe Money to discuss market fundamentals and his views. Welcome back. We have Rohit Srivastava, founder and strategist, IndiaCharts.com and Strike Money with us. Rohit, thanks very much. Good morning, for joining us here on the show. Before we get to anything specific, you must have seen the May numbers that have come in on the mutual fund data. Bit of a surprise there. We saw the net equity inflow at just about 22,800 odd crores, which is the lowest that we've seen in 12 months. In light of what we've been seeing, the theme in the market, the FII selling, domestic investors supporting the market, do you see this number coming in as a bit of a blip, 1 month aberration, or actually retail investors are structurally de-risking now?
No, I would look at it as a temporary reaction to what is happening in the market. Definitely, when every day the news headlines are, war, a rupee hitting a weaker level, it does have some sentimental impact. And that is what we try to, play into and try to understand as to where sentiment is when we're actually taking a market view. So I wouldn't, I would see it as a blip, because it's not like you have halved the inflows. It's like on the margin, there's been some reduction. Which is fine, I think, which is part and parcel of how sentiment really evolves.
Rohit, thank you for joining in. Every time we speak to you, we end up asking you whether this particular level on the index is a base or not. And every time that level ends up getting violated on the downside. Same has been the case this time around as well. We're speaking of 24,000, then we came to 23,800, then 23,500. Now we are at 23,000. Same question again. Is at least for now the 23,000 level becoming a base for the index? Of course, we'll get to the yearly low of 22,182 later, but for now is 23,000 the key for the Nifty? And if so, how higher do you see this bounce sustaining now for the index?
Let me give you two levels on the Nifty and Bank Nifty, what we call as a 61% retracements. That's 23077 on the Nifty and 52687 on Bank Nifty. Now, Bank Nifty got there first in May itself, and it hasn't really breached that level, whereas Nifty only got to that now. And so far, it's a bit early, but we would like to believe that it will also not breach that level. I think if we sustain above 23,350 today, which would be our first early sign that the base level down here is getting formed. And we call this technically a second wave because it does not carry back to the lows that we made in April. So basically, you're trying to form a higher bottom. We may have dropped a few 100 points lower than where we were the last time we spoke, but it doesn't change the fact that we are at a higher bottom than in April. And therefore, it's a basing process, a consolidation phase as far as Nifty is concerned. I think the confidence on this view comes from looking at what we call as market internals or the broad market, which has been performing very, very strongly and outperforming the main index. So that's a good sign. Another good sign is what we look at nearer term is the divergence between Nifty and Bank Nifty, where the June lows in Bank Nifty did not breach the May lows, whereas the Nifty did, and we call that an intermarket bullish divergence when the breakdown in one index is not confirmed by another. So that is also an underlying bullish or positive sign that things will work out in the end, irrespective of what may have happened in the near term.
Rohit, so what is Bank Nifty just the last man standing? When does it take Nifty up to a higher level, or just act as a stabilizing factor as it's been doing recently?
Well, definitely not only acts as a stabilizing factor. I think in the next wave of the bull run, banking and financials are going to be significant performers. They've had a long underperformance phase behind them. And what we are seeing again here below the surface, when we look at Bank Nifty, we only end up talking about the big boys like HDFC Bank or Kotak Bank or ICICI, which have been the laggards. But the moment you shift your focus to the second line banks, second line NBFCs, PSU banks, then you start seeing much better performance than you actually see in the big ones. So I think it's already started to happen that financials as a basket is outperforming the Nifty. We see that in mid and small caps, you might find individual sectors that are also doing so. And which is why, from helping the Nifty point of view, what you mentioned, yes, Bank Nifty plays a significant role, especially where IT sector is the one that has been tarnished. You need somebody, holding it up. And I think Bank Nifty is doing that job.
One sector that has been a bit of a dampener along with IT has been the metal space. The 5 days now with the metals index has been underperforming. Of course, it has its own reasons. Yes, the firming up of the dollar, fears of a rate hike as well from the Federal Reserve. Do you believe that the best for the metals is over, at least for this year, considering the geopolitical scenarios or the global headwinds that are playing, even though the underlying fundamentals may remain strong, but factors beyond their control are not working in their favor?
No, I think that's far from it, because this 4-5 day correction is barely a pullback to the gains that you saw from the April bottom, and the metal sector has been in a bull run for more than a year. So if you actually take a 1 year performance, I'm sure the metal index, in fact, the data is in front of me, it's up 35.4%. So it is still the best performing sector of the year on a 12-month basis, followed by PSU banks and pharma. So I don't think the leadership is really changing. This is just a correction, like you said, because the dollar bumped up a little bit, because oil went up, or more than oil, I think bond yields are the ones that have been the scare factor for the dollar, which has caused the metal correction. But it's a correction which is coming after a significant gain that we saw from the bottom in April. So I would see it just as a normal routine pullback within what is going to be a bull market for the commodity cycle for years to come. This is not something that's going to end in a short period of time.
Rohit, has the view changed fundamentally in the last week? I think the last time you were in CNBC, we were talking about how clients are still looking for longs in metals. You were talking about staying away from IT and buying pharma on pullbacks. With all of these measures that have come in, some of the rate-sensitive sectors as well, has the view at all changed?
I think the view is constructively changed to a very strong bullish outcome. Barring a few sectors, IT, like you mentioned, is one of them. FMCG, I would generally avoid more because they tend to underperform during a growth phase. And there's also the case that, when I talk of the commodity cycle, what you're going to see maybe in the second half of the year is to some extent strengthening in, agro commodity prices. I don't know how that plays into the FMCG space. A lot depends on how they can pass on. So barring, I think, these two sectors, I would find a lot of opportunities in sectors other than, these two, which I can just avoid. And financials being one of the leadership signs, because if you're seeing a market rebound, then financials start that rebound. I think the reason for concerns which are there before, which have been, I think, significantly addressed with the recent RBI measures, was around, the bond and currency markets. I think those are the ones that played spoilsport. And for now, I think 97 is probably the top for USD INR. I don't think that the USD INR is going to go up any further from there now for the next 6 months. And if we are lucky, maybe 12 months. 6 months is almost certain given the flows we get through this FCNR route. And then possibly if the GSEC, bet really plays out, which I think it should, then you'll have two things happening. One is the sheer flows you can get in a bond market can stabilize not just your currency, but it can actually help bringing down bond yields in general over a period of time. Now, when you do that, then you're looking at interest rates starting to come down, which means 7.15%, which was the high that we've seen twice at least in the last couple of months on the 10-year GSEC, would end up again becoming a top. So you'll have two tops here, 97 on the rupee, 7.15% on the bond yield. And as both of them head down, which means you have a stronger bond market, you have a stronger rupee, that both of them really aid the entire investment cycle for months to come. So that is why I think meaningfully something has already changed in the macro. The market is just taking its time to discount it, probably because of the deviation in earnings between large caps and mid caps, where large caps are still growing at single-digit earnings, and the mid and small caps are below the surface. Growth is in double digits.
Pleasure having you as always, Rohit. Thank you for sparing time and joining us. Looking forward to the next conversation. Take a short break, put the spotlight on the macros, and get chatting with Madan Sabnavis on the other side. Stay tuned. Welcome back. Well, the index continues to move to the day's high now, 150 points higher for the Nifty. A good time to get in a quick chart check as well from Jay Thakkar of ICICI Securities. Jay, good morning. Thank you for joining in. And now with that 23,070 level firmly held by the index and now moving higher courtesy the banking stocks, 23,500 looks easy to conquer, or is there still some resistance that you can find at that level? Your call on the index and your stock recommendations as well.
Good morning to you, Hormaz, and I would say that, 23,500, 550 looks quite achievable, I think, Hormaz, with the kind of breakout which we have seen in Nifty coming today. In fact, it has formed a good base around the levels of 23,000 to 23,100 levels, wherein, if you look at the cumulative OI on the put side for this entire series, then 23,000 any which ways had the highest put base, and it did respected it quite well, took support around those levels, and here we see that it has taken off 23,200, 250. On the expiry day as well, it managed to close about 23,200 levels, and today we are seeing the follow-up of the same, indicating that 23,500, 550 range, Hormaz looks quite achievable, and I would not be surprised even if those levels are taken off and Nifty eventually is heading towards 23,800 to 24,000, which is my short-term target for the June series. And particularly why? Because the kind of reversal we have seen in Bank Nifty, which was outperforming the overall market since past couple of trading sessions, we saw that Bank Nifty broke its previous swing lows and Bank Nifty did not. And the Bank Nifty eventually has taken off 55,000 on a closing basis, wherein it had a huge call base. So above these levels, I think 57.5, 58,000 looks quite likely for this series. Since BFSI segment, which was the weakest, since that has reversed, I think Hormaz's overall outlook in the short term remains positive. And if you look at the India VIX, that has cooled off again. It's sustaining below 16 levels, 16.5 on a closing basis, and the crude oil price is also sustaining below 100. So all of this combinedly, indicates that the overall trend is positive, and hence I have a couple of buy recommendations. One is on the banking pack, and I have a buy recommendation on Kotak Bank at the current levels of 390. I think Kotak is likely to inch towards the levels of 410 with a stop loss of 379. One can go long on Kotak Bank for the short-term uptrend. The second buy would be from the FMCG pack. We've seen that FMCG index is trading quite well with a positive bias today. So Nestle, as a disclaimer, we had recommended this to our clients today, but then it can be bought at the current levels of 1444, placing a stop loss below 1390, targeting around 1550 to 1600 going forward. The final buy recommendation I would be having is on Bajaj Finance from the financials. I think that overall banking financials are likely to do quite well. And Bajaj Finance also from the current levels can bounce back to the levels of 920. So this can too be bought at the current levels with a stop loss of 875.
All right, Jeff, thanks very much for joining in with that. Now it's time to get you the macro signal for the day. And today we're going to be talking about the CapEx spend. Now, FY26 was hardly an ideal year for corporates to expand. They had to, of course, contend with the tariff uncertainty. There was disruptions from the West Asia conflict towards the end of the fiscal. There's slowing global trade and an overall uncertain external environment. Yet, there is this new Bank of Baroda study which covers more than 2,300 listed companies, and that shows India Inc., despite all of this, continued to invest. Gross fixed assets, which is a proxy for corporate investment, rose 5.8% in FY26, but that was slower than the 7.4% growth that we saw a year earlier. More importantly, the spending was concentrated in a handful of sectors rather than spread across corporate India. So the fastest growing sectors were not really export-oriented industries and traditional manufacturing giants. It was trading companies, which includes your wholesale distributors, supply chain operators, commodity trading businesses. They led the pack with an asset growth of 33%, followed by electrical equipment at 30% year-on-year, infrastructure at nearly 20%, retail at almost 18%. Now, this report also finds that trading was one of the key drivers of growth as services activity remained strong, while retail expansion and government-led infrastructure spending continue to support investment. So in other words, Companies are investing in warehouses, in distribution networks, etc., and consumer-facing infrastructure rather than building new manufacturing capacity. Now, at the same time, several heavyweight sectors remain surprisingly cautious. So telecom investment was virtually flat year on year. It saw almost no increase in assets. Power sector investment, that grew just by 1.6%. Autos only by 3.1%, which shows that India is not really witnessing a broad-based corporate investment boom. The macro signal is that India's investment cycle is being powered primarily by domestic demand. So companies linked to retail expansion, services activity, infrastructure and distribution networks are spending. But sectors that are facing weaker demand visibility or global uncertainty, they're still holding back. So in other words, the capex cycle is pretty much real, it's happening, but it is very selective. So unless we have sectors like telecom, power, autos and IT join the party, difficult to call this a full-fledged private investment boom. For more on this and all things macro, let's bring in Madan Sabnavis, Chief Economist at Bank of Baroda, who is joining us on the show now. Mr. Sabnavis, thanks very much for your time here. And let me begin with that report itself. Do you see government capex continue to do the heavy lifting? And apart from, of course, the global uncertainty, what's holding back the private capex cycle and how do we start FY27? What is the coming year looking like?
Actually, if we look at the overall investment trends, I think the last couple of years, it's always been a case of saying that there are certain sectors which are spending and others which are not in terms of investment. Now, the reason is quite clear. We need to have enough demand. So whenever we are talking of the government spending, that is the government's capex, there's obviously a backward linkage with certain sectors like infrastructure and capital goods. So that's what we're actually seeing, where when we're talking in terms of higher growth in capital formation in these particular sectors. A similar thing also holds if we're looking at the housing sector, probably doesn't really come out too much in the Q4 numbers, but yes, there has been a case of saying that with the kind of boom we have seen in the housing in the last 3-4 years, there has been a tendency for backward linkages to be forged with indices such as steel and cement. But I think the missing piece really is on the consumer side. So I think we have been talking almost every year for the last 3 years again about consumer demand being fairly uneven across the urban and rural areas. So that's why we see things like FMCG has not really shown that kind of buoyancy. And I think this is going to be the tendency even in the coming year, because last year we had a tariff issue, and that's what you have highlighted, or what our report also shows, that anything to do with exports was going to be very cautious. If you look at textiles, for example, we do not see too much of investment taking place. And I think this kind of a picture is going to be replicated in 26, 27 also. But if I just go back to the GDP numbers which we saw, and we look at a gross fixed capital formation number, that actually shows a fair amount of resilience at around 32% of GDP, which means that while we do tend to talk a lot about the government spending, doing the heavy lifting, but actually it's a private sector which is doing most of it. And within the private sector, of course, it's not going to be evenly distributed. There are going to be leads and lags. Certain sectors are going to be dragging it forward. Others would be slowing down. Because at the end of the day, it all depends upon the demand conditions which need to evolve. And just a last point on this, we should remember that whenever the government spends, it spends because it has to spend. So the 12 lakh crores of capex is something which can be incurred whether or not we really have a positive return on capital. Whereas when it comes to private sector investment, they're answerable to shareholders. You can invest only in case you are sure that you're going to make money on it and you're able to justify it to your shareholders. So I think that's the actual difference between private sector. So it's easy for us to say the private sector should invest, but they will invest provided they've reached the optimal capacity utilization rate, and they're able to generate additional revenue so that you show the profit at the end of the day to your shareholders.
Madan, the part about the numbers is that they have been reported and it's now in the past. The fact that there are challenges that lie ahead for the economy. Of course, the good bit is the fact that the oil prices are cooling off from 120. We are now at 90. But the other challenge is something that's beyond our control, and that's the monsoon. Are the growth estimates, the RBI cut the GDP growth forecast from 6.9 to 6.6, yes, but are the growth projections still underestimating the extent of the weakness in the monsoons that we are likely to see this time around?
At this point of time, whenever economists make any projections of GDP, we do assume that the monsoon is going to be subnormal and there's going to be some kind of an impact on overall agricultural growth. So that's how we come to estimates like we now have a number between 6.4 and 6.6. But this is premised on the fact that agriculture will be growing around 2 to 2.5%. Earlier, we thought it would be around 2.5 to 3%. But as the monsoon sets in and progresses, we'll get a clearer picture about what kind of distribution is seen across the country and which crops are probably being affected or not being affected. And then there will be the final numbers coming out. So to my mind, a certain bit of negativity would have been already taken into account when the RBI came up with a number of 6.6%. But a final evaluation will probably take place more towards September, October, when there's a clearer picture about what has been the disturbance caused. Because we have seen that a subnormal monsoon does not necessarily mean that we're going to have a drought and the kharif crop is going to be down to a significant extent. But definitely we have seen that the subnormal monsoon affects specific crops, especially things like pulses and oilseeds, which could have wider ramifications more from the point of view of inflation rather than overall GDP growth.
Mr. Sabnabis, let me then get to some of these measures that have recently been announced from RBI and the government. As far as forex inflows are concerned, that bazooka measures from RBI on Friday, and then more importantly, the operational guidelines showing that banks can offer leverage on FCNRB. Hedging costs will be fully absorbed, and also that banks, along with PSUs, can also go ahead and raise these ECBs. With that change in mind, what is your own estimate? What kind of inflows can we see? And what does that mean for our balance of payment situation in FY27? Will it offset any kind of shortfall we would have seen otherwise?
I think these are very positive steps which were announced probably at an appropriate time. In fact, personally, I was not expecting these kind of announcements in a credit policy. But I think the RBI and the government have gone all out to make sure that the three missing links which are there in terms of our capital account have been addressed to the extent that you can do it through policy. So if you actually look at all the three pieces, one is the FPIs, the kind of concessions which have been given on the taxation front, which has, of course, been a sore point for them. And second, in terms of the ECBs being kept for the PSUs, where the RBI is going to swap it at 1.5%. Here, I thought that what came as a surprise was it has been restricted to PSUs. Actually, ideally, it should have been done for all companies. But that would have been a big bang, because what we have seen is that we get around $40 to $60 billion in the last 2 years in terms of ECBs. The public sector share has been around 20-25%. So the majority of it actually comes from the non-public sector. So probably the RBI could probably look at it at some point of time. And the third has been in terms of the FCNR deposits, which I think is the big bang reform which has been introduced. Now, how much are we going to get through all this? To my mind, we should be a bit moderate in terms of our estimates. I think at the best of all three working out would be more in the region of around $40 to $50 billion. Now, is $40 to $15 billion adequate for a balance of payments? The answer is yes. Definitely it would be, because we were working on the fact that the foreign exchange reserves would probably come down by another $20 to $30 billion before these measures were announced. Now, when we're talking of this 40 to 50 coming in, even if you get, say, $35 to $40 billion, we're actually saying that the balance of payments will be in the positive territory rather than the negative territory. So what does this mean? This will actually mean that this will provide a lot of support to the currency. So there may have to be less intervention on the part of RBI. And more importantly, I think as far as the speculative element or the volatile element, which we keep talking of whenever we talk of currency, is something which will come very much under control on account of these measures, because this is something which is going to flow in over the next 3 to 4 months. And depending upon how these inflows work out, I think the currency would also be guided to a large extent by this factor.
All right, Mr. Sabnabis, thank you very much for taking out the time and joining us here today to help us understand the significance of some of these measures. Time to get into a short break, but up next we'll get you more on the markets, so stay with us. trading hour, we had metal recycler CMR Green, which got a bumper listing on the bourses. The shares have debuted at more than 40% premium. Nigel D'Souza is here to put it all into perspective. Nigel, quite an exciting IPO, this one.
Well, that's right. CMR Green Technologies blockbuster listing is what we have seen, and the grey market premium was indicating, a good listing, and the listing is as good as what the grey market premium was indicating. Now, a few factors have played out here. One was in terms of subscription. The overall subscription was oversubscribed by around 127 times. But I'll tell you what, the QIB portion of the issue was oversubscribed 270 points. That's tell you the kind of interest that was there for this particular issue. Point number two is it's priced attractively. So if I take a look at it on a trailing earnings basis, well, even after this 30-35% up move that we're seeing on listing day, it's still trading at a bit of a discount in comparison to some of its peers, the listed peers, that is. So the pricing was attractive, and that's where we saw so much of demand. And you'll say maybe scale is not as much. No, that's incorrect. Because in fact, in terms of scale, if I look at the aluminium recycling capacity, that's around 4.7 lakh tons per annum. Well, the management goes on to say that they are nearly 4 times its nearest competitor. So it's larger and yet priced at attractively or at a bit of a discount in comparison to its listed peers. Finally, ahead of the IPO, we had the management that joined us here in CNBC TV 18 studio, and they gave us the guidance. They said that margins will gradually improve from here on. They're saying that the ROCE as well will be in line with peers. And in terms of funding, they say most of the expansion will be done via internal accruals, and they don't see any kind of risk with regard to most of their sourcing that comes in from the United States. So put everything together, good subscription, well priced, and business model as well appears fairly attractive with a large scale as well. All that, put it together, it explains why the stock has ballooned up on listing day, up more than 30-35%.
35% higher from its issue price, a successful IPO in a volatile market. Nigel, thank you for putting that together for us. Take a short break, back with more on the markets on the other side. 150 points higher on the index. The car trade tech has seen some spurt over the last 60 minutes. At one point was up even 9.5%. They're still holding on to gains of around 7.5%. So top gainer on the Nifty 500 is car trade tech. Domes Industries has sprung up on the list of gainers, 4.5% higher on that as well. Kaplan Point, of course, US FDA drug approval. The stock is now moved up around about 5% as well. Look at Aditya Birla Sun Life AMC. That one for a very long period of time struggled below its issue price of around 740, now trading well over 1100 rupees, so 4.5% higher on that stock as well. Take your leave on this edition of Trading Hour. From Ritu and me, thank you for watching. We leave you with the markets at the highs of the day. Halftime report takes the action on the other side.
Indices climb powered by heavyweight. It's even as a broader market trend turns negative. FMCG, healthcare are prominent gainers, while metals and utilities drag.
Reliance will develop Meta's first build-to-suit AI data center in India with an initial capacity of 168 megawatt at Jamnagar. Reliance will manage end-to-end lifecycle services at this renewable energy-powered AI computing facility for Meta.
Mutual fund equity inflows in the month of May dipped to the lowest in a year, with a decline across large cap, mid cap, small cap funds. Even the SIP inflows see a decline versus April, but the tally is still a healthy rupees 30,000 crores. AMFI attributes the May dip to volatility.
Gold sees a sharp drop to under $4,200 per ounce, slipping below its 100-day average as a strong dollar and expectations of rising inflation weigh. Stocks of Indian gold loan providers sulk on the sharp drop.
Brent crude sees a sharp drop in prices to under $92 per barrel after US ends its defensive strike following the downing of its aftershave by Iran. US Energy Secretary comments on the meaningful rise in traffic via Strait of Hormuz aids the decline.
Hello and welcome. You're tuned into Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vinny Motiwala. Vinny, good afternoon. It's all about heavyweights today. The broader market's not participating much or at all because the Midcap index is underperforming. As we speak, the Nifty is at the day's high. It is at the 23,395 mark. It is the FMCG pack which is doing well. So the likes of HUL, Nestle, a lot of contribution coming in from the Bank Nifty as well. And that is charging the markets ahead. The mid-caps, though, under pressure, 114 points lower on that index. But we are seeing this participation come from many sectors for now. Bank Nifty continues to outperform as well. Let's see which way things go.
Absolutely. Hi. Afternoon, Sonal. So absolutely, we'll have to see which way things go. Like you mentioned, the broader end of the market is more under pressure. And advance decline ratio, let's pull that up a bit more in the favor of declines versus advances in today's trading session. So let's watch out for that. But, we have Prime Minister Modi, who's completed 12 years. And we have a discussion lined up for that. And we have Prashant joining in us then.
I think we have Baba Kalyani joining us.
Yes, but you will take us through that conversation.
Well, 12 years of Prime Minister Modi as the government completes 12 years. Let's speak to somebody who's been the thick of all of it, right? Baba Kalyani needs no introduction. He's, of course, the head of the Bharat Forge Group. Mr. Kalyani, great to have you with us here. Thank you very much for joining us. Prashant this side. 12 years of the Modi government, and I was just looking, there are various ways to measure this, right? 12, and we've been putting out data in terms of how things have, but for Bharat Forge, I was just looking, I went back to 2014, and I looked at how your share price has performed. It's up 12 times, sir. So it's been pretty consequential, and I think you've participated, you would agree, in this entire Make in India push in a big way. I mean, back in 2014, we used to talk about opening up private sector in defense, which, of course, now is one of the fastest growing verticals for you. I mean, the entire non-auto segment has been built out in great degree with encouragement with regards to Make in India programs and others.
Yeah, absolutely. I mean, first of all, I'd like to express my heartfelt congratulations to the Honorable Prime Minister for completing 12 years. And wish him good health and all the very best for many, many more years to come. I think you're right. The biggest transformation India has ever seen in the last 12 years has been in the transformation in industrial and manufacturing landscape. Started with the Make in India process in 2014, then went on to the whole Atmanirbhar process where defense manufacturing was then open to the private sector. And the private sector started participating in a big way in defense manufacturing. And now we have come to a stage where even the 5th generation fighter aircraft is going to be made by some private sector companies. So I think that's a very, very great achievement that has been achieved by the Honorable Prime Minister's policy. Apart from that, the space sector has been opened. We have now 2 private sector companies, startups in space who are able to launch rockets in space. I mean, whoever thought 12 years ago that this will happen? So there is a lot of excitement. There is a lot of can-do spirit. And I think there is also a tremendous amount of, encouragement which has created a level of optimism in the 1.4 billion people that live in India, especially the younger ones. That's why you see all these startups and unicorns and everything happening in almost every field. So I'm quite excited. I wish I was 25 years younger. Would have done a lot more. But anyway.
Yeah. No, I want to just ask you to elaborate on that defense, because that's such a big part of you, and growth rates are pretty high. You're saying 40-50% growth you should see in the defense segment. I remember the last time we spoke to you. I mean, 12 years back, total defense exports out of were about 1,000-2,000 crores. They're expected to be between 25-30,000 crores now. But that is exports. But, there's import replacement has been such a big theme, right? Mr. Kalyani, and that ATAG order that you've got. So is this kind of unstoppable now, at least from a defense perspective, before we move on?
Earlier defense was more at a component level as far as private sector was concerned. You made some small parts, you made some spare parts, you made a little bit of ammunition parts, etc. But now we are making platforms. You're making, like ATAX is a platform.
Yeah.
And the most important thing is we are making platforms that are designed and built in India, which means it has Indian IP, whether it's designed by DRDO, designed by us, or designed in combination. I think that is the biggest structural change that we are seeing in the defense sector. And I mean, we have now got an order for carbines, the largest order Army has ever placed to any Indian private sector for making carbines for the Army. And we are beginning to see now a lot of interest from outside India of people who make small arms saying, can you manufacture small arms for us? So I think you're going to see a big explosion in this sector in the next 5-7 years.
Yeah, yeah. Mr. Kalani, so the base has been built, but do you think this is, the conditions are ripe, not just be a supplier to the Indian government, the forces here in India, but be a global supplier as well? We are there.
Absolutely. I mean, in our case alone, out of our total defense sales, almost 40% is exports. So, and we have got a lot more traction we are beginning to see from many different countries. So let's see how it goes. There's a lot of, Europe is rebuilding its whole defense industry. The US has started investing a lot more money in defense. We're beginning to see a lot of new technologies come in the defense sector. I saw just a few days ago in California, somebody has built a cruise missile using 3D printing, which is done at 1/10 the cost of a normal cruise missile. So there is some tremendous change taking place in this industry. And I think this will help Indian companies to get into this case. Only thing is, we need to make agreements with other countries so that we become part of their supply chain, which is not there today. So I hope this happens soon.
Yeah, yeah. Basically, government-to-government kind of agreements where then it facilitates the private sector to interact more freely and become, as you said, part of those supply chains. But there's always, and manufacturing, right? In that sense, but it's a global trend. Over the last 10 years, manufacturing has come back into the vogue in a very big way, and niche manufacturing, etc. And we are glad we have that coming up in a big way. It's being rewarded from a capital perspective, valuation perspective, which was not the case 10, 15 years ago. Now, Mr. Kalani, but in terms of what else needs to be done, what would you say, sir, from here on that manufacturing bit? Because you have the overall bird's eye view.
I think we need to do a little more on ease of doing business. It's still a little complicated when it comes to some sectors. So that needs to be sorted out. In the defense sector, also, the process needs to be made much simpler than what it is today. But I think we are getting there. It's coming. It's going to happen step by step, and we are getting there. I think the Honorable Prime Minister has put this as a priority in terms of what is required to be done. We also need to create scale, especially when it comes to electric vehicles. We need to create scale because scale creates the ecosystem that's required to create technology. And I think creating scale in many areas becomes very, very important. We have seen in the case of solar energy, what scale has been able to do. So I think that's important. And we have to move towards becoming a product nation. We can't just be a service nation. We have to become a products nation. And products that are designed in India, made in India, and sold to the whole world, including India.
Mr. Kalani, Bharat Forge kind of sort of earned its chops being known as the forgings and auto comp player, right, globally. But you do so much more now, and we spoke about defense for a bit. What other area are you most excited about? Because you've always sort of invested in R&D ahead of time and let demand grow into it. And this was true back in the day railways, defense, and other areas as well. Which other new area in manufacturing are you excited about?
Well, we are doing a lot more in defense, but you know about it already. The new area that we are working on is in semiconductors, not to make semiconductors, but being part of the supply chain of semiconductor equipment. That business is pretty large. It's in billions of dollars. And we are already working. There are only 5 companies that are in the semiconductor supply game, and we are working with 3 of them to see how we can make products for them and get into this supply chain. So that's going to be the big thing coming forward.
So this is companies like ASML, which is the largest.
These are companies like Lam Research, ASML, Applied Materials. These companies, and surprisingly, by the way, they all use metal parts for their equipments. And many of them are forgings. Some of them are specialized machine parts. So that's an area that at least we have got our eyes on.
So this is actual lithography, and I mean basically making the
It's not.
Okay.
Not making lithography, making the parts that go into a lithography machine.
Yeah, exactly. That's what I meant. I mean, basically getting into the equipment side of it, which is highly specialized. And as you said, there are only a bunch of players. So you're already moving ahead. You're talking to them for joint ventures, partnerships, that kind of thing.
We are moving ahead to become part of their supply chain, global supply chain.
So supplying to them.
Yeah, supply to them, and that's a very highly value-added product. So, but it's also quite complex, so it takes a long time to get validated in terms of becoming a supplier. But we are quite hopeful that in a year's time, we should be there.
Mr. Kalyani, as an industrialist, sir, do you feel a lot more confident in announcing large capital expenditure programs? I think you've announced one very large project in the east of the country. But as compared to where we were 12 years back, I mean, do you get that confidence?
Yeah, we are actually investing a fairly large amount of capex right now, even in our existing plants here in Maharashtra, in Baramati, for example. We are putting in the most modern facility for making high technology forgings, for making high technology machine parts for data center power backup systems. And that's more than 1,000 crore investment coming up. It'll be up and running by fourth quarter of this year. And we are gung-ho about this, because what we are finding is with technology changes, with AI coming up with full scale, there are so many new markets that are opening up which we didn't even understand before. And so many new products that we can make with the skill sets that we have, the knowledge that we have for the global markets. So we are quite excited about this.
Mr. Kalyani, before we let you go, I wanted to understand your take on the R&D expenditure in the country. It's just 0.67% of the GDP. The global average is around 1.79%. We do have some tax exemptions on R&D expenditure, which is given to corporates. Do you think more needs to be done to ensure that there's more motivation to spend on R&D? Where are we lacking when it comes to that, since you want us to become a product nation?
Yeah, you're right. I mean, I think we need to spend a lot more money on R&D than what we are spending. We as a company, by the way, spend a lot more than what you're talking about. But I think the government has also set up this new research fund of almost 1 lakh crore, which is going to start being used by the private sector for R&D. But that's one area. If you don't do R&D, if you don't do development, we won't become a product nation. It's as simple as that. So we are very clear that for us, if we want to make the products that we need to make, we need to spend more money on R&D, more money on product development, and more money on training people to be, let's say, digital ready, AI ready. And that's another big lacuna that India is going to face in the manufacturing sector, because in 5 years, your manufacturing sector has to be aligned with the rest of the world, with the ability to use AI in manufacturing, AI and digital in your design and engineering stuff, So I think there's a lot of work that needs to be done, but also a lot of people are taking steps to make it happen.
Yeah. You're absolutely right. But, the good thing is that R&D is also getting, and that 1 lakh crore fund is actually is very large, right? It's a 50-year loan, interest-free, made to the Department of Science by the Government of India, which then can be dispersed. And, the dispersal is through industry veterans, etc., and not through the government itself. So let's hope it kind of sort of kickstarts that R&D journey. On the R&D point, there's this one company out of the city that you're in, Pune, Sedemac. I'm sure you know those chaps, IIT Bombay kids who started this autocoms specialized company purely built on R&D, and the response has been amazing. But just one example, it came to mind as you said, and you talked about R&D. So, well, let's hope there's more of it. Thank you very much, Mr. Kalyani, for joining us. Great speaking with you. It's always a pleasure.
Thank you, Prashant. Thank you. Bye.
Thank you very much. Thank you. Well, I think that is the view from Baba Kalyani, one of the most prominent industrialists in the country. 12x on the Bharat Forge stock in 12 years. So manufacturing certainly is back. We'll take a quick commercial break here and we'll connect with Pranav Haldia on the other side of Prime Database. We talk about IPO performance this year so far. We'll talk about what's happened, of course, the pipeline going forward as well. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Nifty manages to still hold on to that 6/10 of 7/10% of a gain. 23,390 around that mark is what the Nifty continues to trade at. But let's shift focus on India's IPO market that has hit breaks in early 2026. Listing activity has slowed down, but investor interest remains intact. Hormaz is here to decode the performance in 2026 so far. What's happening there? Hormaz, over to you.
Well, after two record-breaking years, both in 2024 and in 2025, unsurprisingly, the IPO activity this time around, at least in the first 6 months of the year, has been relatively subdued. We had just 21 issuances that have been completed so far. But, well, call it market volatility or call it the law of averages. But even those who have dared to venture into the public markets in a volatile market like this, well, for most of the investors, well, they have not been disappointed. At least out of the 21 that have been completed so far, 18 are trading above their issue price and only 3 of them are trading below that. You take a look at some of the best performers out of these 21, Shadowfax Technologies and Bharat Coking Coal. Of course, Bharat Coking Coal was the first IPO of the year. It almost doubled from its issue price right at the time of its listing, around about 70-75% returns from the issue price. And One EMI, of course, a recent listing, that too has gained around about 65% from current levels. On the flip side, though, the only 3 names that are trading below their issue price were very small IPOs with 100 to 400 crore in size and not too much subscription on the subscription front. Shriram Twistex happens to be the one that has seen significant retail subscription. That one's down 60% from its issue price. Innovision and Amirchand, of course, the recent listing again down about 40% from its issue price. The interesting bit is that in line with the market volatility, the retail investors have chosen to exercise a lot of caution in these IPOs. Out of these 21 IPOs so far, 10 of them have had retail portions that have been undersubscribed. And it's not as if they were subscribed 80% or 90%. Some of these IPOs have had retail interest of as less as 10 to 12%, if not more. And only 3 of them have seen retail bids exceeding 10 times the total number of shares that have been on offer. Of course, the pipeline for IPOs remains a very large one. Zepto just filed its DRHP, the updated DRHP for its IPO. We'll get to that in just a bit, but there are some triggers, of course, that lie ahead as well. Of course, the fact that the new recent listings will be reporting their results, shareholder lock-ins will end as well for a lot of these companies. The one that ended for Meesho as early as today. Keep an eye out on how these stocks perform after their shareholder lock-in ends. And of course, the major IPOs that are still in the pipeline. You heard of Zepto, NSE is in the pipeline as well. There is Oyo that's in the pipeline. There is Hero FinCorp, Prestige Hospitality, a lot of such names that are in the pipeline, yes, but their arriving on Dalal Street is subject to when the market stabilizes and, more importantly, when the situations around us stabilize.
Okay, so the important point is that retail investors have become more cautious and they are showing a much more resilient or at least thoughtful money in these IPOs. Thank you so much, Hormuz, for that. To discuss more, we have Pranav Haldia, MD at Prime Database Group, joining us now. Pranav, good afternoon. Thank you so much for joining in. You heard, Hormuz, the situation or the performance that has been so far for IPOs, the pipeline as well. How does it differ from what we've seen in the years earlier? Some of them did see an IPO boom. Has that come down a little bit? Is the sentiment more somber? What do you make of that?
Well, for sure. The mood is very different from what you saw in calendar year 24 and 25, as Hormaz just clarified as well. We have to be very clear that IPO market always follows the secondary market. And, the kind of volatility that you've seen in the first 6 months of this year on account of various geopolitical issues, these are not ideal grounds for IPO activity to really pick up. Even as far as the pipeline is concerned, if you look at the data, we have nearly 250 odd companies looking to raise 4 lakh crores. But several of these companies are waiting on the sideline and not launching. The reason for that is very simple. For a company, an IPO is a once in a lifetime event. And, ideally companies would like market conditions to be ideal when they, go ahead with their IPO. So you might see a few issues coming here and there. In May, for example, you had 0 issues. No issue got launched in the month of May. June, you've had a couple of issues which have announced. But I think for some significant traction to build, we need some stability to return to the secondary market.
Absolutely, we'll need some stability to return to the secondary market. Pranav, good afternoon. But we have some big names in the pipeline as well, right? So then does that also cause a delay? NSE, Zepto, Oyo, all of them are there in that pipeline on the sideline right now. But is it now time, at least H2, FY27, things settle down, then we could see them coming in and better traction in H2?
I keep on joking that for whatever reason, the first 6 months of the calendar year have not been very good for the IPO market. If you look at the last 5-6 years, initially you had COVID in 2020 and 2021, then you had the Russia-Ukraine war. Last year you had all the tariffs which were put in place by US. And this year, of course, whatever you've seen in the first few months. So the hope is that, like in previous years, the next 6 months see a lot of action. But, like I said, that for large issues to happen, you need significant participation from foreign investors. Smaller issues which, you can classify as sub 1,000 crores, given the heft of domestic institutional investors now in India, you can still see a lot of them going through just with their support. But for larger issues like the ones that you mentioned, you will need foreign investor support. And I think, for that, some of these major concerns geopolitically need to be, slightly addressed.
Okay, so it is not looking so exciting for IPOs ahead. But Pranav, if you had to talk about some sectors which are doing better than the others in terms of interest from investors or generally in the pipeline, which one would those be?
No, I think if you look at the last, the data for the last 2 or 3 years, you've seen actually a completely secular supply of companies. On one hand, you've got these new age technology companies, some of them which you mentioned as well, which are typically private equity and venture capital backed. At the same time, you've seen your traditional industrial manufacturing, promoter controlled, promoter owned small businesses, family owned businesses, which have also come to the market. So you've seen, a wide variety of, you've got new energy, clean energy, which you've seen significant traction for. So I think one big change over the last 2 to 3 years has been that, companies across the board, in fact, MNCs as well, I forgot to mention, you've seen a lot of MNCs and their subsidiaries coming to the IPO market. So unlike the late 2010s, when, you would typically find that the IPO market was dominated by companies from BFSI, which is banking and financial services. Over the last 2-3 years, in terms of both the issues launched and also if you look at the pipeline, you will find that there's a lot of diversity in terms of the sectors that they belong to.
Absolutely, point taken there. Surely we are seeing interest change from the retail investor participation point of view as well over the years. But, Pranav, there's one thing is that these recent listings that have come in, right? Lock-in period ends now. That's when you see the move coming in on most of these names as well. Could we expect maybe some bit of an overhang here and overall, given the current scenario?
Well, interestingly, if you look at the historical data in terms of, the returns which IPOs have given, after all the lock-ins have expired, whether it's anchor or for promoters, you still find that as a group, if you look at the average gain, IPOs have given, double-digit, triple-digit returns till date. So, for example, IPOs which got launched in calendar year 2020 have given an average return of 356%. In 2021 have given 135%. In 2022 have given 67%. So despite all lock-ins expiring, despite all the volatility that you've seen, as a whole, as a cohort, you've seen that IPOs have given net positive returns to investors.
Okay, all right, take that point. A lot more to discuss on this. It's always an interesting discussion, but out of time today, Pranav. But thank you so much for joining us with your insights on what's happening with the IPO market. Most importantly, what the outlook could be for some of these names. Time for a break now. Manish Hatirumani of Deen Dayal Investments will join us with some trading strategies on the other side. Stay tuned. Welcome back. You're still tuned into Halftime Report. The underperformance in the mid-caps continue, but the broader but the headline index it continues to be higher. So let's get Manish Hathiramani, proprietary trader and technical analyst at Deendayal Investments, joining us now. Manish, good afternoon. Thank you for joining in. Do you expect higher highs on the Nifty moves today, or we could consolidate at these levels? What are the important levels to watch out for?
Good afternoon, Sonal. Thank you so much for having me on the show. Well, last week when we spoke on the same show, we did discuss about this support range of 23,100 to 23,150. We have bounced from there. However, in order to really move up, I think we need to cover some more ground. It is my view that 23,700 is a very stiff resistance and an important resistance which needs to be taken out for the markets to turn positive for the short to medium time frame. If we can manage to get past that on a closing basis, we can see 24,200 as the next possible target. However, 23,100 continues to be an important level of support.
And, Manish, what are the individual names that you're tracking?
I'm working with two buy calls because of this current bounce that we are seeing. The first one is on ICICI Bank, which is for a target of 1350, stop loss of 1240. Among the banking names, this stock seems to have a clearer short-term direction on the upside. It is almost nudging at the recent intermediate highs of 1302. Good volumes have supported the stock around the levels of 1250. The second is on SBI for a target of 1065, stop loss 935. Similar structure like ICICI Bank. Good volumes have supported it around 940 to 980 levels, currently trading above the short-term intermediate highs of 978.
All right. Okay. Manish, thank you so much for joining us. So those are some technical picks and the next important levels to watch out for on the Nifty as well. Time for a break now. On the other side, Manisha Gupta joins in with Prakash Naikan-Navre of India's National Sugar Federation. Stay tuned for that.
Welcome back, and joining us on the show now is Prakash Nakanavre. He's MD at India's National Sugar Federation. Mr. Nakanavre, hi, thank you so much for joining in. While the industry is rejoicing E85 and the fact that a couple of companies have now launched flex fuels, but there are a lot of concerns on the background. Flex fuels for itself, for example, the GST rationalization, till that doesn't happen, those cars are going to be costing a lot. But then apart from that as well, whether it's about price revision or it is about the kind of arrears that are accumulating as well, how are you looking at all of that? And you recently have had a very good meeting with a group of ministers. If you could give us a sneak peek into that as well.
Yes, good afternoon, Manisha. Thanks for calling me in this live interaction. Let me give you a little background. On 23rd March, almost more than 2.5 months ago in Mumbai, the Maharashtra Chief Minister had held a meeting to discuss about the issues being faced by the Maharashtra sugar sector. Okay. Now, in that meeting, it was decided that the Government of India related issues need to be taken to Delhi, and he offered to lead the delegation. But in between, what happened? The 5 state elections were declared. And add to that, Maharashtra faced a turmoil on onion issues. So the club effect was that on 27th May, finally, this meeting took place in Delhi. It was a joint meeting of sugar and onion. This meeting lasted for almost 1.5 hours. Food Minister, Honorable Prahlad Joshi ji, and Agriculture Minister, Honorable Shivraj Singh Chauhan ji were also present. Honorable HM was in the chair. All the Government of India related secretaries, like Food Secretary, Agriculture, Cooperation, Petroleum, they were also present there. And Maharashtra's Chief Minister, 2 Deputy Chief Ministers, and almost 12 senior ministers and almost all the concerned senior secretaries from Maharashtra were present.
All right.
Out of that 90 minutes, the sugar issues were very effectively discussed. So all the pending issues like upward revision of sugar MSP and sugar-based ethanol prices, then equitable allocation of ethanol between sugar and grain industry, then rescheduling of outstanding loans was discussed, and then CFASU like new loans availability, and then the SDF loans, there is an OTS scheme. So the penal interest has been waived, but at least 50% of the principal interest saving, that was another issue discussed. A new issue came up there was introduction of dual pricing. Issue, keeping the 2 different prices for industrial use and consumer domestic use.
Okay.
Then bringing 100 plus tons units of jaggery under sugarcane control order, etc. were flagged. Now these issues were flagged by all the stakeholders who were present there. Honorable HM took note of all the points, Manisha ji, and he touched upon each point in his concluding remarks. That was quite heartening. And he assured to revert back with decisions within 10 days.
Okay.
So, so the waiting is on.
10 days are done. Mr. Nakanavre, I want to come back to you on the dual sugar pricing, as you said, for industry and customers. If you could elaborate on that.
The almost 60-65% consumption is industrial.
Correct.
And therefore, the major consumer is industrial buyer, and he gets the benefit of the current retail price. So our submission there was that let's keep 2 different prices. Now, all these years, this was not being very seriously discussed, considered, because there were chances of black marketing taking place here. But we.
All right, we'll try and get Mr. Nakanavre back, but that was an interesting point that he was making, that we are talking about dual pricing right now, where 60% of domestic sugar clearly is consumed by HoReCa and industrial in packaged foods, etc. And 40% of overall sugar is used by households, that is consumers. So dual pricing earlier was talked about, that industries perhaps would get sugar at cheaper level, but as he said, that perhaps could lead to black marketing. So that is a point that is being put forth very, very strongly. As Mr. Naiknavare was also telling us that the Home Minister did say that he would revert in 10 days and the meeting was on 27th of May. It's nearly 9th of June right now, so that wait is still on. And the other thing clearly has been about the ethanol and the sugar price revision. Remember, it has been 3 years that we haven't seen ethanol price revision, and sugar prices last time was revised in 2019. So that has been a very, very long time since the sugar prices also have been revised. So even as we are talking about ethanol and ethanol coming in from sugar and grains as well, but both of these and the prices is something that the street still awaits. But as Mr. Naiknavare has told us that the wait is still on. It has been a great meeting led by Maharashtra CM, but we still are awaiting details on that, on what steps does the government or the group of ministers actually takes on to that. Well, with that, we'll go for a short break, come back and talk about the crypto markets.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back, and it hasn't been such a great month of June starting for crypto markets there, because we've seen some more outflows continuing on to that one. If you look at the first week itself, well, it has been $1.72 billion that have gone out of the crypto markets. The US spot Bitcoin ETFs and Ethereum ETFs also have seen a decline of nearly 173 million coming in for that one. And if you look at the last 1 week, it is a sea of red for cryptos. Bitcoin fell 4%, Ether more at 10%. Binance is down by 5.5% as well. it doesn't stop there because you have Cardano, which has declined 19%, Solana's down 10%, and Polygon down 18% in the last 1 week itself. But while the cryptos have been declining, there is strong news flow when it comes to the technology itself. Strategy as a company has acquired 1,550 bitcoins for $101 million, bringing the total holdings now at 845 to 56 bitcoins there. Apart from that, there is good news coming in from UK, where new rules for mutual funds now allow them nearly 10% exposure in crypto exchange traded notes. Apart from that, even bigger news coming in for crypto is that FIFA has named Kraken official cryptocurrency exchange as a partner for 2026 World Cup therein. So Kraken clearly has been doing a lot of cracking work, and this clearly adds to that list there. And then apart from that, a couple of companies like A16Z and Paradigm are going to be co-leading a $175 million funding round into Morpho to expand the decentralized Wall Street private credit structures. There has been strong number going for that as well. And then Ethereum also is preparing for systematic hard fork upgrade, which is called Glamsterdam. Now, Glamsterdam, what it does is that it introduces Enshrine Proposer Building Separation, which removes the third-party infrastructure dependencies designed to lower the transaction volatility on network therein. And you also have MetaMask, which is launching MetaMask Agent Wallet, which will provide you a new self-custodial infrastructure therein. And finally, even as the cryptocurrencies and altcoins have been declining, Zcash has been increasing, and that is because they're coming out with an upgrade which is called Ironwood. This is scheduled to go live in July. So a lot of news coming in for blockchain technology, and that in turn, of course, could be supporting prices going forward.
It could be Glamsterdam.
Totally.
So glamorous. Okay, Manisha, thank you so much. Some interesting news there about mutual funds in the UK, looking at crypto investments as well. Well, that's your daily dose of the crypto world. Let's slip into a short break. We'll get you more on the stocks and markets on the other side.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back to Halftime Report on CNBC TV 18. As of now, like you can see, the Nifty from when we started the show has come off a slight, but still holding on to gains of 6-10%. Broader end of the market continues to be under pressure. The Bank Nifty, that's holding on to good gains in the trading session of 4/10 to 5/10%, but slight bit come off from that day's high, or at least from when we started the show. So that's what we'll watch out for. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Indices climb powered by heavyweights even as the broader market's trends turns negative. FMCG and healthcare are the prominent gainers while metals and utilities drag.
Reliance will develop Meta's first build-to-suit AI data center in India with an initial capacity of 168 megawatts at Jamnagar. Reliance will manage end-to-end lifecycle services at this renewable energy-powered AI computing facility for Meta.
Mutual fund equity inflows in May dipped to the lowest level in a year with a decline across large, mid and small cap funds. Even the SIP inflows see a decline versus April, but the tally is still a healthy 30,000 crore rupees. AMFI attributes the May dip to market volatility.
Gold sees a sharp drop to under $4,200 per ounce, slipping below its 100-day average as a strong dollar and expectations of rising inflation weigh. Stocks of Indian gold loan providers sulk on the sharp drop.
And oil prices see a sharp drop into under $92 a barrel after the US ends its defensive strike following the downing of its Apache helicopter by Iran. The US Energy Secretary's comments on a meaningful rise in traffic through the Strait of Hormuz aids the decline. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. You know, the Nifty back near the high point of the day, right? The bank's doing well. It's only the Midcap index that's sulking in trade.
It's been a little choppy over the last few minutes, although the start of the trading session was on a positive note. And the bulls would be happy that every intraday dip that the index has received today has been bought into. Unlike other sessions where we end up usually giving up those gains, the dip that came in at 9:30 was bought into. The dip that came in at around 12:30 has also been bought into. The Nifty Bank doing well for itself in today's session as well, contributed to the gains yesterday, doing a similar pattern in today's session as well. Of course, nearing the mark of 55,500 now, and in this index too, the dip that has come in intraday has seeing buying interest at lower levels, although the one stock that was contributing to the gains earlier in the day has fizzled out as the day has progressed, and that is Reliance. At one point, the stock was down up around 2.5%. It's now trading at the flat line, giving up all of its gains since that announcement came in that partnership with Meta for the Jamnagar data center. But overall, the bulls would be happy for the fact that the dips are getting bought into. The next level on the Nifty to watch is 23,500.
Absolutely, Hormuz. And if you take a look at the sectors, the FMCG pack is leading the gains. HUL, ITC, Nestle, all of them up over 1%. Private banks also having a good run today. ICICI Bank, Axis Bank, and Kotak Mahindra Bank, if those charts come up on the screen for you, you can see are up over 2%. But on the downside, we have those gold financiers falling on the big fall in gold prices globally. Muthoot Finance and Manappuram Finance, both of them down. Muthoot down over 3%, Manappuram Finance down over 4%. And it's the metal packs that are metal pack that's continuing to lag, falling for the fifth straight session. Hindalco, Hindustan Zinc, and Nalco, all of them down over to between 1% and 3% in trade as we speak.
The other big news point of the day has been the mutual fund data that came in for the month of May. Vinny is now here with more on this. Vinny, is a sharp drop in equity inflows for the month of May. Tell us more on that.
Hi, good afternoon. Absolutely right. We're seeing a bit of a drop that's coming in terms of the equity inflows for the month of May. Obviously, cautious stance seems like that's what is coming in from the investors. 22,897 is what the equity inflows stood at, which is a 40% decline. So this is the lowest level that we've seen, or the weakest equity flow that we've seen coming in over a year. So that's a big number there. Moving on, what is impacting it? Like large cap funds. Asset under management, that's managed at 81.58 lakh crores, which is largely stable. Let's pull up the large cap fund. What have they been doing? That's not anything exciting as well. That's seen a fall as well. Almost half to versus last month. That's the traction there. Then mid and small cap, that's also seeing a decline, right? Mid cap, that's all 33% downtick on a month-on-month basis. Now coming in at 4,385 crores. So keep an eye out on that. Small cap, also similar trends that we're seeing in terms of a decline. And March and April, if you see, they managed to sustain. But now we're seeing a fall coming in here. Apart from that, what we're also looking at is in terms of the flows that have come in from hybrid funds or mid and small cap side, sectoral funds. All of them also are seeing a fall coming in. So when you look at it in terms of hybrid funds, that's also halved, 10,000 crores approximately now where it stands at. In terms of sectoral and thematic funds, that also seen a very sharp decline. That frenzy that we had seen coming in for sectoral and thematic funds, that has started coming off, but now it's a sharper downtick. And given the uncertainty that's there currently in the market, the geopolitical tensions, all of that has caused the decline in terms of the equity flows. Let's look at the SIP contribution, right? That number is still steady at 30,000 crores. So then maybe where are you seeing that impact coming in from? Lump sum side. That's what experts have highlighted as well, that lump sum maybe is something that's taken the hit this time. Now, when you talk about other than that, multi-asset funds, other categories, that's still seeing a bit of an inflow, but that was a trend that was going on in the last few months. That was the focus area, but that also has seen a reduction. The uncertainty is the key, where in terms of the market is seeing a bit of a volatility, and that is coming in terms of the numbers also. For whether you look at the flows or whether you look at the NFOs, nothing exciting happening on that front as well. And that is why we're seeing the decline in equity inflows.
All right, Vinny, many thanks for taking us through those details. Up next, metal recycler CMR Green gets a bumper listing on the bourse's shares debut at an over 40% premium. Nigel D'Souza is here to put it all into perspective. Nigel?
Well, you said it, Arundhati. You know, the street was bracing for a blockbuster listing, and we have the grey market premium that we normally track. That was indicating a 30% bump up. And boy, oh boy, it's holding on to those gains. Now, a few reasons why, in fact, it's seeing such a big bump up. One is in terms of subscription. The subscription was more than 120 times. That's the overall subscription. Not just that, the QIB portion was subscribed more than 250 times, close to 270 times or thereabouts, telling you the kind of demand that was there for this particular issue. Why was that? Well, it was priced very, very well. So if you compare it with the listed peers, even after this 30% move, it's still trading at a bit of a discount. And no, it's not because the company is smaller. In fact, in terms of the aluminium recycling capacity, it's much larger than some of its peers. And they say they're a mile ahead in comparison to the second largest player with a capacity at around 4.7 lakh tons or thereabouts. So it's got scale. It got some valuation comfort as well. And the management spoke to us here at CNBC TV 18. They said prior to the IPO, that they're looking at margins improving from here on. They're saying that ROC will be as good as its peers, and they don't see any kind of risk with regard to sourcing from the United States as well, where their raw material comes in that. They also went on to say that capacity addition from here on will be funded via internal accrual. So put everything together, well, good valuations, solid demand, and a path ahead in terms of growth as well. The street seems to have grabbed onto this, explains why the listing has been with a gain of more than 30%, and it's still holding with those gains. Back to you guys.
Successful IPO in a volatile market. Nigel, thank you for putting that together for us. And even as the markets have now moved to the highs of the day, where you're speaking of Reliance giving up gains, the stock that has taken the market higher is HDFC Bank. We were talking about it yesterday, about the fact that an 1100-point move on the Nifty Bank came without any contributions from HDFC Bank. Today, the stock has now moved to the highs of the day, almost 2% higher as we speak, 750 now on HDFC Bank. But of course, speaking of Reliance Industries, the early morning announcement that came in that the company and Meta have announced a significant expansion of their partnership with an agreement for an AI-enabled data center in Jamnagar. Rashna is joining in with more on this. Rashna.
Yes, Meta and Reliance Industries have announced an agreement to build an AI-enabled data center in Jamnagar, Gujarat. Now, the facility will have a capacity of 168 megawatts in its first phase with options to scale further. How this would work is Reliance constructs it, develops it, and Meta leases it and runs entirely on renewable energy cooled by desalinated water. Now, if you've heard anything about data centers, you know these two things are the most controversial around data center, which is energy and water. Then there is also the fact that Meta would cover the full cost of energy and water going into it, and they would not be taking any fresh water from the local sources. Now, geographically, it is quite significant because Jamnagar is where Reliance is already developing one of the largest data center campuses in the world. Pair that with Meta's project Waterworth, which is the longest subsea cable system ever laid, you have some significant compute capacity on Indian soil connected directly to the global internet backbone. Now, Meta's 2026 capex guidance is between $125 and $145 billion, nearly double of what it spent last year and the year before that combined. Zuckerberg's target is tens of gigawatts this decade. India, with over 1 billion users across its platforms, that's WhatsApp, Facebook, all of it, and 2 years of WhatsApp AI testing under its belt, was going to be a part of that build-out. This is also the third act of partnership between the two companies as they built layer by layer. The first was $5.7 billion geo investment that came in 2020. Then came the Llama AI joint venture, and now physical infrastructure. Then there's also clean energy, where Meta has contracted nearly 1 gigawatt of new solar and wind capacity across 5 states, 837 megawatts with CleanMax and 88 megawatts with Fourth Partner Energy. So this can be seen as a significant step in India's journey of moving from spectator to stakeholder in the global AI race.
All right, Rachna, many thanks for taking us through those details. Now, on that note, it is time for us to head into a short break. More news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Let's get you the latest on the escalating tensions in West Asia. US-Iran trade fresh strikes amid a fragile ceasefire. Iran's Revolutionary Guard said they attacked the United States' Fifth Fleet in Bahrain with drones in response to US strikes on southern Iran earlier. The IRGC also confirmed that the US launched attacks against several locations in southern Iran and Qasem Island, damaging a telecommunications tower and destroying 2 water tanks in Sirik's Bemani district. Meanwhile, the US Central Command Forces said they completed self-defense strikes against Iran in response to yesterday's downing of a US Army Apache helicopter. CNBC's Dan Murphy joins us now with all of the latest updates from West Asia.
What we have seen is quite a significant escalation in the region. The US and Iran exchanging strikes overnight, really raising fresh questions, I would also say, about the security of US forces in the region, the situation in the Strait of Hormuz, and the real situation around where these diplomatic talks actually stand right now. US Central Command saying American forces carried out what it called self-defense strikes against Iranian targets on President Trump's orders. CENTCOM saying it targeted Iranian air defenses, ground control stations and radar sites, describing the attack as a proportional response. Iran also responding with its own military action. Iran's Revolutionary Guard saying it targeted US positions in the region, including in Bahrain and in Jordan, while regional governments also reported air defense activity and interceptions as well. The United States launching these strikes in response to the loss of a US Army Apache helicopter near the Strait of Hormuz. This is a really expensive, really sophisticated piece of US kit. Exactly what happened out there is unclear, but President Trump has blamed Iran for that incident. For its part, Iran has denied deliberately targeting the aircraft. US officials say the circumstances remain under investigation. Both crew members inside the chopper were reportedly rescued and are also reported to be in a stable condition. The rescue itself also marking quite a technological milestone, at least according to US sources. CENTCOM saying an unmanned surface vessel or a drone boat, as it's being called, helped to recover those 2 soldiers off the coast of Oman in what appears to be a first for US forces. So this is certainly getting a lot of attention online at the moment. Again, exactly what happened remains to be seen. Important to also say, I would contend that these strikes come at a pretty delicate moment too, because you'll recall we were speaking just yesterday about how President Trump had said the US and Iran were basically in the final stages of a deal, one that could reopen the Strait of Hormuz and advance those talks over Iran's nuclear program. So for investors, the focus right now really shifts to whether this latest escalation is going to further threaten shipping through the Strait of Hormuz or ultimately derails the diplomatic effort that the White House insists and has repeatedly insisted is still moving forward after more than 100 days of this conflict. The message from Washington right now is that the diplomacy remains possible, but I think you also have to look at the bigger picture here. Missiles, drones, retaliatory strikes back in the headlines. The path to a deal looks more uncertain this morning than it did just 24 hours ago.
Dan Murphy with all the latest updates there from West Asia. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Prime Minister Narendra Modi has completed 12 years in office. The Union Cabinet met today and applauded the Prime Minister on becoming the longest serving elected Prime Minister of the country and also the work done over the last 12 years. Ashmit is now joining in to detail the achievements and the key developments in the country under Prime Minister Modi's reign.
Prime Minister Modi has completed 12 years in office with 4,399 days. He will become India's longest continuously serving elected Prime Minister, surpassing Jawaharlal Nehru. Now, in a post on social media, Prime Minister highlighted many welfare measures undertaken by the government. Prime Minister Jan Dhan Yojana, important to point out, was one of the key aspects, in fact, has been flagged repeatedly by the top brass of the party's leadership. They point out that there have been as many as 58 crore accounts that have been formed. Now, one message that the BJP has often sent out is that initially it used to be a case of huge losses in transmission of funds. That has now changed entirely. The funds reach directly the beneficiary, and to that end, over 3 lakh crore rupees of funds have been deposited, and that's as of May of 2026. Another key highlight has been, of course, the UPI transactions. Huge numbers, staggering numbers. In December of 2016, there were only about 2 million transactions. They added up to about 700 crore rupees. That's changed dramatically. Cut to April of 2026, the number of transactions over 22 billion. The amount in question, over 29 lakh crore rupees. GST, another key reform measure that was rolled out in 2016. Bear in mind, we've come across a long way from 2016 to now. Where we stand currently, the monthly run rate in terms of monthly revenue is over 2 lakh crore rupees. That's the monthly run rate we're looking at. Startups, again, something very close to the heart of the current government's leadership. Initially, at 2014, what the data suggested is that the number of startups was somewhere in the vicinity of about 400. That has gone up all the way to 2.35 lakh. That's the startup ecosystem that we're now looking at. And also importantly, giving out jobs. These startups provide jobs to as many as 24 to 25 lakh people. Another key standout feature as far as this government's performance has been, of course, the Forex reserve, which pegged at over 67 lakh crore rupees. Now, this, importantly, has been pointed out. It provides import cover of 11 months. It covers up about 94% of external debt and, importantly, prevents external shocks from impacting the people back at home. Electronics has been the poster boy of the Make in India story, the manufacturing story, and the figures only do justice to that. Bear in mind that back in FY15, the production that we saw, cumulative electronics production, was about 2 lakh crore rupees, 1.9 to be specific. It's shot up to over 12 lakh crore rupees come FY25. And that's, of course, also accounting for massive rise in exports. In FY25, the same fiscal, the electronics exports stood at 3.3 lakh crore rupees.
So that's 12 years of Prime Minister Modi. Ashwin, thank you so much for taking us through those details. Now, earlier today, we spoke to Baba Kalyani, the chairman and managing director at Bharat Forge, on the reforms under PM Modi's leadership. Let's listen in to what he had to say.
The biggest transformation India has ever seen in the last 12 years has been in the transformation in industrial and manufacturing landscape. Earlier, defense was more at a component level as far as private sector was concerned. You made some small parts, you made some spare parts, you made a little bit of ammunition parts, etc. But now we are making platforms. You're making, like ATAGS is a platform. And we are beginning to see now a lot of interest from outside India of people who make small arms saying, can you manufacture small arms for us? So I think you're going to see a big explosion in this sector in the next 5-7 years. We need to make agreements with other countries so that we become part of their supply chain, which is not there today. So I hope this happens soon. I think we need to do a little more on ease of doing business. It's still a little complicated when it comes to some sectors. So that needs to be sorted out. In the defense sector, also, the process needs to be made much simpler than what it is today.
And with that, we take a leave on this edition of Business Lunch. The markets continue to hover around that 23,400 mark. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. Vivek is back with us. Vivek, good afternoon. It's all about the heavyweights today. The Nifty is doing well, but not so much action in the mid-caps. That's the one which is underperforming. Banks too participating a fair bit, and a lot about FMCG today.
Right. Good afternoon, Sonal. Well, like you rightly mentioned, the broader end of the markets are sulking compared to the benchmark indices. Broader end of the markets, advanced decline ratio quite muted over there. And individual stocks is where all of the action lies in terms of individual news flow, in terms of reactions to brokerages, as well as investor meets that have been going on, especially as the last 2 weeks are concerned. But a lot lined up on the show, so let's start off with the top headlines. Indices climbed to the day's highest point, powered by heavyweights, even as the broader market trend turns negative. FMCG and healthcare are prominent gainers, while metals and utilities drag.
Solid market debut for non-ferrous metal recycler CMR Green Technologies. Stock lists at 40% premium at 268 rupees a piece versus issue price of 192 rupees.
CleanMax, Enviro and Meta Platforms ink a 900 megawatt renewable energy partnership. CleanMax to develop and operate 836 megawatt of new capacities across Rajasthan and Karnataka. Meta, meanwhile, will purchase 100% of the environmental attributes of the said projects to align with its aim of 100% clean energy usage.
JM Financial maintains a buy stance on Aegis Logistics, raising the target to 1,200 rupees a share. The brokerage also raises EBITDA estimates for FY27 and FY28 on the back of distribution-led strength, while Jefferies upgrades Aegis Wopac to a buy rating with a target of 240. Solid moves on both group stocks, Aegis Logistics and Aegis Wopac at lunch hour.
U.S. drug regulator greenlights Concord Biotech's arthritis drug. Approval positions the company to capitalize on the $500 million opportunity in the U.S. market. The stock rallies.
Okay, all right, those are the top headlines that we are tracking. A clear loss that we are seeing in the mid-cap space. So let's talk about what's happening and what are the stocks which are buzzing around. The index has recovered from the lows, but there's still some selling from those levels. That's the mid-cap index that I'm talking about. Nifty has also given up some gains from the highs of the day. So this is our special segment, Mid-Cap Movers. We have Ria to take us through the mid-caps that are moving around in trade. Ria.
Well, yes, lots of stocks moving around in today's trading session. Starting off with the gainers, first we have Car Trade, which is one of the biggest movers in the trading session today. The stock is up around 45% just in the last 11 trading sessions as well. Afcon's Infra also gaining in trade today on the back of very strong volumes too. Nearly 34 times the 30-day average volumes traded today. And this after winning an LOA worth nearly rupees 5,300 crores for a project. Chambal Fertilizers also bucking up in trade today. Although this stock is down nearly 15% in the last 1 year. Concord Biotech also seeing gains after a US FDA approval for an arthritis drug, and Aditya Birla AMC also seeing big gains in today's trading session, and the stock is up nearly 52% just in the last 6 months. Looking at some of the other stocks that have hit their 52-week highs as well as their all-time highs today, we have CCL Products, Aster DM Healthcare, Apar Industries, HSCL as well as Chem India Projects all in this list. And on the flip side, looking at some of the losers in today's trading session, we have HFCL, which is in fact up around 2.5 times just in the last 6 months. Jain Resource Recycling takes a hit in today's trading session, continuing its decline. It is down nearly 37% just in the last 1 month. And apart from this, we have Z Entertainment, Jindal Saw as well as Indian Bank taking a hit today.
Well, thank you so much, Ria, for joining us, giving us a neat wrap of all the top movers and shakers as far as the broader end of the markets are concerned. Well, it's a good time to welcome Pritesh Mehta from Yes Securities for a quick technical check on the market. Good afternoon, Pritesh, and thank you so much for joining us. Well, first up, give us your view as far as the markets are concerned. Nifty is holding quite steady, but the broader end of the market is making a bit of a tumble. So do you see the Nifty correcting from here on?
Good afternoon. First of all, it's good to see Nifty or large cap leading from the front. But in the recent history, if we visit that, I think we should not be getting excited by this comeback of index, because in last couple of weeks, index has been largely range bound and not doing anything in particular. So I think this trend of likeless direction movement is going to continue. Large caps have been the main culprits for the recent lack of action in the last couple of weeks. In fact, if you look at Nifty, it is underperforming EMs. It is underperforming the global peers also. And I don't see that changing in a hurry. In fact, when you look from the intermarket perspective also, it is lagging behind, against some Nifty Composite Index, also against gold. So it tells us that investors are more keen towards capital preservation rather than chasing risk. In this kind of environment, we should not be expecting much from the index, but stock-specific activity will keep on continue. Something like banks, banks have done recently well. They have outperformed the benchmark index. But again, the top tier names have been missing. It's been all about the mid-tier banking names, which have been making the right moves. So I stick with them. Rather than focusing more on index, I think let's keep it aside. Rather, I would prefer watching the World Cup action.
Okay, Pritesh, what do you make of individual names then? A lot of action there as well, if you have some names?
Yes, mid-caps, yes, today they are a bit quiet when we talk from relative perspective of an index, but over the last few months, they have been leading from front. So something like Indian orders we like, it is challenging the peak of May 2026. We have seen series of bullish shutter break, and now we are witnessing a breakthrough. So I think a move towards something like 770 is on the cards. Stock would be around 640. Second stock again from the mid-cap category we like is SRF. It had a big rally in the first 2 weeks of May. Thereafter, it went to a bit of sideways consolidation. Now it has given a break above the downward sloping 45-day trend line on the pointer figure chart. So we are expecting resumption of the previous uptrend. So buy for a target of 3100.
Well, thank you so much, Pritesh, for joining us, giving us a view on the markets and individual stock trading calls as well. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
and so is Aegis Vopak, which is up around 3.6%. There is a note from JM Financials where they have maintained a buy on Aegis Logistics with a revised target price of 1,200 versus 935 earlier. So that's a big upgrade that's come by. Raised EBITDA estimates by 36% for FY27 and 15% for FY28 because of the strength in distribution that they will be seeing. They delivered distribution volumes which are up 72% on a YY basis in the quarter gone by. They were 40% ahead of JM Financial's estimates as well. Yes, the transit of ships via the Strait of Hormuz is something which could affect their business. But they also expect these disruptions to persist through first half of FY27. With key connectivity projects on track, they expect LPG throughput to witness strong growth. So yes, there are some concerns that they are seeing in the first half of FY27, but still considering the volume growth that was seen in Q4, they expect that to continue in the entire FY27 and FY28 as well. For Aegis Vopak, there is a note from Jefferies where the stock has been upgraded by that particular brokerage. It has corrected 16% versus Nifty's 8% since the Middle East crisis started. It has around 52% revenue coming in from LPG itself, and LPG crisis was the big talking point there anyway. So near-term risks, of course, they remain, but LPG imports should not started diversifying its LPG imports anyway, and we have seen gas imports at least get back to the normalized levels. We estimate, or Jefferies estimates, a 41% EBITDA CAGR for the next two fiscal, led by 46% LPG volume CAGR because there will be capacity additions by these companies, and also the LPG pipeline that is coming by. The stock is trading at 29 times because which they say is reasonable for the strong EBITDA growth that they are looking at. The stock has been upgraded to a buy. The target price is at 240 rupees, but they have cut FY27 EBITDA by 22% because there was a miss in the March quarter. But generally a beat because they expect things to get back to normal, and also because of the fact that stock has corrected a lot in the last couple of months.
That's right. So both of these stocks buzzing after the analyst meet, and thank you so much for highlighting those particular names as well. But moving on, in an exclusive conversation with CNBC TV18, Baba Kalyani of Bharat Forge says that the company is looking to supply components to companies in the semiconductor manufacturing equipment space. Sudarshan joins in with all the key details.
So some time ago, Baba Kalyani has joined us and spoken exclusively about that company, whatever company is working into the defense segment, how the business is going to be over the next 5 to 7 years, and also if there is a new business that company is working on. So first talk about the defense business. He has said that earlier defense sector used to be a like component for entire private sector, but now companies like Bharat Forge is making it a platform, and whatever is making it's being designed in India, manufactured in India, and also built in India. And over the next 5 to 7 years, he believes that there can be a significant surge in defense segment in India. Next, he has talked about how the India should focus to become a product nation than a services nation, and everything that we make product, it should be designed in India, made in India, and should be sold to the world. About the new business, he has talked about that the company is looking into a semiconductor space and to become a part of global supply chain. He's also working with top 3 of like top 5 companies. He has named those companies like Lam Research, Applied Materials, and ASML. He's in talks with these companies to become a part of their global supply chain. And over the next few years, he believes that there can be a significant opportunity in this segment because there is a huge opportunity, and the opportunity can be as such that this business forms almost more than $1 billion. So let's listen to what exactly Baba Kalyani had to say about the semiconductor business over the next few years.
The new area that we are working on is in semiconductors, not to make semiconductors, but being part of the supply chain of semiconductor equipment. That business is pretty large. It's in billions of dollars. And we are already working. There are only 5 companies that are in the semiconductor supply game, and we are working with 3 of them to see how we can make products for them and get into this supply chain. These are companies like Lam Research, ASML, Applied Materials, these companies. And surprisingly, by the way, they all use metal parts for their equipments. And many of them are forgings. Some of them are specialized machine parts. So that's an area that at least we have got our eyes on.
All right, that's the word coming in from Bharat Forge. The stock has recovered sharply since CNBC TV 18 had that conversation, up 1.2% as we speak. The other set of stocks that we are tracking is Muthoot Finance, Manappuram Finance as well. A lot about gold prices and the impact thereon. Ananya is joining us with all the details.
So gold financiers, Muthoot Finance, Manappuram Finance are under pressure today after gold prices corrected nearly 2% and gold ETFs saw a net outflow of 725 crore in May, the first monthly outflow in over a year since April 25. But this is not really an asset quality concern. For instance, if you look at Manappuram's LTV ratio, it's 57%, means for gold worth 100, they lend 57. Even after 2% fall in gold prices, the LTV rises to just 58%, which is hardly a concern. In fact, both Muthoot and Manappuram have repeatedly highlighted that moderated gold price corrections have very less impact on their loan books because they have strong collateral buffers and conservative lending practices. But what's weighing on the sentiment is the growth. The real worry here is the growth. Muthoot recently mentioned that their 50% plus AUM growth was mainly driven by higher gold prices because customers can borrow more on the same jewelry. Tonnage and customer additions have been relatively softer, indicating that a significant part of the growth has come from higher gold prices. So, today's reaction appears to be less about credit risk and more about that the growth can the growth sustain going forward if the gold price continue to correct going forward.
Well, thank you so much, Ananya, for joining us, giving us a sense of what exactly is transpiring as far as gold financiers are concerned. Higher competitive intensity as well is something that the street appears to be slightly wary of. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, we are now focusing on a company that's moved significantly higher on good volume today, and that is CleanMax Enviro. This particular company, remember, operates in the power space, renewable energy power, and it is present in the C&I segment, which is the commercial as well as industrial segment. What does that mean? That means that the company typically does not participate in tenders, rather goes ahead and signs exclusive PPAs with companies that it needs to go ahead and supply power to. Now, what is the development today? Now, today, the company has announced that Meta and them have gone ahead and partnered on the development of renewable energy capacity in India. Both of these companies will jointly develop close to 837 megawatts of solar as well as wind capacity across the states of Rajasthan as well as Karnataka. CleanMax will develop and operate the renewable energy capacity, while Meta will purchase 100% of the environmental attributes, mainly ensuring that they will get all of the benefits as far as the green carbon footprint is concerned. Now, what does this particular development mean for CleanMax? Remember, CleanMax contracted capacity or portfolio stood at over 5.7 gigawatt at the end of FY27. The contracted capacity portfolio stood at close to 6.4 gigawatt versus just around 4.9 or 5 gigawatt on a year-on-year basis. The weighted average PPA tenor for the company is almost 23 years. And remember, most of these PPAs are at slightly higher rates compared to what is discovered as far as the tariffs or the auction is concerned. In terms of FY27 targets, remember the management joined us after the Q4 results, and they told us that they expect minimum of a 1.5 gigawatt of commission capacity in FY27. Now, Sonal, this shouldn't come as a surprise because the company actually has quite a few marquee MNC clients, and most of them use this particular CNI platform to go ahead and do quite a bit of offsetting as far as their carbon footprint is concerned. So again, Meta, a large client, the company also works with names like Apple, etc. And the stock has done phenomenally post what was a very weak listing. The stock's almost doubled.
Oh, yes, it was a weak listing, so people were still trying to understand the business. But as Vivek just mentioned, it is a big contract that the company has entered into. Let's move on now and talk about an exclusive conversation that we had. Kushal Desai, CMD of Apar Industries, told us that they are targeting 10% volume growth and adds that cables will account for 2.5% of data centers capex. Listen into what he had to say.
We are hoping that we'll still be in the 40s as we complete the year. We are looking at, we've been guiding a 10% growth, and we are looking at more business coming from the US market now that the tariffs seem to have got a little bit more stabilized. In the data center complex, there are no conductors used, it's basically cables.
Right.
So the cabling would be between 2 and 2.5%, maybe slightly higher than that if the specifications of the products are at a high standard like fire survival, etc., etc. There is also a huge play for us of bringing power and data into the data center. We are looking at it in the cable business, and we've publicly stated that about 25% year-on-year growth for the next 5 years. That's what we are targeting. There's a significant amount of capex that Apar has planned. 50% plus of that capex is going into the cable side to create this capacity. So we are quite bullish on that cable side and its growth. Specifically with the US market, last year we did approximately 1,600 crores of revenue in the US in spite of all the tariff-related issues.
Turmoil, yeah.
This year we are looking at beating that number, but I can tell you that FY28 is where we will be really well set up.
Okay, all right. That's the word coming in from Apar Industries. Important flashes at the bottom. They see very heavy rain in parts of Kerala Thursday, Friday, Karnataka on Friday. This has been an issue for the markets, the deficient rainfall that we've seen so far. So that is something we'll be tracking very closely. For now, the markets continue to trend higher. The broader markets under pressure, though. That's all we have on Midcap Radar, but your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon, and not a great afternoon coming in, given that we have come off from the day's highest point.
Absolutely.
We're holding on to that green right now. For the markets, yes, 23,350, around that mark is what we're trading at. Bank Nifty, that has also come off from the highs of the day. Still some gain, 0.4% of gain coming in for the Bank Nifty. But specifically in the last 1 hour, we've seen a bit more of a decline and up and down coming in for the markets. Now, obviously, advance decline ratio is going to be more skewed towards the declines versus advances because the broader end of the market today is not doing well. The mid-cap, small-cap, nothing exciting happening. And that gap between both the green line and the red line, that seems to have widened up as well, Arundhati. But yes, that's a trend right now in today's trading session.
Absolutely. And as you pointed out that, advanced decline ratio at one point was even Stevens, and now it's going in favor of the declines. And if you look at the sectors that are doing well today, we've got that FMCG pack that's leading from the front. You've got names like HUL, ITC, all of them doing well. Nestle is also one of the top gainers on the Nifty. We've also got private banks that are doing well as well. ICICI Bank, Kotak Mahindra Bank, Axis Bank, all of them in the green today. On the downside, we've got that metal pack that's continuing to extend its losses, right? Another session of losses. I think it's a 5th straight session of losses for that index. So those names, Hindalco, Nalco, all of them in the red today as we speak. We've also got those gold financiers not doing very well today in trade as well. So that's how the markets are set up, Vinny, today. But let's go across to our guest to answer all of your stock queries. Joining us today, Somil Mehta, the head retail research, Mirae Asset Sher Khan, and Sneha Podar, the VP research, wealth management, Motilal Oswal Financial Services, to answer all of your stock queries. So the first query coming in from Ashish, who's writing to us from New Delhi. He says he is holding Jupiter Wagons for over 2 years now, and he wants to know if he can buy more shares. Now, Jupiter Wagons is at 274 rupees a share. He's been holding it for 2 years. So, Somil, let me come to you first. What do you think he should do with this? Should he add more? Would that be a good thing for him?
Good afternoon, good afternoon to everyone. I'm just trying to pull up the charts. Just give me a second.
Sure.
Absolutely, no problem. The stock is currently at 274, and that's how the stock is faring and is at right now. And he wants to know if he should buy more shares. So while Somil is looking at the chart, Sneha, why don't I come to you to ask you what he should do, whether he should buy more shares?
Okay, hi, good afternoon. So basically, I would suggest to exit because given the weak numbers that the company announced in Q4 and in general for the entire FY26, in fact, Q4 we saw a very sharp drop in net profit as well as revenue, and the margins contracted very significantly. What I believe is that they're facing a lot of execution challenges, which has to be very actively monitored in FY27. Though given the the big capex program that the government has on the railway side, the opportunity is big. Their order book is pretty healthy, but execution challenges continue to affect their overall numbers. And thus, my suggestion would be to exit the stock and actually look at diversifying into some other sectors which are currently are doing well in the scenario.
Okay. Surely we'll watch out for that, and like we're saying also, Jupiter Wagons has been facing those execution challenges, which is weighing on their overall performance. In 2026 specifically, we have seen that come in as well. But Soman, on the charts, in the last 1 year also, the stock has not done anything, right? It's down 33%. The viewer has been holding it for the last 2 years. I know you don't normally say average buy, but what are you looking at right now? Is it better to just sell the stock?
Absolutely. I'm negative on the stock. Since January 2025, the stock is below 200 daily moving average, making low top, low bottom on quarterly, monthly charts. Does not look good in the daily charts as well. A small triangular pattern has broken on the downside. So I'll be expecting the stock to go down till at least 240, 230 levels. So definitely exit from the stock. My view would be negative in the medium term, long term both.
Okay, view is negative on the medium and long term for Jupiter Wagons. Fundamentally and technically not looking too exciting right now. Let's move on then to the next query for today. We have SK Bhatia, who's writing to us from New Delhi. He's holding 405 shares of EIH. He's been for more than 5 years, so he's a long-term investor. Wants to know the outlook from here on for the next 1-2 years, willing to hold on for a long term. The story and the view for the long term and the short term. Sneha, first to you on the fundamentals. How is it looking like?
So see, I mean, EIH, though it has witnessed turnaround over the last few years, but FY26 was not a good year for them. Their overall net profit, in fact, dropped almost 15%, and this was largely hit by some exceptional loss which they incurred. And if we look at the overall industry, the industry is not doing good per se, because it seems to be kind of reaching the near-term saturation. And plus, to add on to it, the overall geopolitical situation is also have created a lot of uncertainty, and thus the overall outlook for FY27 doesn't really look promising. The stock might start performing once the numbers start improving, but for that the overall industry growth has to pick up, and which in the current scenario seems in a very gray area. So my take would be, at least from 1 year perspective, this doesn't look good, but if you're ready to if the client is ready to hold on for 2 to 3 years, this stock might see a reversal from here.
So if he holds on for 2 to 3 years, it might see a reversal. Somil, coming to you, over the last 5 years, the stock has actually gained quite a bit, but in the last year, it fell a lot. So what do you think he should do? He has a 1 to 2 year outlook on EIH. So he wants to know whether he should sell, whether he should keep the stock. So what do you think he should do?
I think I'll be negative as well. I'll be expecting the stock to still, keep continuing the downtrend till 270. If it does not sustain around 270, it may fall till 250. So I'll be negative. It's been in the downtrend for a very long time now, trading below short-term averages, long-term averages. The trend is negative. So medium-term, short-term, both negative. Is the 40 daily exponential moving average. And below that, 130, which is the lower end of the Bollinger Band on the daily chart. So these are two supports which I'm looking out for. However, the trend on the upside still intact. The structure is positive. My suggestion would be to buy on declines around 150, 130 levels. That will be a great time to buy the stock. Wait for the positive close on the monthly charts around those levels, and then you can enter again.
Okay. That's a view there for HFCL. Let's move on then to the next query for today. We have Subramanian, who's writing to us from Bangalore. He's holding 540 shares of Coffee Day Enterprises. This is at a price of 103. The stock is currently trading at just 34 rupees per share. Wants to know, as a long-term view for the stock as well, what should they be doing? And obviously, they bought it a while back. So in the current scenario, what is your view coming in for this one, Sneha?
See, I mean, the Coffee Day Enterprise has witnessed a turnaround in the March quarter. But then when we look at the balance sheet, still the legacy debt overhang continues to be there. And plus, the legal regulatory struggles continue to pose negative sentiment for the stock. In fact, the recent SEBI penalties for the disclosure lapses also led to some sort of correction in the stock. Plus, the fundamentals are not really very sound, and though the overall industry tailwind is good, but the corporate governance issue seems to be one big overhang for this company, and thus, in any pullback, my suggestion would be to switch from this company to some safer bets.
All right, so switch from this company to a safer bet. The company did do well in its quarter results that just went by, turned a profit. Somil, what do you think he should do at the price that he bought it at?
Yeah, at the moment, in the very short term, yes, there is a bounce, and I'll be expecting more upside till 51 levels. That is short to medium term outlook, but not more than that, because it has been in a very broad range and the trend is down. In the bounce, probably it can go till 51, but that will be an exit opportunity. So my suggestion would be to exit at the higher levels.
Okay, that's a view there. Exit at the higher levels is the word on the technical front. But on that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries after the break. Stay tuned in.
to this Barra da Tijuca beach in Rio de Janeiro, our airline CEOs from around the world gathered for the world's biggest aviation conference. And the theme this time for discussions is common across continents. How is the West Asia war and the jet fuel price shock reshaping global aviation? Will jet fuel prices stabilize? Will airspace restrictions continue to pose a major risk to commercial aviation? And will airlines be able to recover their losses? We get you exclusive interviews with the big faces in aviation from Rio de Janeiro on CNBC TV 18.
Welcome back. You're still watching Your Stocks on CNBC TV 18. Still with us, Somal Mehta of Mirae Asset Sharekhan and Sneha Podar of Motilal Oswal Financial Services to answer all of your queries. The next query is coming in from MVS Rao, who's writing to us from Telangana. He wants to know if he can invest in Tenneco Clean Air for the long term. The stock is currently at 573. It is trading above its listing price. So, Sneha, let me come to you first. What do you think he should do? What's the long-term view on the stock?
My take would be to avoid Tenneco because Tenneco operates in a very niche segment, which is the automotive emission control segment. Now, though that segment is doing well and it's benefiting from the tightening of the emission norms in India, but then with the gradual shift which is taking place towards the EV, probably this segment could suffer because this caters more towards the ICE segment, which is the traditional segment. And plus the current valuations seems a little stretched. So my take would be to avoid this. Rather, he can look at Samvardhana Motherson, which is a much more diversified auto ancillary player and is benefiting from the premiumization trend as well as from the shift which is taking place towards the EV. That would be a much safer bet compared to the Tenneco, which is concentrated in just one particular segment.
Okay, that's a word on the fundamentals. Somal, I know there's not much in terms of technical charts. It's just been 6-7 months since the company has listed. But have you managed to see anything, any suggestions here?
In the very short term, because the data is too less, so I'm giving short-term view. In the very short term, I'll be bearish on the stock, and I'll be expecting the stock to go down till 540 levels. If it does not sustain there, then the next level would be 510. Now, small triangular pattern has broken on the downside on the daily charts, taking resistance at 20 and 40 daily moving average. So I'll be bearish here, making lower top, low bottom. So stay away from the stock for now.
Okay. Stay away from the stock for now. Short-term is the only thing. Even on the fundamentals, it didn't look anything exciting. Let's move on, and we have Rama here, who's writing to us from Mumbai. He's holding 1,000 shares of growth. This is at a price of 188 rupees, which he's bought it. Making some bit of a profit on this one. Wants to know if you should continue to hold this for the long term or just book out that profit that you're making on this one. Sneha, your view on this one, the capital market side, all of these players are always in focus. That's the trend that's coming up as well. What is your suggestion?
My suggestion would be to hold on to the stock. See, Grow is a market leader in the retail demat account, and they are commanding a very dominant market share, and it will continue to benefit from here given the low cost model that they have. And the demat penetration is still to happen in a big way in tier 3, tier 4 cities, and plus they are benefiting from the cross selling potential into mutual funds and the other segments. In fact, their other segments are at a very nascent stage, like for example the wealth management, the last segment, MTF segment. So these segments have a huge growth potential from here on, which also provides a diversification to their overall portfolio. So my take would be the company would be able to maintain the strong run rate that they witnessed in the fourth quarter. So that should continue in FY27, and from here on we can expect the stock to do well. In fact, these levels are really attractive in terms of the valuation perspective.
So you would suggest to hold on from the long-term perspective. Somal, what should he do with Grow? He bought it at 188. It's at 192 now. Should he continue to hold or should he sell the stock?
If the client has done a short-term trading, definitely book out some profits. However, if the person is holding on to this stock for a long term, definitely hold on to it. Positive on the industry targets would be again above 220, 230 levels for Grow. So yes, buy on decline should be the strategy for long term. In the very short term, maybe there'll be a little bit of a pain.
All right, in the short term, a little bit of pain, but from the long term, he should hold on to it. The next query is coming in from Sunil Kumar, who's writing to us from New Delhi. He holds 100 shares of Anant Raj at 650 rupees. He is making a loss on the stock, and he wants to know if he should continue to hold or sell. So, Sneha, from a long-term perspective, is this a good stock to be invested in?
Yes, he can continue to hold on to Anant Raj. They recently launched a new project in NCR where they are receiving a very good response, and plus the overall launch pipeline for FY27 remains pretty strong. The company is also benefiting from the data center investment that it is making, and they have huge plans over that side. In fact, the overall numbers that they reported for FY26 was pretty decent. So going ahead, we believe that the company will be able to clock about 20% revenue, and the overall pre-sales and the collection should remain healthy for FY27. So my suggestion would be to hold on to the stock.
Hold on to the stock. That's the view coming in on the fundamentals. Somal, they bought it at 650 rupees. Currently, the stock is trading at 525. So more on the higher side is what they bought it in the last 1 year, specifically when we've seen that move in the stock. Your suggestion for them, right? What should they be doing? Continue to hold or maybe sell, book out that loss right now? What's your suggestion?
If the person has bought it for long term, definitely hold on to it. However, in the short to medium term outlook, I don't see much positive waves going on right now. it may go down till 500, probably 480 levels at this point of time. However, in the long term, I'm very positive because there's a huge triangular pattern forming for Anand Raj. And once this entire triangle pattern has broken on the upside, it will be a great run for the stock. However, this is a wait and watch stock, and the breakout level is above 600 and probably 10. So 610 would be the breakout level, but I'll hold on to the stock for long term.
All right. Hold on to the stock for the long term. All right, Sneha, Somal, thank you so much for taking time out and answering all of our viewer queries today. But with that, it is a wrap on this edition of Your Stocks. But do remember to email us your queries and we will address them with our experts. Up next, Closing Bell will take you through the last hour of trade. And from Vinny and me, goodbye and many thanks for watching.
Beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Well, that is the market which is looking up. Nifty, Bank Nifty, broader markets all looking up and about. So a smart session so far. This is Closing Bell. We're coming to you from the CNBC TV 18 Motorsport Studios. I'm Prashant. Nigel is with me. Nigel, hi.
Well, the Nifty Bank is playing a good role, right? Today, the problem is in the broader markets. The Midcap index has come in for some profit taking. But, Prashant, after the kind of run that we saw yesterday and the strong close that we saw yesterday, I think the bulls will take it, right? If we end home, go home with gains of 80 to around 100 points, I think the bulls will be pretty okay. And the Nifty Bank, that's really building onto gains. It's taken out some crucial technical levels. So I think you'll be betting big on the Nifty Bank, actually, moving up from here on.
It was PSU Bank.
Yes,
Today it is all ICICI, HDFC, Axis. I mean, the entire pack is actually doing quite well. That's a private bank space. By the way, this is for the Nifty, this is exactly the congestion zone. We are in the congestion zone. So let's hope, we don't lose our way in all the congestion and there is a clearing on the way higher because, once you take this out, you're basically looking at about 23 in the 23,800 or in the vicinity of the 23,800 kind of levels. But lots of time has been spent exactly where we are right now. So let's see if we're able to do it by closing in the next 1 hour or so. Well, it's an action-packed last 60 minutes coming up. Lots of opinion you'll hear. Mid-caps, of course, are weaker a little bit, and FMCG and private banks, as we told you, are looking better. But lots of managements, right? Apar Industries has offered ambitious commentary. We'll play out some sound bites from that interview going forward. We have the top boss at Bharat Forge Group, of course, telling us that, well, they're looking at new areas like semiconductor equipment, basically. We also had, by the way, the management of NRB Bearings earlier in the morning. That's, again, a company you don't hear from very often. And again, I mean, sounding very, very positive. In that sense. I mean, actually, the common thread through all these three companies is manufacturing. And, all three sounding very optimistic about future prospects in that sense. Well, how should you position yourself in the last 60 minutes? That's the question. And Mitesh is with us with the answer. Mitesh, good afternoon. Good to have you here. So, your sense on the trades to take?
Good afternoon, Prashant. See, I think, while the Bank Nifty has done slightly better than the Nifty, I think broadly, the Bank Nifty, needs to get past 55,500 and close about. We are just there. Actually, we did touch that level, making a high of 55,555.8. But the follow through is not, very dynamic, and that's why maybe the Nifty is also failing to get past 23,400, 30,450 zone. Which is where, if you recall, in the month of May, we had about 3 or 4 lows around the 23,450, 400 zones. So I think it's a market which is mildly biased on the positive side, especially the financial names, but yet lacking decisive strength to break on the upside. So we're watching the index, nothing much being done on the index position-wise. But on stock side, I have one buy and one sell. Pidilite is something, which is breaking out today. That's a buy with a stop at 1495. Look for targets of 1580. And Coal India, I think after a long time, Coal India is showing first signs of correction. So let's just sell with a stop at 458 half, 459. Look for targets of 435 on the downside.
Oh, that'll be interesting because once it gets past that 447 odd mark, there could be some further selling that will come in. I say that because the 447 is the mark where the allocation was done. In that recently concluded OFS. So that's going to be an important mark. 447 is the important mark you want to look at. But let's turn our attention to the oil and gas space. Oil India is under pressure on the back of a Morgan Stanley note. Sonal joins us to fill us in with details on that particular note. Sonal, over to you.
Morgan Stanley is generally bullish on the upstream sector because of the capex that will be announced. They're expecting investment boost of $10 billion a year. There has been a royalty cut that has come by, new discoveries of natural gas that we've been hearing about. There's no windfall tax that surprised the street positively as well because there was a fear there could be a windfall tax otherwise as well. For Oil India in particular, they're not so bullish because it does have a refinery segment as well. That is the Numaligarh refinery that they acquired from BPCL a few years back, and that is the reason why they have downgraded it to an underweight from an overweight. Target price has been cut as well to 404 rupees a share. They see 6 to 7% downside risk to street estimates now that they're expecting oil prices to normalize. That is one of the reasons, of course, but they are expecting delayed natural gas average selling price increase, so it will be delayed versus what was expected earlier. Lower refinery margin, there could be cap on diesel sales as well from that particular refinery. So on a consolidated basis, there could be some EPS cuts. They are expecting slow slow increase in domestic production as well. So yes, these are some of the reasons why Morgan Stanley is not so bullish on Oil India, majority of it coming in from the refining segment.
Got it. Okay, all right. Thanks a lot for that. Sonal, clearly big impact out there. Oil India, the stock is now down 10%, I think. So massive downtake on that particular name. In fact, the markets have come off the top. You know, we've run into resistance at around the 23,380, I think so. And, you know, we have moved actually now lower, broken the 23,300 mark on the downside. So keep an eye on that. Nifty Bank, though, still holding with a gain of around 180 points. Sid Kemka, Head of Research Wealth Management at Motilal Oswal Financial Services, joins us on the show. Sid, what do you make of these two, Oil India and ONGC?
Yeah, hi, good afternoon, Nigel. I think definitely based on these geopolitical issues, if the crude price comes down, I think that's a big negative for some of these oil companies. But if you look at structurally, what we see is that the upstream oil companies, they are in an upcycle given the increasing production capacities that they are doing, and even the new gas find that Oil India did recently. So I think if you look at in that sense, while the short term may be a bit impactful because of the sharp fall in the global prices and whenever this war stops. But I think overall we believe that there is a slow and steady growth. If you look at specifically for Oil India, about 2 to 4% of oil and gas production CAGR over the next 2 years. And I think on falls, one can look at them incrementally, but currently I think the sentiment is definitely a bit on the negative side.
Got it. Okay. All right. A quick word, Sid. You know, we had Mitesh who was talking to us about Coal India. You know, that played out actually as a beautiful trade, tactical trade, because it has tailwinds with regard to global prices moving up. They're talking about better offtake after a couple of years of absolutely no growth. And the street is optimistic that, you know, that cash balance, dividend yield as well is there. The question is now, should you be getting out of the stock or you be getting in? Because it's come back down to around 447, which is incidentally the allocation price in that recently concluded OFS. At 452, would you be interested?
Oh, I think yes. If you look at the current energy crisis globally, has brought in a lot of focus towards coal, especially in a country like India, where we have a lot of domestic coal production, mining, and hence we have seen newer policies, especially if you look at the coal gasification policy that the government has come out recently. So in the long term, I think that's such a good play on the domestic energy. Plus, if you, as you rightly highlighted, I think on the production side, the operational performance that has improved with the production volume going up, the mix of e-auction volume, where the spot prices for coal had gone up sharply. So I think overall, we remain positive on Coal India. The volume CAGR is about 4%. Revenue CAGR about 5%, but more importantly, EBITDA CAGR of about 12%, and the dividend yield and the comfort of the price levels, I think that remains. Stock price had moved up, I think, post the OFS, but now again coming down to the attractive level. So yes, we would remain positive on Coal India. We have a buy rating at target price of 530.
Yeah. Got that. You know, Sid, we'll just sort of play out some sound bites from our conversation earlier with Baba Kalyani. Baba Kalyani is, and Bharat Forge is looking to enter new segments. I mean, you know, it's used to be forgings, autocoms, but of course it's much beyond that. You know, actually Sud is with us. Sud, why don't you just sort of wrap up what Mr. Kalyani told us in that conversation?
The stock has seen a huge surge in the last an hour or say after Baba Kalyani spoke to us and talking about two major segments. One, that is the defense segment. For company, defense has been the focus area for the last few years. And he has said that for the private sector, defense used to be earlier at the component level. But for companies like Bharat Forge, defense has now become a very important part, and companies making a platform for the same. And this segment is going to see a huge surge over next 5 to 7 years. And private sector will be making products that will be designed and built in India and will be sold to the world. Second segment that he has focused is semiconductor, and that can be one of the reasons why stock has seen a huge surge. For the first time, Baba Kalyani has talked about that one business that company is working on is semiconductor. He's not looking at manufacturing business in that space. He's looking into becoming a part of the global supply chain, and he's working with 3 of top 5 companies that are part of the semiconductor global supply chain, and those companies are Lam Research, Applied Materials and ASML. Let's listen in what Baba Kalyani has to say and had to say to CNBC TV 18.
The new area that we are working on is in semiconductors, not to make semiconductors, but being part of the supply chain of semiconductor equipment. That business is pretty large. It's in billions of dollars. And we are already working. There are only 5 companies that are in the semiconductor supply game, and we are working with 3 of them to see how we can make products for them and get into this supply chain. These are companies like Lam Research, ASML, Applied Materials, these companies. And surprisingly, by the way, they all use metal parts for their equipments. And many of them are forgings. Some of them are specialized machine parts. So that's an area that at least we have got our eyes on.
Okay, all right. Clearly, the street listening in to the commentary that Mr. Kalyani spoke to us here on CNBC TV. The stock was down 3%. Now it's up 1.5%. That's the kind of impact that you've seen with regard to those comments that have come in there. But Sudarshan's had a very, very busy day. He's normally a busy man. But today, additional responsibilities covering Bharat Forge. He's also chipping in and telling us what's causing the buzz in car trade. Sudarshan, take it away.
So since Q4 earnings that company had announced in the early part of May, since then the stock is up more than 30%. YTD, if you take a look, it's still down around 13%. So recent developments. First, company has talked about OLX India's Elite Buyer program, and for that sign-ups have crossed 80,000 May 2026. And this program has now started contributing to OLX revenue growth, and company believes that it's going to become a significant contributor to company's growth in coming years. Next, Q4 earnings was very strong. It was 12th straight quarter that company had posted more than 50% year-on-year growth in EBITDA. And going forward, believes that there is scope for further expansion in the margin, even from current levels of around 33 to 35%. And talking about the profit outlook, by over next 5 to 6 years, it believes that profit is going to become 4 times of the current level and going to hit 1,000 crore in next 4 to 5 years. Recently, Kotak Institutional Equities on 3rd of June had come out with a note upgrading the stock to buy, and target was increased to 2,300 rupees per share. It has said stock price is under pressure YTD on concerns of disruptions from AI models, but company's deep dealer database and value-added offerings may limit the impact to an extent, and it has upgraded on account of sharply higher valuations for OLX, and OLX sees steady GMV growth, improving monetization and margin, and also it has raised FY27-29 EPS estimates in the range of 1 to 5%, mainly on the back of higher profitability estimates for OLX. So OLX has been one of the major reasons why company believes that profit is going to become 4 times in the next 4 to 5 years, and also brokerages have been bullish.
Yeah, I mean, it's a big move, right? So coming in, I think, what, 20% very quickly on car trade recently.
Correct. So on 7th of May, company had announced earnings, and that day the stock was hovering around 1940, and now currently it's at 2460. So almost 30% move.
I think there was that fear of that AI, and that was the risk, and that's why we saw a sharp sell-off. And then a lot of people got interested at 1700, 1800. I was in fact at the conference yesterday, and a couple of fund managers who used that opportunity, they said after 17, 1800, they couldn't see it directly. And today it'll be even higher because 2100 became, 2400 in a matter of a day. Well, let's get in. Sid, what do you think? Will you ride this car?
Nigel, unfortunately, we don't have coverage or view on car trade, but some of these new age businesses, I think they have been showing pretty strong up move, especially after the performance. So we have companies like Urban Company, Lenskart. I think some of the other high discretionary value items. There is where I think the interest and strong growth in business is visible. Definitely a good story, but right now not under our coverage.
Oh, okay. All right. Got that. By the way, markets have actually come off the top of the day. We're up only around 40 points, dipped below the 23,300 mark as well. Sid, let me ask you about Meesho. Any view out there? Jeffries came out with a note. Today, there was a couple of large trades. I don't know whether that was the pending trade out there that's actually got cleaned out. But do you have a view out there? Because volumes are very, very high, but there will be some disclosures, since the lock-in has ended. Your take?
So yeah, again, another stock where a new age business, which is showing a lot of traction, showing a lot of promise. Unfortunately, again, we don't have coverage. But as I said, this is a space that the quick commerce space that we really like. We believe that some of these companies like Eternal, Swiggy, now even Zepto is lining up for the IPO. I think this space looks more and more interesting as we go ahead.
Okay, all right. I think you tracked the next one, which is Apar Industries. Let me first cover the news flow today. It's trading at a record high. It's making fresh lifetime highs today. Well, they spoke to us here at CNBC TV18. Mr. Kushal Desai, the CMD of Apar Industries, says he is betting big on the cables business, which is expected to see strong tailwinds from the data center boom. Let's listen to that conversation and then get Sid's view on the stock.
We are hoping that we'll still be in the 40s as we complete the year. We've been guiding a 10% growth. In the data center complex, there are no conductors used, it's basically cables.
Right.
So the cabling would be between 2 and 2.5%, maybe slightly higher than that if the specifications of the products are at a high standard like fire survival, etc., etc. There is also a huge play for us of bringing power and data into the data center. We are looking at it in the cable business, and we've publicly stated that about 25% year-on-year growth for the next 5 years. That's what we are targeting. There's a significant amount of capex that Apar has planned. 50% plus of that capex is going into the cable side to create this capacity. For Apar, we have 3 C's that we focus on. The first is capacity, which is the capex that you put in, is the easiest to do. Then you need to improve your company's capability of being able to produce the right products to meet requirements of customers, etc. And the third and most important is to improve credibility of the company. So to do very well in a market like the US, you have to really focus on the last C. Looking at 15% plus,
Revenue
so
growth
we closed at 23,000 crores last year.
Okay, well, stocks at a high, 4.5% and almost all of the move, of course, coming in after the conversation there. Well, CleanMax is the next one we want to just focus on, and we'll ask Sid's view on both. But CleanMax, of course, is buzzing. That deal with Meta coming in early this morning. Vivek has got details, and I mean, just looking at the business of CleanMax itself. Vivek, take it away.
Well, that's right. Let's first understand what CleanMax does. CleanMax is the renewable energy open access provider of power, and the company, remember, differentiated itself from other companies because it is present mainly in the C&I segment, which is the commercial as well as the industrial segment, basically meaning that the company does one-on-one PPAs with industrial customers and largely does not participate in tendering or auctions as far as power is concerned. Now, as far as today's announcement itself is concerned, the company as well as Meta have gone ahead and have signed an agreement for development of renewable energy capacity in India. CleanMax will develop close to 837 megawatt of new solar as well as wind capacity across the states of Rajasthan as well as Karnataka. CleanMax will develop and operate the RE capacity. Meta will go ahead and purchase 100% of the environmental attributes from these projects. Now, just to give some perspective as to the size of CleanMax is concerned, remember, CleanMax is India's largest CMI renewable energy player. Contracted renewable energy portfolio stood at 5.7 gigawatt at the end of FY26. Contracted capacity portfolio was at close to 6.4 gigawatts versus 5 gigawatt on a year-on-year basis. And remember, the company typically signs PPAs of 25 years. So of the remainder of the portfolio, 23 years is what is pending as far as the company's contracted portfolio is concerned. In terms of FY27 targets, remember, at the end of Q4, the management did join us. They said that they expect to go ahead and operationalize 1.5 gigawatt of commission capacity in this particular year. In terms of valuations, not really cheap after the very sharp rally that we've seen. Axis Capital estimates that at the current market price, the company could be trading close to 12.5 to 13 times of FY28 estimated EV to EBITDA.
Just one point. This is largely wind and solar, right?
That's right.
So, but the data center capacity, and I think we've asked the management when they've been. So, this is, there's nothing called base load for data center, right? I mean, 24/7 it is base load because I mean the data center works non-stop. I mean, data centers just as a concept. So, this is for large data centers. Will this be a combination of grid power plus on-location power from CleanMax, or like are we looking at battery systems and whatnot? I mean, is there clarity there?
Well, a couple of quick points. Number one, yes, in terms of data center, when you're talking about the base load, during the daytime, there is actually surplus of capacity, but the bigger problem comes in the evening time when there is actually not enough solar or wind to actually go ahead and supply. So in that particular case, thermal is what comes into the picture. But yes, going forward, most of the renewable energy PPAs that you will see will be a combination of solar plus BESS, which is battery energy storage system. Now, talking about CleanMax itself, one thing that we need to keep in mind is, company typically when it signs a PPA, it's not necessary that for this particular project, CleanMax will be providing the entire power supply. In this particular case, Meta will use environmental attributes. In that particular case, Meta will be able to go ahead and offset some of the carbon footprint that it generates, for some of the other facilities via this particular purchase agreement with CleanMax. Now, we will be speaking to the management of CleanMax in a couple of days, get some more details on this particular development itself. But largely, what they've highlighted with us is going forward, it is going to be a mix. And in typically, the risk that in terms of the transmission is borne by the company that is buying power from CleanMax.
All right. Well, thanks very much. We don't have very much by way of details with regards to Meta. There is confidentiality issues, etc., etc. But the other thing to wonder about is if you read what's happening in the US, because these large, hyperscalers like Meta, etc., have all the money in the world. I mean, sort of speaking, in a liberal way, they are actually enabling their providers in lots of ways, enabling them to provide services to them because the requirements are so large. But we don't have that that level of detail with regards to what they're doing here in India with companies like CleanMax. Perhaps, should come out at a later date. Siddharth, any thoughts? CleanMax first and then that conversation with Apar.
Yeah, Prashant, I think this is a space that we are very positive on as a house. Motilal, our NFO on the BSE Clean Environment Index Fund is currently on. We have coverage on stocks on the renewable energy front, plus on the recycling front. So Gravita, Gen, Resource, Acme Solar. So I think Premium Energy, Vari Energy. So this entire space looks interesting. And I think with the kind of power usage the data centers, the AI centers would be going to use, and with the focus on the environment, we are already hearing the kind of chatter that the amount of water is required in one query that we put in the AI. So I think these themes will continue to do well. We need to understand greater finer details of the arrangement, what is the kind of power supply, what is the long-term duration, and all those kind of things. But nonetheless, I think this is a space which looks interesting. The second one on Apar, I think very clean, good company, is one of the largest manufacturers of conductors and also a major player in the specialty oils and cables business. What they are now doing is that shifting to premium products. The interview also spoke about a lot of these newer segments where the demand is coming from and how they are kind of able to shift a significant portion of the portfolio towards these value-added, high-efficiency cables, conductors, wires. Financials are pretty strong, but I think stock has seen a sharp run-up and would be now closer in terms of valuation. I would say that from here on, one can expect a 20% kind of a CAGR profitability growth and similar kind of return from the stock.
Okay, got it. Any view on CMR? You had mentioned recycler, so I ask you.
CMR listed today, we were one of the bankers, so I think I would better avoid giving any view. But as I said, this is a space that we are very positive on.
Got it. Okay, thanks a lot, Sid, for joining in, giving us a take on all the stocks that we discussed. But as we were discussing those stocks, the markets actually have done a bit of a U-turn. The Nifty bank that was up 250 points, that's moved into the red. And the Nifty as well has come off. I'll tell you what, we'll take a short break. on the other side. Pramod Gopi of Marcellus is waiting for us in our special segment, Alpha Managers. Stay tuned. Well, the markets have flattened out a little bit, just around the flat line. Both the Nifty as well as the Nifty Bank, the Midcap index continues to remain under some pressure. But the mutual fund data for the month has been released, and Vinny, she's been slicing and dicing those numbers. She joins us to give us, quick insight into how those flows looked. Vinny?
Hi, afternoon. So in terms of the flows that have come in, equity inflows for the month of May, we've seen a dip coming in on a month-on-month basis, 40% decline, right? And this is the weakest inflow that we've seen for equity inflows in over more than a year. So clearly there's pressure that's come in across the board, whether large cap, mid cap, small cap or hybrid funds. Now let's break it down and look at the large cap funds as well. What happened in terms of flows there? That more than halved on a month-on-month basis, lowest levels that we saw coming in for large cap funds since December 2025. Mid and small cap, while that managed to hold on in the month of March and April, we've seen a decline coming in there as well, right? Mid-cap is down 33% on a month-on-month basis. Small cap also similarly, it's seen a very sharp decline from the month of April. So May 2026, large cap, mid-cap, small cap, nothing did well there. What was steady was the SIP flows. That stood steady at about the 30,000 crore mark. So on a month-on-month basis, yes, you've seen a 1% decline versus April, but investors seems like they've not panicked, at least for the long-term story. In the short term, you've seen some bit of that cautious stance that have come in from investors right now, but SIP flows steady there. The contribution in terms of SIP also continues to be steady. Contributing SIP number, that's something That is a bit of a concern and a bit of a dip that they saw coming in there. Now let's move on, talk about hybrid funds. What happened there? Hybrid funds, they also seen a decline, halved on a month-on-month basis, right? From 20,000 crores, now it's at around 10,000 crores overall hybrid funds. Specifically, when you look at multi-asset allocation fund, which was trending, which is where everyone wanted to invest in, multi-asset allocation and flexi cap funds. This is what everyone looked at. That has also come off, and that also seeing a significant decline versus last month. Multi-asset allocation down 23%, flexi cap is down 49% on a month-on-month basis. Sectoral thematic funds, they had lost their charm a while back, and now further decline is what you're seeing coming in on these funds as well. On a month-on-month basis, from 1,900 crores approximately, now it's at 650 crores, the thematic funds. Gold ETFs. We've seen that run-up coming in gold prices. Gold ETFs saw some bit of a profit booking, and now we've seen sharper profit booking coming in here right now. Gold ETF outflows is what we've seen this time. Outflow for the first time that we're seeing coming in since April 2025. Silver ETF also similarly, we've seen an outflow this time. So gold ETF, silver ETF, both have seen outflows coming in. NFO, nothing exciting in terms of data points over there as well. You're not seeing much launches in terms of new fund offerings coming in. So that continues to be a bit subdued and muted. While in terms of the AUM, we are managing to hold on steady. The overall asset under management at around 81 lakhs. 81.5 lakh crore, and that's what we are holding steady at right now.
Okay, well, thanks very much for that, Winnie. So that's those are the numbers with regards to flows and that retail bid, which has sort of meant that markets have stayed rock solid even as foreigners continue to sell, and they are selling 40,000 crores this month so far. Well, Pramod Gubi is with us, co-founder, Marcellus Investment Managers. Pramod, good to have you with us here. You're not a mutual fund, but you also do take in money, and you're also dependent on the mood and the sentiment out there. So just, I mean, your thoughts on what we've seen in May, and how steady is that retail bid going to be?
No, I think it's quite encouraging if you see the bump up in the flows in March and April suggests that investors are willing to buy into the dip here. And after the rally in April, you would have expected some slowdown. So I think it's quite encouraging and positively surprising that the flows are sort of counter-cyclical. To that extent, I think it is credit to the retail investor for demonstrating such maturity, and also I think credit to the industry to have created this awareness.
But is it starting to come off a little bit? I mean, there are many who say that, well, headline indices being flat, were 2 years plus, maybe we'll start to test patience at some point. I don't know if you're seeing that at all.
Yeah. So I mean, look, I think the returns, given the awareness that the industry has created in terms of long-term orientation, the short-term returns hopefully should not, but if the situation persists, you never know. We've seen this in the past, flows coming in at the top of the market and then receding. Hopefully, we should see better behavior this time around. But having said that, I think given the number of variables, particularly global parameters, which are not entirely under our control, and things like AI and stuff, where nobody really knows how it's going to pan out. I don't think you can say with any degree of certainty when investors will see fatigue and throw in the towel. But so far, it seems fairly stable.
Hi, Pramod. Good to see you, Ben. How would you position yourself, though? As of now, if you're deploying fresh money, would you look at the small mid caps, or would it be the larger caps that you would find comfort in?
I think we are getting into an environment where it's become a little market cap agnostic. It is a lot more bottom up. There are no obvious themes that you're seeing. In fact, from a factor perspective, we're seeing quality getting re-rated finally after almost 5 years of underperformance. I mean, those 5 years of underperformance came on the back of 10 years of outperformance, but perhaps these are early signs of quality coming back in a factor of values after values outperformance. Given that we're generally positioned as a quality house, we're seeing some opportunities, high quality businesses, particularly where we see the growth valuation trade-off attractive. The obvious place is clearly financials, where valuations are clearly attractive on the private sector financials front.
Okay.
Healthcare has been a decent exposure for us, and that's more of a structural theme. Not to say that valuations are attractive here, but if you look into it, you will find opportunities where the growth prospects can justify the valuations. The third area we're seeing a lot of opportunity, where perhaps there is a tilt towards small and mid cap, is opportunities on the back of the rupee depreciation, where manufacturing exports in specific sectors are clearly becoming more and more competitive. Even before the FTAs have kicked in, we're seeing some order books getting built up. And these generally tend to be more in the small and mid cap space.
Okay, all right. You talk about quality, but quality has been painful, right? Some of those frontline names, some of the top MNC, well-run companies, HUL, Lever, the likes, they have not given any returns. And companies like Asian Paints actually have seen a sharp drawdown. So you've given us a few sectors you like. Let's focus a little bit more. What about staples? I'm focusing on some underperforming sectors, whether or not you believe they provide an opportunity. Staples, paints, would you look at them?
Yeah, I mean, look, I think the definition of quality is also changing. Typically, quality used to be clean accounting, high ROCs. I think along with the high ROCs, you also need to look at reinvestment rates. One of the classic sectors, I think both FMCG and IT, historically part of the quality pack, have clearly underperformed, not just in terms of stock prices, but also in terms of growth. They've clearly gone ex-growth. This is where a little bit of nuance is required. Within FMCG, I think certain categories are reaching very high levels of penetration, so therefore structural growth itself has come off. But more than that, I think the traditional moats around brand and distribution have been broken by the emergence of digital marketing and e-commerce and quick commerce on the distribution side, which has allowed significant lowering of entry barriers. So we've seen a plethora of D2C brands coming and competing with the biggies like Favours and the Maricos of the world. So to that extent, they have lost market share. And therefore, although they remain very high ROC businesses, very well-run businesses, the growth has clearly come off. So you need to be looking at quality with a slightly different lens. IT, on the other hand, clearly has been affected. IT services have lost share to GCCs. But more recently, we've seen the impact of AI. To be honest, nobody really knows how much of an impact this is. But clearly, that's knocked off a few percentage points of growth, because a lot of the IT budgets are getting diverted towards spending on data centers from hyperscalers, as opposed to dishing out contracts for the next ERP implementation or the cloud migration. So FMCG and IT needs to be seen in that light. Having said that, quality is not just staples in IT. We've seen quality companies exist across healthcare, within hospitals, pharmaceuticals, and even cyclicals now. We're seeing a whole host of manufacturing businesses tick the box on the combination of high ROC and high reinvestment rates. So like I said, if you look at the rupee depreciation as a tailwind, there could be significant opportunities for reinvestment-driven growth in some of these sectors.
Got it. Okay, all right. Pramod, thanks a lot for joining in. Wishing you a good remainder of the day, and we catch up soon to understand how you're rejigging your portfolio. Well, time to slip into a short break. On the other side, D-Street Chatter is waiting for you. Nimesh will tell us what is he picking up. We'll also get our technical experts to give you some fresh trading calls. Markets slipped into the red then as we speak, with outperforming index today is the FMCG pack. You have Nestle as well as HUL, both of them holding on to gains, but they don't count much on the index itself. Good time to get in Nimesh to tell us what is he picking up on D Street Chatter. Nimesh, good afternoon.
Hi, afternoon, Nigel. A sharp sell-off, especially in the last half an hour of trade, and a bit of surprising as well, because at least from a flow perspective, the indication were not that there is a very large selling from the FIs. In fact, there is a small MOC buy at a leading FI desk. So, not sure what led to this big sell-off, at least in the Nifty and in the larger name stocks. But again, from a flow perspective, I guess the momentum is clearly there in the private bank names. That's been the consistent feedback, and it's showing up in the outperformance as well. So, private bank is where, by since still there is a good bit of interest from large institutions. The breadth is quite weak in today's market, and looks like it's a bit of profit booking day in the broader market names. So many of those mid-cap and small-cap stocks which have really outperformed in the last few months have seen a bit of profit booking in today's market. But I guess it's under pressure today, but it doesn't sounds to me that there is a very large selling from larger FIs today.
Yeah. Individual names, Nimesh, that's where all the chatter is.
So the first name is Chambal Fertilizer, Prashant. So a bit surprising, but it's moved up today and on very strong buying flow. So not sure what the reason is, but there is a bit of FI interest in Chambal Fertilizer in today's market. So expect very high delivery volumes in this particular stock today, and hence we've seen a big up move, 5% up in today's market. The second stock is Oil India. We've been highlighting since morning. There is a big Morgan Stanley downgrade from an overweight to underweight, but I believe there are very large selfers as well, which is adding pressure to underperformance for Oil India in today's market. Third, a couple of names where I'm expecting fundraising very soon. Kim's as well as Craftsman Auto. Both have been consolidating with a positive bias, but now at these levels, either through a QIP or preferential, is something which is lined up in both those names. And the last one is Tejas Networks. Again, it's a bit of curious the way the stock moves throughout the year, down one day, up one day. But now I'm hearing at least the street is anticipating one large order win, as well as a potential global tie-up as well in Tejas Networks. And hence you've seen in the last couple of days a bit of momentum and with a bit of larger volumes as well in that particular stock.
Large order, I mean, the one, I think this is no secret, Nimesh, the one order is the BSNL order, right? Which has been, people have been talking about for a while, for years actually.
Yeah, that's been anticipated that the large BSNL order is likely to come, but this I believe is a global order. So it could be over and above the BSNL order, and also the tie-up seems to be with a global company. So these are the two bits of news as far as Tejas is concerned.
Right. Anything on Z, Nimesh? I mean, the board meeting is today, right?
So the board meeting is today. The feedback is that the promoter is quite keen to infuse money, so that potentially will come. The promoter are looking to invest via warrants or preferential, so that's something to watch out for. I'm not too sure whether any external investors or HNIs are going to participate in the fundraising. So that bit of clarity is not there, but it looks like at least the promoter entity is likely to infuse, and that's the reason the board meeting is there for fundraising today.
And with regards to Z, if the fundraise thing happens and the promoter is basically what comes after that, which the street is talking about, right? Maybe kind of a spin-off, value unlock, or something.
So, of course, that chatter has been there that they're looking to value unlock. In fact, even if you listen to the last con call, the management has gone on record saying that they will eventually, look for options as far as the Zee Music is concerned. So it's not a big secret that they haven't spoken at all to the investor community. But Prashant, even for the fundraising in Zee, given that the promoter holding is so low, even if they propose to fundraise via preferential to promoters via warrants or whatever, it will require shareholders' approval. So even that is something to watch out for. Yes, today there is a board meeting, so they will propose that promoters wants to increase the stake and infuse money. But will the shareholders approve that is again something to track as to whether there is an approval from the larger part of the investor community for promoters to infuse at this level.
Sure. So, fair enough. There could be opposition from shareholders. We don't know. But yeah. So we'll track this one. Thanks very much, Ramesh, for that. So Chambal, Indian Oil, Kim's, Craftsman Auto, Tejas Networks are the stocks on the chatter list today. We'll take, should we take a quick break? Okay, I think Mitesh is with us. Mitesh, welcome back. How are you? What's been happening? I think we've come off, right, from the last time we spoke.
Big time, both the markets have turned negative. So, we'll take some STBT calls. Tata Motors personal vehicle, TMPV, is an STBT with a stop at 385 for targets of 374 or thereabouts. And the insurance companies have been in a free fall, I think, even breaking the earlier lows, and one of them is SBI Life. So that's an STBT with a stop at 1740 for targets of around 1700.
Okay, all right. We'll track this one, but 40 points lower, far off from where we were. 23,200 now as far as the index is concerned. Well, let's shift focus to the pharmaceutical space, and this is pharma major Cipla. CNBC TV18 made its way to the company's Goa facility to speak with the recently appointed Chief Executive Officer Achin Gupta. This is his first interview since taking over the strategy that he has for the business. Here's that chat with my colleague Ekta Batra. Listen in.
A lot of the mainstay of revenues in time to come, maybe 5 years, 10 years, will still stay generics, because that's where we serve the maximum number of patients. There we'll go up on complexity. So we already have B2s in the US, which have a higher complexity. We have innovated a lot in India. If you see the respiratory devices, we have breath actuated devices. We recently launched an inhaled insulin. We've launched various, I think in every single therapy in the last 1 year itself, we've launched novel products. So the journey now is to take Cipla onto the more globally relevant novel innovation, where we've done small moves over the last, I would say, 3-4 years. We've tested the waters. We're going to expand that effort. If you ask me in 5 years, we would love to have 10% revenues from innovation, but when we complete 100, I would love to see much more coming out of innovation, because that's where the world is going. And, Cipla has the right skill sets. We have the talent. We have the capabilities to get there and be a bigger player in innovation.
Just give us a sense, which are the geographies that you're supplying this to? 3 lakh tablets per hour. Which are the main geographies that this is being manufactured?
So right now, the biggest product which is coming out of here is actually for India itself.
Okay.
It's a cardiology product.
Okay.
Ditor is the brand name.
Which is one of your most successful products right now for the Indian market.
In India, yeah. It's one of the flagship products.
Okay, so that's being manufactured here.
Yeah. The advantage of having a facility like this is you can get excellent quality.
Yeah.
And when you have large volume requirements, that's where it works best, because minimal interventions, like you see, there are hardly any operators, and the process just continues delivering a very consistent quality real-time checks, and therefore you don't have to make too many interventions, less changeovers. I think ultimately, see, the game is about saying how can you deliver best quality at the best price.
Yeah.
So it helps you achieve both those objectives.
So how much of Goa supplies to the US? And how many plants out of the 48 units that you have supply to the US?
So currently Goa is pretty much supplying all the markets.
Okay.
And close to half of the manufacturing will be for US, but also Europe, various other markets. Developed markets, Asian markets, Latin American markets. This facility is one of our largest, so it supplies everywhere.
The reason I'm asking about the US particularly is because there's a push from the government, from the US government currently, to look at domestic manufacturing versus exports.
Yeah.
So where does Cipla stand when it comes to manufacturing in the US for the US?
Yeah, so I think that has multiple dimensions. If you see, Cipla has now 4 manufacturing facilities in the US. We are doing it with the objective of de-risking and diversifying the manufacturing. So if you talk about the 48 manufacturing facilities we have sites in South Africa, we have sites in Morocco, we have sites in China, and now we have sites in US. One of them is a new site. To answer your question, I think this is not just the localization push from the local administrations, but also gives us flexibility, because what we are able to do is take some of the more complex dose forms closer to the market. Right? So if it's a respiratory unit, which is making, like our newest approval, which is Ventolin, will be made in the US for the US.
Okay.
Advair generic, which we are expecting soon, will be made in the US for the US. So it helps us de-risk. And every country wants some bit of manufacturing to happen.
That brings me to lanreotide, which has been the key issue for Cipla this year. What is the remediation with your Greek supplier at this point? What are you doing to mitigate the risk? Is there any tech transfer, any other facility where you'll be manufacturing?
Yes. Yeah, so exactly on that de-risking theme, I think, the current supplier, which is Pharmathen, got a warning letter from the US. So they are remediating, and that's one of the tracks. Once they're ready, we will be inviting the FDA to